Good morning, traders, and welcome to the Traders Corner Stock and Options Investors Summit. I'm Anthony Chapman, your host for today's event, and I couldn't be more excited to guide you through what promises to be an incredible day packed with insights, strategies, and real-world trading wisdom. Markets are moving, volatility is high, and opportunity is around us if you look hard enough and are disciplined to make the right trades. That's why we've assembled an all-star lineup of elite trading minds, 7 experts who are ready to share their most powerful strategies for profiting in today's market environment. Whether you're a seasoned trader or just starting out, today is about equipping you with tools and ideas you can act on immediately. So let's dive in. Up first, we're joined by the dynamic Melissa Armo of the Stock Swoosh TV. She's an analyst and educator and the force behind Make a Million with Melissa. Her presentation is titled Trade on the Side of Institutional Money and Gaps. Melissa's Golden Gap strategy is built on tracking big money, and today she's going to show you how to align your trades with institutional flows to maximize profit potential. Let's give a warm welcome to Melissa Armo.
Good morning. Can you hear me?
Yes, I can. Thank you, Melissa.
Wonderful. Let me know if you can see the screen too.
I can. Can the audience as well?
Perfect. Thanks for having me. I think I have till about 12 o'clock. Is that correct, Anthony?
Yes, that's correct. Thank you.
Perfect. I will watch the clock. Welcome, everyone. Thanks for being here with me on a Saturday morning. It's actually sunny here in New York City, which I'm thrilled because we've had nonstop rain and probably the coldest May. And today is the last day of May, so I hope June is actually going to be beautiful and sunny and start to feel like summer here in New York City. So today I'm going to talk to you a little bit about what I do, and if you have questions, you can plop it in the room and I will answer the questions as we go along this morning. So I'm going to talk to you today about trading on the side of institutional money and gaps. And when I started trading, which seems like a long time ago, 17 years ago, I had no idea what I wanted to do except for the fact that I wanted to make money. When I started out, I was doing mortgages, and that was 2008. And the mortgage industry was totally collapsing, 2007, 2008. And I said, you know what, I want to do something different with my life. But at that time, actually, this was before work at home or work from home was popular, when now everyone's doing it. I was working from home. So the idea of finding another career to substitute my mortgage job that I could work from home was something that I really liked. And I said, you know what, I think I can do this. But when I started trading, I didn't know what to do. And it was more challenging than I thought. But I very quickly realized, I was smart enough to realize that you only needed to do one thing in order to make money. I only needed one strategy, and many days only one trade. So that was something that I learned, you know, right out of the gate. I didn't know what I was doing. Like I said, it took me about 3 years to totally get to the point where I knew what I was doing and creating the system that I've been doing now for the last 14 years. But I knew that I really only needed one thing. And I think one of the critical mistakes that a lot of traders make is they try to learn too many things. The idea of becoming a jack of all trades and a master of none doesn't work for the market, particularly in times when the market is tough. And I think at the beginning of the year or towards the early start of the year, I think people thought the year was going to be something that it turned out not to be. And then it got choppy for people, and now everybody thinks it's easy again. But trust me when I say June is probably going to be one of the most volatile months of June that we've ever seen in the market. Typically, people think, well, summer is not a busy time to trade. That's just not true. Earnings season starts in July. So July and August are earnings, where stocks report earnings, and they typically gap, which we're going to talk about in a minute. But I think June is going to be crazy volatility because we're going to be starting to talk more and more about tariffs, because the tariff pause, remember, that the current administration put on ends at the beginning of July. So that's going to be on tap, and already you've seen some volatility even in the last 2 days where people are really talking about tariffs again. I also appear on TV, I talk about the stock market, I talk about the economy. They're not necessarily related. You may have a fabulous, fabulous, fabulous economy and a market selling off. You could have a bad economy, or you could have, you know, we could be in a recession. You could have the market at new highs. So they don't always go hand in hand. Again, we had a number on Friday, an inflation number, and the market actually had a sell-off Friday. So again, and that inflation came in lower than expected. So they don't always go hand in hand. it's something that we can talk about more at another time. But if you'd like more information, you can always call me at 929-3200-GAP. You can email me at melissa@theswoosh.com and follow me on any social media sites as well. So like I said, it's summer. It's a great time to trade because what I do is look at fast trades in the morning. I do not want to sit at a computer all day for 6.5 hours. Now, I do options, which we will talk about. I don't babysit my options where I'm staring at a screen. I may be in an option later into the day, but I'll check it like at lunch, or I'll check it before 4 o'clock. I'm not sitting and staring at my options trades. I'm doing the weekly options that expire on the Fridays. But my day trades, I'm in and out quick in the morning, the first half an hour, hour of the day. And again, nice to do that in the summer. Why? Because you have the rest of the day to yourself. And like I said, I'm really looking forward to having some downtime, you know, in the summer. It's been a busy start, really busy start to 2025 as far as trading goes. And like I said, when I started trading, I wanted to do a different career. Nowadays, I think people don't necessarily want to get involved with trading because they want to switch jobs. They just want to make extra money. Despite the number that we got Friday, I still think, this is me personally, and again, I live in Manhattan, I think prices are still high. Like, I mean, you could say, well, they went down. Yeah, but rewind 5 years ago, or 6 years ago, or 4 years ago even. I still think we're in a high inflationary environment compared to where we were 5 years ago. I remember the prices of things. So lots of times now people are coming to me, they want to trade, they like their job, they like their career. They're not interested in doing this for the reasons that I was 17 years ago necessarily, but they just want something that they can do on the side that's part-time hours where they can make extra money. And that's fine. You know, whatever the reason is for you wanting to do it, I think you should know why you want to trade. But a lot of people want to do this. They want to make money, but a lot of times people don't know how to make it happen. So whether you want to do this full-time or part-time, like I said, for me, it's a part-time hour situation. And like I said, when I was doing mortgages, it was 7 days a week. So even if I sat at the screen all day, which I don't, but even if I did from 9:30 to 4, that's 6.5 hours, you know. So again, I'm trading during the live market hours between 9:30 and 4. So it's not even 40 hours a week, to be honest with you. But you need the right tools to be successful, number one. And a lot of people don't have that. And what do I mean by the right tools? You need a strategy and a system. You've got to have the right system in order to get good results. You're not going to get good results if you're all over the place. It's just not going to happen. It's going to be the luck of the draw or 50-50 crapshoot. And eventually it takes a toll on you. What I found, again, just as my personal experience when I started out trading, and then again, teaching people for 14 years, is a lot of times when people get into a losing streak where they're trading and taking losing, yes, it takes a hit to your trading account. But to be honest with you, it takes more of a toll on you emotionally, because then what happens is you start to go into that negative Nelly kind of behavior, and then you stop believing that you can do it at all. And that's the worst thing to do. You can always make money in the market if you learn a system that works. You can always make money, even if you're in the hole, you can always come back. Always, 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 always. If you have a bad day or a bad week or a bad month or even a bad year. Like if you're having a bad start to 2025, it's, you know, it's 5 months into the year. You got plenty of time to pull your year around, but not if you're not using a system that works. You'll dig yourself a deeper hole. You know, if you keep doing what doesn't work, you're going to dig yourself a deeper hole. But for many people, what I find is that the emotional toll of going into the losing mentality takes a toll on them even more than the financial aspect of it is. And again, nobody wants to lose money. So you have to be very thoughtful about the trades that you take. So when I decided to do this, like I said, I realized one thing was all that I needed. So I was trying to hone it down. I was looking for high odds trades. And it wasn't like I started out and woke up one morning, I figured everything out. No, like I said, it took me 3 years. So I developed a system, which is a rating system. It's a checklist. And this is what I do every day. Even after all these years, I do it. I don't scrunch it or skip it or trade on the fly. I go through the process of rating the gap every single day. So I developed a system that would give me high odds. I said, well, if I take this trade, it's high odds of working. And that's what I want. So I look at 26 points. I don't have to get a perfect score. I'm trying to get 20 or more. If I get 20 points, I feel like the trade is going to go in my direction. Again, whether I go long or short, but we're going to talk today. I prefer to short. I prefer to short, and there's reasons for that as well. So one of the biggest shorts we've had in the last week or even the last month was UNH. And I don't know if you've been following this. Again, if you love fundamentals, if you love it, love it, love it, there's been tons of things that have been going on with this UNH news-wise, but we did some beautiful day trades and some beautiful puts in this when we were short it. And again, it's a lovely chart, but let's talk about what is a gap. So this is a daily, okay, it's a daily chart of UNH. So a gap is the difference between the close and the open. So every day, the stock market, the US stock market closes at 4 o'clock and opens the next day at 9:30. Now, does every stock gap every day? Yeah, usually everything gaps, including the market, but it doesn't necessarily mean it's playable or predictable. Yeah, that's why I coined the term the golden gap, because it's like finding gold if you find something that rates good. So again, well, actually, this was Mother's Day weekend. I can't believe that was so far away now. This was 2 weeks away. 2 weeks ago, this was. We did this here. Closed here, gap down, open, dropped. So this was a short, okay? So we shorted this. And again, I looked at this before the open. So I'm not trading before the open, but I'm preparing. I'm getting ready, and I'm trying to figure out what to do. So if I don't like anything by 9:30 when the market opens, I'm not doing anything that day. And if I do, then I know what I'm going to do, and then I still don't do it until after the open, okay? So this was one that we did. I sent the trade out for the options newsletter before the open, but you can't do the trade till into the open. So again, I'm prepping in the morning. So I called the 340 UNH puts that expired on 5/16. This was an options trade. So I bought the put and I sold it to exit it. Let's go back here, look at the 13th. So again, I did the 340s. You could have done a lower strike if you wanted to, actually. But I did it. It fell, boom, boom. So again, this was a 16th date expiration that I called on the 13th. So again, even my options trades, I'm doing what I consider short term, okay, short term. So here was the trade. Again, this was not crazy expensive, but again, it's a $300-some price point stock. Cost $14 for one contract on average. I did 7. It was a great trade. Got in on the 13th, exited in the 15th, and again, made 471%. Now, is every trade that I take, do I make almost 500%? No, but some of them I do. Some of them I do. This was a great trade. So I made $46,200 on this trade. So go back, here's the chart. I didn't, got the drop. Boom, boom. And again, if you did a smaller size, which you absolutely could have done. Oh, I don't have the beginner in here, I'm sorry. If you did a smaller size, you could have risked one contract, risked $1,400, just so you know, sold it at 80, and you could have made $6,600 or $6,600. So that's still a nice trade. So again, to be able to risk $1,400, what would you need? What size of account would you have needed? Probably like at least 10 grand. I'd say have 10 grand. 10 grand is good. I wouldn't risk $1,400 if you have 2,000 in an options account. I think that's too much. That's more than half your account of risk. But again, if you risked, $1,400 on this trade and you had 10 grand in your account, you would have made over $6,000 in this trade, and your account would have grown by over 30%, actually almost 50% in one trade. Let's go back. Actually, more than 50%. So we played the gap. Boom, boom. Now, what you could have done, and I don't do this here, you could have done, say you wanted to do 2, and you risked like, over 3,000. You could have got out of 1 here. Basically, say it wouldn't have continued, you wouldn't have lost in it, booked 1 contract and held the other one down. You could have done that too. Now, I don't usually split my trades like that, but there's another idea for you to do it. But again, this was a short. This was a short. So what happened here, institutional money dumped it. They sold it. They sold the stock. They dumped it. Boom. It got dumped. So again, what am I looking for? I'm looking for whether or not I want to go long this, or whether or not I want to short this, or whether or not I don't want to do anything with this, okay, which I obviously decided to do something with it, and it was a good trade. So getting into shorting and why I like to short and why I prefer to short, when I started trading, within the first couple of months of me trading on my own, I did a trade, I'll never forget, it was a trade in Netflix. I didn't have big size. I was shorting on margin. It wasn't an options trade. I had a couple hundred shares and I made over $1,000 in the trade, like in less than 5 minutes. I said, oh my God, I want to do this. I want to do this. Stocks sell off much, much faster than they ever rally. It's just what it is. There's no panic involved with buying. It's very rare that you see panic buying in anything. Stocks are the overall market. But stocks move faster to the downside. So I like that part of it. And also you get big moves to the downside because panic comes in. And again, I was talking earlier, I started talking about the month of June. Again, people are going to be uneasy about what's going to happen, getting closer and closer and closer to the date of the tariff pause, not knowing if it's going to, be revised or if it's going to be kept. And so you could see some selling in stocks or the overall market. Again, panic is the key to shorting, to making money shorting. But getting back to what I was saying, following the smart money really is the intelligent choice. And in fact, it's the only path that will lead you to success. I find that a lot of people, want to, buy the dip and trade gaps for gap fills. That does not consistently work. Sometimes it works, but it doesn't consistently work. So the key to making money for longevity, if you really want to do this, whether it's part-time or full-time, is to having something that consistently has more winners than losers. I have trades that lose. There are trades that I take that loses. In fact, the loser from last week, you can look it up. I had bought a put 2 weeks ago, actually, in Target. I did a video of it. It's on my YouTube. Target didn't work right. Target had earnings, and I bought a put, and it lost. It just never went right. It kind of, the first day I did it, I sort of had a bad feeling about it, but I gave it a shot, and then it just never went right. So it's not that every trade that I take wins, but I have more winners than losers. And then I have some winners that are very big winners. And actually UNH is a good example of that, but we did a couple of trades in that. But getting back to what I was saying, how do you determine what the smart money, the institutional money, the big money in the market is doing? I use my rating system, and it's based on technical analysis and the gaps. Everyone says, well, do I have to buy software? Do I have to? No. You just have a trading account. Whatever broker you have to have live data. Okay, you have to have a live data feed, you have to have charts, and you have to have a daily chart. And that's it. And you should get that, with your broker. So then you can figure it all out. It's just based on technical analysis. What is technical analysis? Technical analysis is predicting future price movements by looking at past price movements. And that's how I do it. Excuse me. And any questions here? I'm going to take a sip of coffee. Have my caffeine for the morning. So again, part of the magic of trading is not predicting what's going to get. Like I'm not a psychic, Somebody says, well, why aren't you doing leaps if you, think the market could sell off? Why don't you buy leaps in the SPY for January 2026? Because again, I'm not a psychic. I'm doing short-term moves, which is actually something that you can wrap your head around predicting pretty close to the button, pretty close to the nose. It's like if I said to you, what are you going to have for dinner tonight? You'd be like, oh, I'm defrosting chicken. I'm going to make chicken parmesan or something, Saturday night dinner. But if I said, what are you going to have for dinner next Saturday night? You're like, oh my God, next Saturday? I have no idea. I didn't even go grocery shopping yet. So again, that's just a span of a week. So like to predict where the market or the SPY will be by January 2026, 8 months from now, no one knows, because I don't think anyone could have predicted the movements the market had and the sell-off that we had late March, early April. And again, I'm not predicting where the market's going to be by July 4th, but I am trading this coming week, and I'm going to trade the next week and the next week and the next week. And as I see the moves in the gaps, then I will be able to make my choices to take my trades, to take the trade, get the move, take it, book it, get out. Take it, book it, get out. Again, that's the whole way you chunk it out and you can make money, again, whether you're doing this part-time or long time. Somebody's asking a question, how to check the 26 points for a stock. I don't like to rush it. I open the room every day at 9 a.m. Not cutoff time to enter is 9:20. If you're a room member and you want to log in at 9 a.m., then you've got 30 minutes to go through your points. I think you should give yourself an hour. So you should probably start about 8:30. Now, for me personally, I don't like rush, okay? I get up early, look at the market before I even exercise in the morning, go walk in the park if it's not raining, come back, have breakfast, look at everything around 7 a.m., 7:30. So I give myself probably an hour and a half because I don't like to rush. So again, that's just me. I would give yourself an hour. I think an hour is plenty of time. I think 30 minutes, you could rate stuff in 30 minutes and you could scan in 30 minutes, but you're going to be rushing it. And I just like to be kind of ready to go by like 9. You know, not that I'm not still looking at stuff after 9, but like by 9 o'clock, I kind of like most data is out. Data points are out by 8:15, 8:30. The market sometimes moves on econ that we have out. By 9 o'clock, things are pretty much situated that I know what I want to do. So it doesn't take hours and hours and hours if that's what you're asking me. Why? Because I scan very quickly in the morning. I can scan very quickly, just eyeball things and say, no. So most things I'm not even rating. So even though there's thousands and thousands and thousands of things every day that gap, once you learn the system, you're not going to rate everything. You'll make a small watch list of 5, 10, 15, 20 things if it's a busy earnings season, but you're not going to rate hundreds or thousands of things. Even in a busy morning, I might rate 20 things, and that's a lot, but you could do that in an hour. So again, I don't rush it, but you're not rating thousands of stocks, because once you learn the system, you're manually just eyeballing and saying, no, you can see right away, this isn't even going to cut the honey mustard. And it's like a nothing burger, you know, which actually, to be honest with you, most gaps are. You know, on most any day of the market, most stocks go with the overall market direction. So then you're like, okay, well, how do I play it? Well, then you got to get the market direction right. How are you going to do that? Look at the market from Friday. Again, I don't have a Friday chart in here, but we gapped down Friday, sold off really hard, and then late into the close bounced. Like, again, unless you're perfect at reading the market every second or every minute of the day, if you don't do something that's on its own that doesn't need the market, you're gonna have a hard time making money. And you can't even do a stock in the right direction of the trend even all the time, because that's not gonna work either. And then are you even reading the trend right? A lot of people don't read trends right, actually, which is that's another topic for another lecture at another time. Anyways, I just wanna go back here to this point in time, which we're gonna come up against. We're going to come up against here. I said it all the whole time after this bar of the day that Trump paused the tariffs, which was the night. I said, this isn't over. This isn't over. Are you kidding me? This is not even over at a long shot. And everyone was convinced it was, and this was a low for the year. I don't know if it's a low for the year, but I got to be honest with you. I'm probably 1 in a million people that think it may not be. Most people think this is. I'm like, it's 50-50, because I wouldn't be surprised at all if it's not. And some people are betting the farm and risking the farm that in fact it is, because people are long. So let's go back here. Stock close here, gap down. Again, this is a chart of the SPY. This is a gap. So again, this was back beginning of April. Market closed up here, snug as a bug, around 565 and change, gap down, open, rallied, drop. So you could have shorted this on margin. Again, this is the SPY. It's kind of pricey, or you could have bought a put. So the puts are cheaper to do. People are even doing daily puts now. Now, I don't do the daily puts, but they're way cheaper than the weeklies. Then we had another gap, close here, gap down, boom. Beautiful sell-off here. Again, this was a fatter day than the first day. And again, this was a short. This was a short. Here's another chart that I've been loving. We've been doing Apple, and it's been working. We did a short in this here, did a put, got the drop, boom. Again, there's been news out on this. This has been something that's been really on tap with the tariff issues. So there's been a lot of gaps in Apple. So again, I find gaps and I rate them using a checklist. Gaps have to be qualified. The checklist tells you what to look for in the price of the stock. And again, it's based on the chart, which is something anybody can get anywhere in the world at any broker. And you got to have live data though. You got to make sure you have live data feed. And again, if you want to be somebody that's, you know, into the fundamentals, fine, but you should make decisions based on that for short-term trades. You want to invest in a stock long-term. You're like, I want to buy this here and I want to hold it for the rest of, you know, 25 years or something because the fundamentals are good. That's not what I'm doing. Okay, I'm doing short-term trades where we're taking trades, getting the momentum, getting in and getting out. So the big money comes in and does what? It either buys a stock or the market, or it shorts it, or it sells it. So again, I trade on the side of institutional money for the big momentum moves. Big momentum can equal big money. Again, this is just such a great chart. Now, I know that there's people out there that are talking about buying this. Again, because somebody asked me about buying this, I said, oh my God, what are you doing? So on certain chat rooms, Reddit chat rooms, whatever, people are buying this for they think it's extended, they think it's sold off hard, they think they're buying the dip in this, they're buying this for a gap fill. My take on this, to be honest with you, is that this is lower. I mean, I don't have the last 2 weeks in here, but you can pull the chart up for yourself and look at it. But again, just a beautiful, beautiful, beautiful example of a very strong downtrend, okay, in this particular chart. So this was one of the days that we shorted this. This was a day trade. Again, this is a day trade where you have to have a margin account. Shorted it at 275.10, boom, got out at 270.20, beautiful trade. You could have held it even more. Again, I like to do my day trades in and out quick. So the entry was here, got out, got the drop, but I want to show you here, this came all the way down to 250. I could have held this. So I don't always get the best exits on all my trades, options or day trades, because again, I'm trying to get out of trades and make money, momentum, and this was a good move. Like this is $5, boom, good, done. Morning, finished. But I just want to show you that this continued. So one of the reasons I like to do puts is because I think it's easier to hold a put. I think it's easier to hold an option because I have a week, you know, or if I do something on a Wednesday for the following Friday, you know, I've got a week and a half or whatever. Like I have to get out of my day trades like this before 4. And I don't carry them overnight and hold them, just so you know. But you have to have a margin account to be able to do that. So anyways, getting back to the rating system, it's a very useful tool. I use this tool each morning to determine what stock to trade and when. It's a very useful tool in the market, but particularly in this type of market where you're back and forth trying to really trade the news. That's what people are trying to do right now, trade the news. They're trying to guess what Trump's going to say, what Scott Bessent is going to say. They're trying to guess all kinds of things, you know. Look at the price, okay? Are institutions selling it? Are they shorting the stock? Are they buying the market or not? Or are they doing nothing? You know, you could have a neutral trend too, where it's back and forth, really basing out, not going anywhere. It also can, the system also can help you decide if you should exit along. Again, I'm talking about shorting here. So like if you rate something and if you're in something long and a gap's done against you and you're long the stock and maybe you're long it for your retirement account and it rates good as a short where we might short it or do a short-term put in it, maybe you want to take profits at it. So that would help you to take profits and longs, but it just takes the guesswork out of your trading if you're looking at something and trying to figure out what to do, because you could really get in your head about it. Everyone's trying to figure out what's going on with the Fed. Are they going to lower rates? What's going to happen? Again, I said this all last year in 2024, that I didn't think the Fed was going to lower rates 5 times. They didn't, okay? And they ended up not even lowering rates, even though all year they talked about it nonstop until the fall of last year. And now here we are, to be honest with you, only in 30 days, we're 6 months into 2025. And they're still talking now about lowering rates this year, 3 times, 2 times. People are still, I would be surprised if they end up raising rates. I don't know, could happen this year, could happen next year. I wouldn't even be surprised. So again, you know, you can't predict what Powell's gonna do. It's, you know, you're just gonna spin your wheels. Look at the price, see what's happening, make a decision and do it. Again, here was another gap. Here's an example of a gap. Stock close here, gap down. This was AIM out, dropped, fell, boom. Again, this was a short. Again, I'm looking at the daily chart. Someone's asking a question. Does your system depend on predicting a gap? No, I see the gap. I'm not predicting the gap's going to happen. In other words, go back to this here. Did I know AIM out on the earnings was going to gap down? No. Was I in the trade before this? No. No. Do you wait until the gap occurs? Yes. Do I use a market order or a limit order? For my day trades, I'm using hotkeys and I have them set up as limit orders. And again, if you never used hotkeys, you can practice that or play around with that yourself. I think mouses are slower to enter trades if you're using a mouse. But there are times that I will, let me go back to the UNH, be in a trade already that I did, that I get a bigger move, which is what happened with this, that I didn't predict the gap. Like I didn't, you could say, well, did you predict this gap? No, but I was already in it here. So I got paid more. Now I could have got out of it here. I could have, I was up. I could have, but I didn't think there was any chance in hell it would go up over 340 where it closed. So I opted to hold it. And then the second day, it was beautiful too. So I decided to hold it, and then I got this. So did I predict this? No, but I was ready in the trade. So there's times where I will be in a trade. I will tell you, I'm in some things I did Friday. So I'm not going to go into details of what trades I'm in. I'm in some stuff Friday that I think gaps down on Monday, some puts. So we'll see if I'm right. But like, I will take a trade and maybe not get out of it because I'm not up. Maybe I'm flat. Maybe I'm up a little, down a little, whatever. Or maybe I'm in it like this, and it's my choice to hold it. Now, you could have got out of it. You could have got out of it and retaken it, but I would have done a lower strike here. But anyways, this was so far in the money. I said, there's no chance in hell this goes over 340 by the 16th. And I was right, it didn't. Or like I said, you could split it. You could split it. You could do one, you could do two, and get out of one and hold one. Anyways, in order to become successful in the market, you have to become an expert, a specialist. So I'm an expert in shorting. I'm also an expert in predicting directional bias, whether it's long or short, although I prefer to short. And again, I'm a specialist in one specific strategy, which is based on gaps. So I go on TV, I talk to a lot of people. A lot of people are managing money for people, and they don't know what a gap is. They don't understand gaps, or they know what a gap is. They don't know how to read them right. It's amazing how many people are managing money, wealth advisors, whatever you want to call them. They don't even know how to read a chart. It's something that was really eye-opening to me when I started television about 10 years ago. It was almost shocking, actually. So I choose a strategy that reads institutional money, or what I call power money in the market. This brings momentum and opportunity. So reading is a skill. It's reading charts is you're looking at something, you're trying to predict where it's going, and you learn it. Okay, it's a skill. It's a lot of times people are trading, and like I said, if they get in their head about losing, it's okay to just say, I have no idea what I'm doing. I'm losing money. This isn't working. I've had it with this thing. It doesn't mean you can't make money in the market. It doesn't mean it's anything wrong with you. It doesn't mean you're dumb or you're stupid or anything else. And yeah, maybe you paid for classes in the past and you didn't learn anything, or maybe you took trades and you lost. You can always make money back. You can always make money back from the market. Really, literally, like once you get on a string of positive trades and learn a good system, it can all turn around for you, and it can turn around very quickly. Again, I can't predict the next 500% option I'm gonna get, but I know that the people, if you're trading with me, if you're on the newsletter for a year, you're gonna get trades like that with me. Here was this UNH again. So here was another trade we did the 13th. This was the first day. Closed here, gap down, open, dropped. Again, if you're like, oh my God, this is so expensive, just do the put. Okay, but I shorted this on margin, 336.95, boom. Again, this is crazy, almost $10, but this stock can rock and roll. So again, with only 800 shares, I made over $7,500. This is a nice move. Again, if you don't want to do this, you can buy the put and get out where I get out as a day trade. So where I got in the day trade, you could have bought the put, just bought whatever, 330s or something, and you could have wrote it down and you could have got out of it as an option, as it played it as a day trade and got out. So again, I did a margin trade here, but if, you can do whatever works for you. If you don't have a margin account, then you can do that. Any other questions here so far? I might have to skip through some of this. I see I only have 12 more minutes. Any other questions? So anyways, you need a winning strategy. You got to learn it. I think it's important to have a mentor, someone like me that guides you in the room. And then I think you got to get good at one thing, because again, that's all you need to make money. And then you add the size to it and you implement a winning mindset. What helps you do that? Just getting good. Just getting good. I'm very confident what I do. And if I make a mistake and I lose, and I go back and I review, was there something I missed? I went back and looked at the target. I said, no, there's nothing that I missed. That market happened to rally those days and it screwed up my target trade. But I do think target actually is lower. I didn't reshort it. But, again, sometimes you go back and look at something. If you lose in a trade and you say, well, did I miss something here? You say, no, it's just the luck of the draw. It just didn't work in my favor at that time. Anyways, let's talk here, review again. What is a gap? A stock gap from the opening price today is different than the closing price of yesterday's trading. A gap is a break in price action from one day to the next. I'm looking to determine the control. Again, if buying comes in, you want to go long. If selling comes in, you want to short. Because if you get the direction right, you're going to win. If you get the direction wrong, you're going to lose. Period. End of story. And this has nothing to do with the trend. There's nothing to do with the trend at all. I'll short stocks in an uptrend all day long, all day long. So it has nothing to do with that. It's the overall control. Someone's asking a question. So you can buy puts at the money instead of shorting margin. If you have an account set up to do options, you can do it. You would buy the put to enter it and try to just pick a strike as close as you can where the price is of whatever you can pull in the drop down. Again, I'm not doing the daily markets expirations, but if I short UNH, which is a Friday expiration, you would just pick the closest one at the price of the stock, wherever it's at, that you can pull. And then you would get out of it in 5 minutes, 10 minutes, 15 minutes. And there are people in the room that are doing that because they don't have a margin account, or they don't like having a margin account, or they have an IRA or whatever. They just like options. You know what I mean? Like, so that's fine. And they're cheaper. I will say that. Again, I like holding options a little bit more, but that's not anything to do with the system. That's just my personal preference. And I like day trades. I do like day trades. You know, I like the fast trades on margin, and that's how I started out trading, actually. Anyways, what is a golden gap? It's a gap that rates 20 points or more per the 26 rating system. This is what you come and learn in my class. It's the checklist. It's the meat and potatoes, which tells me how to make the picks. How did I know UNH would fall? Because I rated it and it rated good. How did I know Apple would fall? Because I rated it and it rated good. We've been doing a lot of trades in this, to be honest with you. Just, they're almost all working. There's only one that we did recently that didn't work. The 210 puts here, 5/20 expiration. This was cheap, to be honest with you. 280, sold at 6, made 114%. Again, we did this on the day of the 15th. I sent this out at 8:43 in the morning. Oh, here was the day. I already talked about it. Boom. So again, you would take it here and you wait for the drop. And in that case, again, I was predicting the sell-off. So I don't know how it's going to sell off. Is it going to sell off on the day I do it? Is it going to sell off the next day? You take it, you wait and see. Again, if you did 1120 risk, you could have made 1280. That's a nice trade. That's a good, solid trade. But again, everything I'm doing is looking for the institutional money, trying to read what's it going to do. Are they buying Apple or are they not? Are they dumping it? Are they dumping it? So again, that's what I'm trying to look for. And you kind of got to get up in the morning and see. If you learn how to read the footprints of big position players before the momentum occurs, you can take the position in the right direction, get out after the move happens for profit. But you have to understand how to trade with this side of power. It's going to help you win big. Like I said, also, I'm a mentor for people because I'm running the room, I'm calling the trades. I developed a system myself, and I think that really helps you. When you have questions, you can email me, call me. You can always reach out to me after the class. And the reason I got into gaps, like I said, is because you have big momentum. So I'm not looking to scalp something where I take 10 cents, 15 cents, 20 cents. I feel like I'm taking too much risk to just make 10, 20 cents of something. I'm trying to make $1 or more. I'm trying to make 100% in every trade that I take, whether it's an option or a day trade. Again, some end up being way more, but it's not like necessarily pre-planned. I might take the trade and then it goes and it's going. And then I'm like, okay, this is going to the next target. The next target's already hit target 3. Well, I'm going to ride it out. So sometimes I'll take it and then again, it's going and then it turns into a big trade. I don't always know necessarily, like before the open, if something's going to be a huge winner. I'm rating the gap and saying it's going to sell off, but I don't know if it's going to go 500% necessarily. But as I'm watching it, as I'm reading the price action, as I'm looking at the technicals, I'm seeing it. And again, what would you learn from me? You're going to learn how to rate the gaps, and you're going to learn how to enter the trades, and you're going to learn how to read who's in control. But for me, it's really just looking at who's doing what in the price of the stock. Again, I'm very good at chart reading. I know people say, well, what books can I read? There's really no books that you could read to prepare for my class. You're into candlesticks. You can read all kinds of books about charts and candlesticks, even though I don't call anything any fancy dancy names with candles. Someone's asking something. If your options trades is losing, can you cut your losses before expiration? I personally do not kill my trade in the middle of it. If that's what you're asking me, if it goes against me, I will write it down to the Friday expiration and it'll usually expire with the full loss. If you want to change what I'm doing and, you know, kill somebody at 50% or whatever, you can. Am I going to share my scoring system? No, the scoring system is what you would pay for when you sign up for the class. First of all, it's a 16-hour class, and I'm not giving this scoring system for free. People pay me for that information. The class is next weekend. I'll skip ahead to that in a minute. Any other questions? Again, we've been talking about institutional money. We've been talking about quality. And again, we've been talking about trading, where I run a live trading room every day that opens at 9, and we start to trade at 9:30, where I'm taking the trade, again, like the UNH trades, where I take the trade, get in, get out. If you go to my YouTube, you can see some of the trading room videos that I have on there. But I really have become an expert in shorting. I mean, over the years I've been doing this. We were in the market before that drop. I didn't know anything about the tariff stuff that was happening. We were in quite a few things. So it's gonna, like, I don't know what I'm gonna do this month. It's like, again, I'm playing it just out till next week so far. But I can tell you it's gonna be a very, very, very volatile market. So it's about working smarter, not harder, if you want to learn how to trade. And you've got to get consistent with what you're doing. But like I said, I like to short because I like the panic aspect of the big, big sell-up. And you think about it intellectually, it makes sense. You can make money going institutional money, and you will lose if you're against it. So how will you learn the system? You will learn the 26 points in the class. You will learn where to enter them and when. And again, we're looking for early confirmation between 9:30 and 10, precise entries with follow through and a good risk reward potential. So I'm trying to get 1 R, but again, many trades are more than that. So if you've been someone that's been trading the market, like I said, and you're not having a good start to 2025, you still have plenty of time this year to turn it around. So if you're interested in learning my system and my method, you can learn it next weekend. Again, it's the 26 points, and it's all of my entries, and it's all of my exits that you'll learn in the class. So it's a complete system to use to trade. And again, the short class where I'm shorting is the class that I teach. We sometimes go long, but it's really rare that we go long. So the class is called the Golden Gap course. It's a full course in how to strategically find, pick, and play stocks that are professional bearish gaps. Class is June 7th and 8th, 9 to 5. And again, the class tuition is $69.99. Class is online. You can be anywhere in the world and take it. And I'm doing a Hello Summer Special, which is if you sign up for the Golden Gap course combo, which is Saturday, Sunday, which is the Golden Gap, and then the Trends, which is Tuesday, June 10th. The price of these 2 classes, which is 3 days of courses, is $79.99. I'm running a special through tomorrow where you get 3 subscriptions free for 1 year, which takes you into June of 2026, which is a long time, really. And you get the Wealth Manifestation course free. That's in July. So it just happens to be a special I was running all week. If you're here and you're interested, it ends tomorrow. Email me at melissathestockswoosh.com if you want to sign up. Jerry, you can email me. If you didn't get any value out of this presentation, then you weren't paying attention, because I said a lot of valuable things for free. Any other questions here from anyone? If you're interested in shorting, if you're interested in learning how to short, if you're interested in learning how to trade gaps, and again, whether it's options or day trades, email me at melissa@thestockswoosh.com. Thanks so much for having me.
Thank you so much, Melissa. That was incredible. Thank you for that eye-opening session on trading with institutional momentum, and thank you for your generous offer. Remember, everyone, you could find Melissa's special promo link. Well, not a promo link, but her email. So make sure to email her if you're interested in her course. Next up is a true legend in the world of options, Lawrence McMillan. Lawrence McMillan, best-selling author of Options as a Strategic Investment and founder of the McMillan Analysis Corporation. His topic today is McMillan's market outlook, what option indicators are saying now. He's going to walk us through current market sentiment and what the options landscape is forecasting for the weeks ahead. Let's welcome Larry McMillan.
Thanks. I think you hear me okay?
I could hear you. Could the audience hear you?
Hopefully. So I'm using a different microphone on my laptop, that's all. Just want to make sure. Okay, great. Thanks. So we're going to spend the next 45 minutes or so talking about the market and what our indicators say. Just a little background on our company. I started this company actually in the 1990s. Seems like a long time ago. And we started out as a derivatives research company, selling data, some strategy recommendations, that sort of thing. Then in 2008, because we had done quite well with handling that financial crisis, we moved into money management. So we're both an RAA and a CTA. And then, we also continue to do a certain amount of option education seminars like this. And we also have a mentoring division. So I'll come back to this later, but we will be sending you the PDFs of this webinar, so you don't have to madly take notes or something like that. We'll be getting those out to you as soon as we, perhaps as soon as tomorrow, certainly Monday. So there's four main indicators that I look at. The number one is the S&P 500 chart, and that's really the most important thing because that is the market. So, if the chart is bullish and your indicators are bearish, well, the chart wins because that's what's really actually happening. We also take a look at, we'll take a look at equity-only put-call ratios and also put-call ratios on some individual stocks and futures. Market breadth, we have a sort of an option-oriented way of looking at that. And then very importantly, the volatility indices and volatility futures surrounding VIX. I have a general rule of thumb, actually two of them, but the one is oversold does not mean buy. So we were getting oversold in the beginning of April, but the market continued on that. Actually, I think we were probably even oversold a little bit at the end of March, and then it got really oversold. But we wait for confirmed buy signals. So we don't just jump in because the market is oversold. And conversely, overbought does not mean sell. So more recently now, we've had some overbought indicators. In fact, there's a couple that are still overbought. But, again, that doesn't mean sell. We wait for a confirmed signal to happen. So here's just a longer term chart on the S&P. We're still in a bull market, I guess, as far as you want to go back. But we've obviously come into some trouble lately. So, and even after we've recovered from the lows of April, we still have this downtrend line right here. And it connects the February high with the most recent high in May. So that's a bearish indicator. Of the longer term, down at the bottom, the blue trend line, that's the longer term bullish bull market trend line. But we did have a very sizable correction in April, 21.3% in just 37 trading days. So very volatile, and that volatility is still with us. Those other corrections on that chart were more than the normal bull market corrections of roughly 9 or 10%. So if we take a little bit closer look at things, a one-year chart, we can see a couple of things. First of all, since we bounced above 5,800 in mid-April, well, actually we didn't really get to 5,800 until May, but we got above 5,700. It sort of halted the downtrend. So right in here, we have support at 5,800 and also at 5,700. That downtrend line that I talked about previously is right there. So the market's sort of in a triangle between that support at 5,800 and that downtrend line right there. So I would say that we're kind of neutral until there's some resolution of what either the support breaks or the downtrend line is penetrated on the upside. Those pink circles are gaps on the chart. Not every gap is filled on an S&P chart, but most of them are. You can go back and look. I mean, I'm sure you can go back and find a real long time ago some gap wasn't filled. But I think the filling of the top two gaps would actually be a positive thing. If you trade it down to 5,700 and then back up again, they'll fill both of those gaps. So if we start talking about filling this gap, that's a major problem. And I have to say we'd be in a bear market if that was going to happen. Right now, I call the downtrend line new because there had been a steeper downtrend line existing in April, and we penetrated through that. But now this next one has happened. But if we close above 59.60, that's the May highs. That would be positive. And of course, there's the all-time highs at 61.50. We close above there, it's off to the races. As I said, we have support 5,700 to 5,800. Technically, 5,760 was the low last week. And we're in this triangle right now. So the S&P chart is, I'd say, modestly bullish, but we're not. I would not take a position just based on that chart until that triangle is resolved one way or the other. Now, another thing we do with the S&P chart is we calculate and draw Bollinger Bands. When John Bollinger invented Bollinger Bands, he needed a definition of realized volatility. So he used the standard deviation of closing prices, which seems reasonable, but that's not what the math guys use, like Black-Scholes. And so they use the standard deviation of daily percentage price changes. So it's slightly different bands, and that's what we use because for us, it's important for our realized volatilities, which uses that definition, to line up with the applied volatilities, which of course are what we're in the business of trading options. So we have a ton of volatility information that we post on our website every day for a pretty cheap subscription. Anyways, we watch for the market to move outside the plus or minus 4 standard deviation band, then move back inside. That's a signal. We were just trading it that way for a while, but there were too many whipsaws, so we added a second criteria to create what we call MVB or McMillan volatility bands, which just for some confirmation. So here's how that chart looks right now. So the top line up here is this is 4 standard deviations right there, and that's +4. And then just inside is +3 standard deviations. So you can see, for example, let's move over to the left. It's a little clearer. We're trading outside the 4 standard deviation. Then we traded inside the 3, and we confirmed that with a further price move down. So that was a sell signal. Once we get the sell signal, we look for the market and then move to the opposite band, which it did there, and that completed a successful signal. Gave us a buy signal. That one lasted for quite a while. Even though the market was going up for months on end, it never did get back to the +4 sigma band. It did, though, recently do that, and so we have our most recent signal from this indicator that's in green because it indicates that signal is still open. We got outside the 4 standard deviation band, and then back inside it. So right in here, we are above the 4 standard deviation, and it went back inside. And so that's a sell signal. The target, of course, is down here at the -4 standard deviation band, which is right now at about 55.60, but that you can see that band is rising as implied as historical volatility has dropped. Bands can constrict towards the middle, towards the average. But anyway, that is a sell signal. We do this calculation often, and if you look at the Option Strategist newsletter, which is our oldest publication, that we published that for the entire 35 years the company's been in business, you'll see that this has a long-term, very positive track record. So we had a buy signal there coming out of the April lows. It was pretty short-lived, but we did make some money on it. Now this one has just arisen. The concept of drawing these bands applies to any chart. It doesn't have to be the S&P chart. It could be IBM or Google or anything else. And so we offer a service where you can look at the bands on TradingView on any entity that you want, stocks, futures, ETFs, etc. This is the chart on S&P that shows up on TradingView. And when you get a signal, this red arrow appears. It doesn't have a circle around it. I put that there. And when you get a buy signal, the green arrow appears. So what I like to do is, and every day we give you a list of ones that are approaching a new signal. And so you can, you don't have to sort through 3,000 stocks to find something, but condense that list down to a very small number. But I like to look at ones that have had some decent success, and then that's the ones they'll try to concentrate on. Obviously, this is the S&P, and it's done fairly well. So that red arrow on the upper right there, that's the most recent sell signal I was just talking about. All right, so let's move on to put call ratios. Put call ratios as an indicator were invented by Marty Zweig back in the 1950s when he used to get the volume of options out of the ads that ran in Barron's, the ads run by the broker dealers back in those days. Today we're dealing with a lot more options, and we use the equity only put call ratio, that's all stock options that trade, to predict the broad market. But it's a contrary indicators. Marty was, I think, probably a little surprised to find out that when there's a lot of call buying, pretty soon the market went down. And when there's a lot of put buying, pretty soon the market went up. It's a similar thing actually happened. I don't know if you ever look at that investment advisors summary newsletter, but when that was first started, probably about 70 years ago, the person who started it thought that he would see what the advisors were doing and then you follow along with them. It turned out you want to do the opposite of what the advisors were saying. In any case, this is a contrary indicator. So the trick is determining what is too much buying, what too much selling. Let's just say IBM at the end of the day, we sum up the volume of puts that traded separately, we sum up the volume of calls that traded, divide the put volume by the call volume, that's the put call ratio. So since puts are in the numerator of that fraction, if you have heavy put buying, the ratio is going to go higher. But when are you likely to have heavy put buying? Well, that's when the stock is going lower. So the stock price and the put call ratio move opposite to each other. We keep a moving average. I use 21 just in case there's something to Fibonacci, but you need to use some moving average because it's a noisy data series and it needs to be smoothed out a little bit. So typically this is the theory, and on our website we publish over 1,600 put call ratio charts every day. Again, that's in that area where we sell the data. It's pretty cheap, but when the stock is moving down like this, the put call ratio is moving higher. Remember, they move opposite. Well, people are buying puts as the stock is moving down, but eventually you get to here where you create a local maximum in call ratio, and once you get the local maximum, then that's a buy signal for the stock. So local maximum in the put call ratio is a buy signal for the stock. And then as the stock starts to move higher, move over to the left side of the chart. As the stock starts to move higher, people are buying calls. That forces the put call ratio lower, and eventually you get to a local minimum. And when you get to a local minimum in the put call ratio, that is a sell signal for the stock. So all of our put call ratio charts also show the stock chart so that you can see how it's, if this symmetry exists or it doesn't. If it doesn't exist, which can happen in like arbitrage cases, dividend arbitrage especially, things like that, then I would not bother with that particular chart. In any case, on top is the S&P 500. This is not a current chart. And on the bottom is the equity only put call ratio. That's all stock options that trade. And you can see the inverse symmetry that exists here most of the time. So that's why we use the equity only put call ratio on all stock options that trade to predict the broad market. So enough theory. Here's the actual chart. Most recently, the last signal that we actually had was this local maximum right here in mid-April. That was a buy signal. That's certainly done quite well. We're still on this buy signal. This signal will exist until this ratio eventually somehow rolls over and begins to go higher. That would be a sell signal. So you can see there was a sell signal back in February, and the red letters on this chart are where we traded the index and it traded the ratio, and it has a good track record. As so that's just using the simple volume of stock options. But as computers came along, we could do a little more than that, and so we could use the dollar volume. So the way we do it is at the end of the day, I take the option's closing price and multiply it by the volume of the option that traded that day to get the dollar volume. Now, you could do it tick by tick. That's expensive and time consuming, and this seems to work just as well. So you make that calculation for every option. You sum it up for all the puts. Separately, you sum them up for all the calls, divide the two, and that's your dollar weighted or weighted put call ratio. And now you're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. And this gives us signals appear at about the same point in time. It's just that they a little more extreme. So here you can see that the put call ratio last February or April was quite high. February is quite low. So we had the sell signal in February, followed by the buy signal in April. Now this one has started to move sideways. That's not a sell signal yet, but it sort of puts the system on alert. And we use a computer analysis, sort of a chess playing tree analysis. It knows what's coming off from 21 days ago. It knows what's coming on in recent days. It can make a prediction as to whether that's going to turn or not. So I checked it this morning. The computer is still saying it's not turning yet. So this remains on a buy signal as well. Although the fact that you're getting down to the bottom of these charts means that the market's getting a little overbought. But again, overbought does not mean sell. So right, just sort of repeating what I said. So we got buy signals about a month ago. They've worked out very well, but we don't have sell signals from this indicator yet. What do we trade when we get these signals, like the McMillan volatility band signal or the put call ratio signals? So we trade SPY options to trade the S&P in general, and we trade normally slightly in the money options. In other words, I want the delta of, let's say in bullish, I want the delta of my call to be larger than 0.5. The delta of a call option ranges between 0 and 1. You don't have to go all the way for 1. That's overkill. But you buy calls a couple strikes in the money, and then that guarantees me that if I'm right about the direction of the index, S&P index, then my calls are going to make money too. Yes, I'm going to lose a little time decay, but I also have a nice strong delta that'll help me out if the market's moving in my favor. So sometimes if we're doing a little bit longer trade, I'll do an at the money option, but that still has a delta of 0.55 or so. Now on TV, when they trade, they often spread. And in real life, people don't spread all that much. Market makers, etc. By spread, I mean this. Let's say you're bullish on this stock, so you buy a call at this strike. And but then to create a bull spread, you sell a call at this strike. And so what that has the effect of doing, your first call makes money up to here, and then the fact that you sold a second call cuts your profit potential off. Now, this does make sense when options are expensive. So again, on our website, we have a lot of data about realized volatility versus applied volatility. That data is free. We update it once a week in the free section of our website. And right now, for example, the broad stock market is expensive. VIX is pretty high, so up in the 20s or near 20. So we have been using bull and bear spreads on the recent SPY recommendations, but we don't do it all the time, certainly not in individual stocks unless volatility is high. The proponents of using the spread will say you're risking less, but you're not. You're risking exactly 100% of what your broker requires you to put up to do the trade. So if you're going to buy a call, you have to pay for it in full. If you're going to do a bull spread, you got to put up the debit of the spread in full. So you're risking 100%. So that's a false statement that you're risking less. Yes, you're risking fewer dollars, but that's easily compensated by, let's say, instead of buying 5 bull spreads, you buy 4 calls. So what happens is your bull spread is this profit graph, but your call profit is this one, and it has unlimited profit potential. So by doing the spread, you give that away. And I know the previous speaker talked about having some pretty big winning trades occasionally. We do the same. I think any good trader does. You take limited losses and you try to let your profits run. Well, you can only let your profits run if your strategy you're in has ability to let the profits run. But what if you do spread? Is there something you can do to help mitigate the negative aspects of spreading? yes, there are two things you can do. First, you can widen the difference in the two strikes. So right now, when we're recommending bullish strategies using SPY, we're spreading the calls 20 to 25 points apart, the two strikes in the bull spread. If we're doing puts, though, we're like 40 to 50 points apart because out of the money puts are more expensive than out of the money calls are. Secondly, you can roll if the short strike is hit. So what do I mean by that? Well, let's say SPY is 590 and you want to put on a July spread and you're going to spread it 20 points wide. So you buy July 590 call, you sell a July 610 call. So you do that on Monday morning. Suppose you're fortunate enough now, SPY trades up to 610 sometime before July. So you sell the spread you own. So you take a profit on that first spread and you buy a new spread. And now the new spread is both sides are 20 points higher. Basically what's happened, the spread you had on is you've now reached the point where it's really limiting your profit potential. Yes, there's a little bit left, but not much. So take that one off and put on a new one, which has now more upside profit potential up to a price of 630. When options are expensive like they are now, though, sometimes especially on the call side, when interest rates are non-zero as they are now, you don't really have all that much profit potential. That 590 call is selling for 15, and the 610 call is selling for 5. So we're buying this at 15, and we're selling the 5, so that's 10. We're buying 10, and the most we can make is on that spread. So that's okay. That's double your money kind of thing, but that's not great. For example, here's a put. Now, I said in puts, we're recommending 40 to 50 points lower on the put spread. So let's say you're bearish, you buy the 590 put, you sell the 540 put. And these are the prices. You can see how expensive these deep out of the money puts are in spot. Now here you're paying 10 again, 14 minus 4, but now you got a chance to make 50. That's much better. And in this particular case, you would, if SPY got down to 540, then you would sell that spread and buy a new one with lower strikes. So you would roll it down. So that's how to mitigate the negative aspects of spreading, bull spreading. Let me show you just a couple of put call charts. I always like to do this on individual stocks and futures. With individual stocks, we only trade the extreme maximum minima. We don't trade the ones in the middle. So here, for example, there's trade there, or something here, something here. We're not trading all those little ones in the middle, just the outside ones. So this is APH, and it's had a good track record. You can see that this local minimum down here in December was a great sell signal, or pretty good sell signal. Stock went down. Then you had a buy signal here in late April, and that's been a great one. It's still going higher. But now the put call ratio is beginning to roll over again. And the question is this a sell signal yet? Even if it were, if I'm still long these calls, I'm using a trailing stop on these calls here. I was not a bull spread here. There was not high implied volatility here. We're just long the calls. So I would still just use a trailing stop. So this might be leading to a sell signal, but it has not been confirmed yet. Here's another one, Uber. Uber's given a number of sell signals in the last year, kind of mixed results, and but a new one has just set up. So if you have, let's say, another reason you're sort of negative on Uber, this might confirm your opinion to buy some puts. This is Robert Half. As you can see, this put call ratio on Robert Half really took off here, and in the last decline. 700 means that $700 are being spent on puts for every $100 being spent on calls. That's really pessimism personified. So that's a buy signal when that thing rolled over. However, the stock hasn't really responded. So a lot of times what we'll do is we'll look for the stock to break it over resistance. In this case, has been resisting 48. If it could break out over 48, I would buy the stock based on this signal, but not until then. So sometimes you can combine technical analysis with the put call ratio chart. I guess we already did. Oh, I'm sorry, went the wrong way. Sorry. Okay. another one that has been, I'm using this to illustrate futures. So here, the bottom line, the blue line, is created the put-call ratio by looking at the 10-year note futures options that trade on the Chicago Board of Trade. But there's an ETF, IEF is its name, that trades over on the stocks of things that simulates the movement in 10-year note futures. So you don't have to necessarily have a futures account and go over and buy puts on the Chicago Board of Trade. You could just buy puts on IEF through your regular stock brokerage account. But that doesn't work all the time. Yeah, here we're just getting a new signal in soybean oil futures. Now, soybean oil futures have a high leverage. They're $600 a point. So the chart up on top there doesn't look like it's moving that far, but in dollar terms, those are pretty big moves. $10,000, $12,000 moves. So, but here, this put call ratio chart at the bottom is drawn using the soybean oil futures options that trade on the Board of Trade. And so that we get the maximum, minimum. You can see those have been pretty good, really, like 8 decent signals there in the last year. We're getting a new sell signal now. But if you want to trade this sell signal, you're going to have to trade futures options. There is no stock side of the ledger ETF that simulates soybean oil futures. So, that's a big problem. And if you're trading, let's say, at Interactive Brokers, they let you trade both futures and options in the same account. Many other firms do not. So you'd have to open a futures account. So let's move on to the next topic, market breadth. You can do two things with it. One is just keep a running total of advances minus declines. And the other, you can keep a cumulative total of well, that is the running total, sorry. And the other thing you can do is calculate an oscillator. And so we do both. The oscillator we rely on for signals, and this is the value of the oscillator going back to 2019. Now it says up here at the top, stocks only. The reason for that is there's two data sets. So one is advances and declines. We just use New York Stock Exchange advances minus declines. And that works pretty well, but there's a lot of things on the New York Stock Exchange that are not stocks. There's ETFs, interest rate related things, preferred stocks, all that kind of stuff. So for stocks only, we use just optionable stocks. There's over 6,000 of those now. So that gives us a good, robust data set. Then we keep this oscillator. And when it gets oversold, it shows here in green. The most oversold times in history were, well, that was right before we're going back. Okay, this one was right before Christmas 2018. This was the pandemic, and this was a sell-off at the end of the bear market. And you can see when the bear market was going on, that was actually the beginning of the bear market. When the bear market is going on, there's a lot more oversold conditions than there are the rest of the time. Most recently, we got quite oversold in that April sell-off. Didn't quite get down to the extremes of those previous ones, but got pretty close. But remember, oversold does not mean buy. So we wait for it to quit being oversold before we buy, and that happened on April 22nd. So we were long on April 22nd, and from there we moved into a very overbought condition. Again, overbought does not mean sell, but finally we did move out of this overbought condition just this past week, and we got a sell signal, or actually week before, got a sell signal on May 22nd. So this indicator has just gone bearish a week ago. So it has a good track record, but there are whipsaws because this thing can flick back and forth. Breadth can move, quite heavily, in a matter of a day or two. But right now, this is bearish. This has given us a new sell signal, recent sell signal. We are trading positions based on that. There's another thing we follow, which is cumulative volume breadth, and this is, in other words, the volume on advancing stocks minus the volume on declining stocks every day, keep a cumulative total. This turns out to be pretty good for two things. First of all, if this makes a new all-time high before S&P does, then you should buy S&P because typically S&P follows along. And that's significant right now because recently this did make a new all-time high, not only in terms of the stocks only data, the optional stocks, but in terms of New York Stock Exchange advances and declines as well. Now, I consider this to be a longer term indicator. There's no time frame on this, but this is saying S&P will not move to a new high. And I'm not talking about 2 years, but a few months. At the top of bear markets, you sometimes get a negative divergence, but not every bear market has a negative divergence. That was the case at the beginning of the bear market in 2022, but we really haven't seen any negative divergence since. So this is, a longer term indicator that is bullish. This is the chart of it. You can see here, this is current. You can see that it moved to a new all-time high right here. It's a little bit higher than it was back there. Meanwhile, S&P is not. We've got this downtrend line that we looked at earlier. This is the February high right there in S&P. So this indicator is saying S&P will go to a new all-time high. I think if that happens, we're really off to the races on the upside because there's a lot of pent-up buying power trying to figure out what's going on with tariffs and what have you. Another indicator we keep an eye on is new highs versus new lows. This is neutral right now. It gave a sell signal in March, which was then later stopped out at the end of April. Excuse me. That was a profitable signal, but we haven't had a signal since then. So this one's just on the sidelines. So let's talk about VIX and volatility for a minute. So there's a couple of things on the VIX chart that are important. One is the trend of VIX. VIX should be trending opposite to the market direction. And also spike peaks in the VIX chart are buy signals. So here's the current VIX chart going back a year. It had the two monster spike peaks, one last August, and then of course the one here in April. So those are both great buy signals, but all these other red on here are buy signals. We have a trading system that we built around this, and so the blue ones are losing because our system has stop outs as well. So most recently, last week, I think it was the week, May 23rd, the market dropped on the open, news of tariffs, of course, and VIX spiked up about 25 and right back down again. So that gave us a buy signal from the VIX spike peak buy indicator as of May 23rd. And that will now be in effect for 22 trading days. That's the optimal holding period, unless VIX makes a new high over that peak of May 23rd, and that would stop us out. What about the trend of VIX? Well, right now there is no trend of VIX. It's just kind of hanging around, not really trending. But if it closes back above its 200-day moving average for 2 days, that would give us a sell signal. That's a possibility. I mean, right now VIX is around 19, and that 200-day moving average is around 20. So what we've done, what we're saying in our newsletters is, if it closes above 21 for 2 consecutive days, that's a dangerous, serious warning, and we would take some negative position based on that. Now, you can't trade VIX, but you can trade the VIX futures. And so there's a couple of things that are important about VIX futures. So if we price out the VIX futures out in time, and we look at the relationship, that's the term structure of the VIX futures. And in a bullish market, the term structure slopes upwards. Occasionally, though, this happens. It slopes downwards, and that's a really nasty bear market. This happened in early April. The prior time that it happened with over any extended period of time was all the way back in March of 2020 in the pandemic crisis. So it doesn't do this too often, but when it does and when it's beginning to do that, those are warning signs that you need to heed the market. So it began to invert like this in very early April. And that again was a very negative warning sign for stocks. So where are we right now? Well, this is the closing prices from last night, Friday night. VIX closed at 1857. These are the VIX futures. you can see that each future is pretty much higher than the previous one, at least till here. These are kind of all the same. So the term structure is sloping upwards modestly. They're trading at a premium to VIX. I would take the futures price, subtract off the VIX price, and you get the premium. So a positive premium is bullish for the stock market. You can see these are all trading at a positive premium, so that's good. So this is mildly positive. In a really bullish situation, the slope of the term structure here is much steeper to the upside. Now, you can look at the price of VIX futures and delayed prices on the CBOE futures website, but the CBOE also publishes 6 volatility indices, and you can use those as sort of a poor man's futures contract. So there's the one-day index. That's sort of in a world of its own for trading the 0-day expiration options. But then there's a 99-day index. VIX is a 30-day index. And there's a 3-month, 6-month, and 1 year. These, again, are the current prices. You can see that these are sloping steadily upwards, more than the futures. And so this is a nice bullish pattern right there. And so the term structures are relatively bullish here. You know, I would say mildly bullish, relatively bullish, however you want to say it. The thing to keep an eye on is really the 2 front month futures. June closed Friday at 20.07 and July at 21.06. June is the front month. And so that's okay. July's trading higher than June. If June suddenly trades above July, then the problems begin. And that's when things can get really nasty. And as I said before, the inversion in the term structure that we saw in April of this year was the biggest one we've seen since March of 2020. Yeah, occasionally you get little ones like last August when VIX went shooting up there for 1 day or 2 days. But that was a big one. Two of the things I recently wrote an article about this. This is the difference between implied volatility, which is VIX, and historic volatility, the 20-day historic volatility S&P 500 index. You see, most of the time they're relatively close to each other, and it's just all this noisy pattern, means nothing. But occasionally you get these things like this where implied volatility is much lower than actual volatility. That's a rare case, and we examined all of these in the article, and most of them were good buy signals, not the one in 08, but the others were. And so recently, this fell all the way to minus 26, and then went back up into this area. So now it's back up in here again. And that gave us another what I would consider a longer-term buy signal as of May 8th. So we've got 2 of these long-term buy signals. One was cumulative volume breadth, and now this one. And so just one other long-term thing. A 90% day is when advances are 9 times declines, or declines are 9 times advances. You don't have those too often, but we have had a few recently. In fact, we've had 4 in the last 50 days. So that's that red dot there. You can see that when things get bad for the market, the frequency of these 90% days increases. And pandemic, 2022 market. So this, in my opinion, is beginning to trend higher like this. If we go to 5 and even 6 or what have you, that's going to be bad. But it is the last 50 trading days, and a couple of these occurred in early April. We're going to be dropping those off from a 50-day count pretty soon. So I'm not really relying. We don't have a trading system built on this or anything. This is just more for for your information kind of thing. So put this all together, where do we stand? Well, we really only have 2 sell signals. That's the McMillan volatility band indicator and breadth. So those are bearish. On the bullish side, we've just got this VIX spike buy signal. We have these 2 long-term ones that I talked about. The equity only put-call ratios, those are still on the bullish side. I don't have the SPX chart all the way over to max bullish. It's sort of bullish as long as it's holding above 5,700. But as I said, there is a downtrend there. And so the jury's a little bit out on that, but it's more bullish than bearish. And then as we just looked at the volatility derivatives, the construct, the term structure, again, mildly bullish, relatively bullish. Meanwhile, these two indicators are not giving a signal at all right now, new highs versus new lows or trend to VIX. They're neutral. So not all bullish, but somewhat bullish. So we trade these individual indicators as they come up, and each one has a trading system, and each system has its own stops. So it's possible to be long, short, and still make money on both. But we're not holding a core position right now because the S&P chart is still in that triangle. You know, as I said, more buy signals than sell signals, but we're in all of these. And what we do is when an option gets deeply in the money, for SPY that's 8, or sometimes for stocks 10 points, then we roll the option. So whether it's a spread or an option, we roll the whole thing. And that gives us, we take out the market. We still have exposure to, you know, the market, but we've reduced our risk. So that helps a lot, you know, in the entire spectrum of trading. I mentioned that we're offering a special. So at this URL, optionstrategist.com/traders corner, you can take a 1-month subscription to all 3 of our top newsletters for $99. Not $90 each, just $99 for the whole thing. Also, you will be getting the PDFs of this seminar. I say PDFs because one is in color and the other is in grayscale in case you want to print it out. You know, spend a fortune in color ink. So our top 3 newsletters are daily volume alerts, which I write every morning. That has all of these signals that we've talked about here today are in that newsletter. Then the daily strategist comes out twice a day, and that basically has everything we do, just everything. You know, straddle buys, naked puts, everything. Then the option strategist comes out once a week. That has articles, educational articles. I mentioned we wrote an article about that differential between implied and historic volatility, that sort of thing. You can take these consecutively, so you have some time to study them. You don't have to take them all at once and get crammed in there, but it's a free, it's on 1 month of each for a total of $99. As this chart needs update, we're our 35th year publication there. And there's a track record of the option strategists on the website, and as well as these 2. Obviously, past performance, no guarantee of future results, but I do have a lot of faith in these trading systems. They work pretty well for a long period of time. Our new website is up and running. I invite you to just go over there, wander around, see what you can find. As I mentioned, there's some free volatility data, and there's also a very low priced subscription just to get data of all kinds. We have a couple of other newsletters too. One is a conservative put writing newsletter. That's those ones where you see 90% winners. What do you do with the 10% losers is what the real question is. If you're writing out of the money puts, yes, you can get 90% winners, but what happens with the losers? We have another newsletter, special situations. We have I update a market comment on YouTube every Monday, so I invite you to subscribe to that. And so that's pretty much the whole thing. If you're interested in our money management, you can go to this URL. Our minimum account size is 100,000 for the money management. So I think we're just about right on time. I don't know if there are any questions.
There was one question. Someone would like to know, do you send alerts for the SPY and top technology stocks?
Yes. So our recommendations are in the daily letters. The letter comes out either in the morning or, in the case of the daily strategist, comes out twice a day. So the recommendations are in there. There's not a separate alert, but it's when it comes out in the morning. You know, that's where the recommendation is.
Okay. And that was it. I guess they were a little concerned about their account size as well. Is there
Right.
like a
So,
minimum?
I mean, well, basically, so there are, you know, many micro futures, so you could use those instead of SPY options if you wanted. And there are, yeah, I mean, if we're recommending 3, you could buy 1, but I mean that cuts down on your ability to take partial profits and do those sort of things. But there are other ETFs that simulate SPY without at a lower price. Same for the Qs.
That's great advice. And one more question. Do you have an overall preference for options on indices over individual stocks?
Well, so many of our indicators here are on the broad market, but I tell you, the ones that we seem to make the best money on are individual stocks, but that's because we're not spreading there. We're just long options, and then just try to ride it as far as we can, especially futures options if they come along, like the soybean oil, for example, that sort of thing. But I don't have a preference. I'll trade all the signals as they come up. I'm just telling you what's happened in the past as far as the bigger profits being in the individual names.
That's it for the questions. Thank you, Larry.
Okay.
Thank you
Glad to
so
be
much.
there. All right. We'll see you.
Everyone, please take advantage of asking our panelists some questions, because they're so intelligent and they're battle tested and proven. So thanks to Larry. Always great to hear Larry's data-driven perspective on markets and traders. Don't forget Larry's special offer, which is available via the link in the chat. Now let's shift gears with Chris Sayre from BigTrends.com. His session, how to trade options on the Nasdaq ETF QQQ with the %R and ATR indicators. Chris will show you how to spot short-term trades using precise setups, leverage weekly options, and scale your QQQ strategy with confidence. So let's welcome Chris.
Anthony, how are you?
Hey, I'm good. How are you?
Doing well, thanks. Doing well. Thanks for
Good.
having us. We really appreciate the opportunity to be back with you and your group again.
We love having you.
Very kind
And
of you.
you got such a good radio voice too.
Oh, you're so kind. Very kind. Maybe because
Yeah.
I got my workout in this morning, I'm energized to be here.
There you go.
So,
All right, it's all
thank you.
yours. Yeah.
All right.
You're welcome.
Well, good afternoon, I guess. It's 12:47 p.m. Eastern time. I am based in Lexington, Kentucky. As you can see, and as Anthony told you, my name is Chris Sayre. I'm the lead consultant at Big Trends. A little bit more about me and Big Trends here in a few minutes. But as Anthony said, we're going to talk about QQQ. And if you're not trading the Qs as they are known, it's one of the most highly traded securities day in and day out when the markets are open. It tracks the Nasdaq 100 index. Anybody out there trading the Qs or maybe even owning them as an investment? Always curious to know that. But we're going to talk about the new playbook for QQQ options traders targeting doubles in days. So if you stay with me, I've got to read the disclaimer to you to keep everybody happy. The information provided in this presentation is based on our proprietary research and is intended for illustrative purposes only and are not to be construed as specific advisory recommendations. Stocks and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. See our terms of use on the BigTrends.com homepage for more information. So let me get to the next slide, and then we're going to start talking about the system. So again, as Anthony and I told you, Chris Sayre, you can see I've been in and around the financial services industry for quite a while. I'm 56 years old. I've been trading and investing since I was 18. When I was in college doing trades from pay phones, if you remember those things where you had to put money into a phone and call the broker. And my very first options trade was on Fruit of the Loom, if you remember that, and made some money, and I was hooked ever since. So Big Trends, if you're not familiar with Big Trends has been around for more than 25 years. Price Headley is our founder and CEO, and Price started Big Trends in November of 1999. I was actually one of Price's earliest clients. So Price and I have known each other for several decades. And as you can see, I've been with Price and his team since September of 2011. So over 13 years on the front lines, interacting with traders and investors just like yourself. So I love doing this. All right. I love getting to know how you all trade. We're not saying that we have the end all be all absolute perfect system in the world. What we do is the research for traders, right? Because so many of you are so busy in your daily lives, whether you're still working a full-time job, maybe you're retired and you're out on the golf course, the pickleball course, or maybe you're taking care of a loved one or chasing grandkids. You love the markets, but you just don't have time to do the research. That's why you would subscribe to our newsletter. Now you can see our contact information at the bottom of some of the slides while I go through the presentation today. Nobody's in the office today. You can email clientcare@bigtrends.com if you want. We do spot check that email over the weekend. But if you have any questions next week, please reach out to us. We're open 9 a.m. till 5:30 p.m. Eastern time. So enough about big trends, enough about me. Let's talk about you guys. You're sharing your Saturday with us, so let's talk about it. So here at Big Trends, we call our trading systems alert services. And the one that we're talking about today, as you can see there in the yellow, is QQQ Options Playbook. That's the name of the newsletter. That's the name of the subscription, trading system, whatever you'd like to call it. All right, QQQ Options Playbook. So let's talk about some of these bullet points. We're going to talk about how we boosted results with less work. As I was just saying, we're all busy, right? When I encounter traders just like yourself, everybody thinks I'm trading all day long. Price does not pay me to trade all day long. I can trade, but he doesn't pay me to do that. He pays me to do these webinars. He pays me to do individual coaching and packages and things like that with individual traders. So we're always trying to look for less work, right? Be efficient. And as I said, we've been around for over 25 years. Now, given my experience assisting people throughout the decades, I have found that most people are visual learners. So you're going to see success stories and chart examples, and so you can see what these trades look like. And as I said, the name of the trading system is called QQQ Options Playbook. I'm going to reveal some information about that trading strategy to you today. Not going to give you all the bells and whistles, right? We want you to subscribe. We want you to become a part of the Big Trends family. And when you do that, one of the resources that you get access to is called the Settings and Rules Sheet. The Settings and Rules Sheet. It is a 2-page PDF that line items every criterion that Price and our team of analysts look for when they're finding these trades. And of course, just like Larry right before me, and I'm sure others today, we do have a special offer for you today for the Traders Corner crowd. So stay with me. Let's talk about the strategy guidelines of the QQQ Options Playbook. Average holding period, very popular question that we get. Check this out. 2 days or less, but no day trades. The day trading thing is a concern for most traders for whatever reason. Maybe they're day trading other securities on their own. Our alerts will not get you a day trade. All right. More about how that happens. Now, one of the things that has happened over my decades of experience is when I first started trading those fruit of the loom options back in college, all we had back then were monthly options. And if you're newer to options back then, and still do, the monthlies expire the 3rd Friday of every month. And then weeklies came into play. And now several securities have options that expire every day. One of those securities that has those daily options are the Qs, QQQ. What type of strategy? So check this out. 3 different %R signals analyzed on a daily chart. So some information here for you. Every chart you see today will be a daily chart, right? Got that there for you. Now, %R. I personally use the Thinkorswim platform, but please hear me when I say this. You do not have to use the Thinkorswim platform to be a subscriber to our QQQ Options Playbook, all right? As long as you can place call trades or put trades, then you can subscribe. But %R, otherwise known as percent range, was created by Larry Williams. When Larry first created the indicator, he used a negative scale, negative 100 to 0. %R takes that and flips it from 0 to 100. Now we have tweaked the %R indicator to our proprietary setting. And again, you would get access to that when you subscribe today. So what options do we trade? Well, I gave this away a little bit. We're only trading calls and puts. So you don't have to worry about having spread approval. You don't need to worry about any debit spreads, credit spreads, diagonals, butterflies, any of that stuff. Now, 3 DTE expiration, what does that mean? Again, if you're newer to options, and as I shared with you just a few minutes ago, these options are expiring every day, every trading day. So the options that we buy when we issue an alert expire in 3 days. So if you see that, and then you go up there to the average holding period, this means we're only in these trades 2 trading days at the most. More about that here in a few minutes. So as I said, we start with a daily chart. New trades can trigger once per day, Monday through Friday. We do not take Friday afternoons off. If we get a signal on Friday afternoon, we will issue it and hold it over the weekend. As you can see there, these signals are entered at 3:40 p.m. Eastern time, 3:40 p.m. Eastern time. So you only have to be alert that time each trading day. Now, that doesn't mean there's going to be a trade every day. It's just, that's when the signals will be coming if there is one issued. This defined scanning session eliminates noise and allows us to use the power of those 3 DT options. You see that we have eliminates noise there in red. As I've told you a few times now, I'm in my mid-50s. Been doing this for a long time. One of the things that has changed over the decades, showing my age here, is the amount of information that's in our face. Whether it's the multiple business channels, all the social media channels, all of that stuff. And everybody's trying to tell us what to think and how to behave and all that stuff. And in my opinion, the vast majority of it's trying to scare the crap out of us and tell us why the world's going to blow up and end, right? We are very systematic here at Big Trends. We scan, we use technical analysis to eliminate that noise. We try to keep the subjectivity to a minimum. Now, scanning for signals every day has resulted in high trade frequency. That's something I hear being on the front lines here at Big Trends. Traders want some action and large profit potential. People are looking for big results. So how to get the most bang for your buck while managing your risk? Let me share some of the details with you. So these 3 DT options allow us to get lots of leverage for a small investment. What do I mean by that? Well, the average contract price has been $4.10 over the trailing 12 months. Again, if you're newer to options, there's 100 shares represented in each options contract. So you just simply multiply that 410 by 100. That means the average recommendation over the past year has been $410. All right. So you don't need a large account to subscribe to the newsletter. However, and we'll talk about that more here in a few minutes, the Qs are so heavily traded and so liquid, if your account allows, you can trade a whole lot more than $400 a contract. Now, as I said earlier, these trades are exited after 2 days at 3:40 p.m. Eastern time. And I want to point this out. If they've not been closed before then, this avoids being affected by the final day of volatility. So a couple things there in those 2 sentences. One, if they've not been closed before then, what does that mean? We start out every trade with a 50% stop loss and a 100% profit target. So we're risking 1 to make 2, right? Now, not every trade's going to be a 50% loss. Not every trade's going to be a 100% win. It's not one or the other. We're not dealing in absolutes. Our research has said if neither of those targets have been hit during the first 2 days of that trade, shut it down. Even if it's a minus 15% loss or a plus 15% win, close it down. Do not hold that trade, as the last sentence shows, on the last day of expiration. Because if you haven't traded what are known as 0 DTEs, that means you are buying that contract that day and trading that day's action, you can get some whipsaw effects if you're not careful. So we look for a specific setup. Like I said, we're technicians here, right? We're using technical analysis. Now, our team has determined that each trading day will fall into one of 8 categories. All right, one of 8. 3 of those categories are tradable patterns. So 3 out of 8 is 37.5%. How do I know that? Well, I've done this presentation a few times, but if you remember my intro slide, I used to be a stockbroker, and back in the early 90s, stocks traded in eighths. Now we trade in pennies, right? But back then you traded in eighths, so I know the percentages on eighths. So 3/8 is 37.5%. So that means most days there's not going to be a tradable pattern, and that's okay. We look for the percent R, again, that stands for percent range, to be within certain windows. And then we confirm those setups with candlestick patterns. Now, we use the historical profit factor to determine which days were the best for long trades via calls, short trade via puts, or neither. As I just said, the vast majority of days are not going to be tradable patterns. But when we do find those, based off our testing, the historical profit factor of using this system on the Qs has a positive edge over time. So why should you care about this strategy? Well, let's talk about that edge over time. So the strategy was started in January of 2023. Now on this slide, I want you to see that over here on the left, starting with a $25,000 model portfolio. Jump over to the right. If you'd allocated up to $5,000 to every trade that was issued by the QQQ options playbook, all wins, all losses, total them up, no compounding, you'd be up $88,740. $88,740. As you can see back over here on the left, that's a 354.96% return. 354%. Now, past performance doesn't guarantee future results. Future results are going to vary. But let's break it down on a smaller scale. Let's say a $5,000 model portfolio, still starting at the inception in January of 2023, this time only allocating $1,000 per trade, right? $16,073, still up over 300%, 321.46%. Now, all of these results are before commissions and any subscription investment. Now, if you're paying more than $1 a contract to trade options, get online or get on the phone and contact the broker and find out what it's going to take for you to get a lower commission rate. It's a highly competitive industry and they're looking for business. You may think that you don't have a large enough account to warrant a smaller commission rate, but if you're an active trader, they would rather have you as an active trader than someone, let's say, with a $5 million account that has it just sitting in a money market account. They want action. These brokers want action, all right? So that's a tip for you. Now, as we have to say, past performance doesn't guarantee future results. Future results are going to vary. But remember, not all trades have to be 1,000. Not all trades have to be 5,000. As I shared earlier, the average recommendation over the past 12 months has been $4.10 a contract. Now, let's review a winning trade from this past week. Then I'll explain more about how our QQQ options playbook works. Some things I want to point out. Remember earlier, we're talking about candlestick patterns. That's why you see the candlesticks there. Each candlestick represents 1 day of trading action. 1 day of trading action. Now, all trades today on these charts are going to be based on allocating up to, but no more than $1,000 a trade. And then the indicator that you see down here at the bottom is percent R. And remember, that stands for percent range. And you see these multiple windows here, right? And that's what our team uses in conjunction with price action pattern. So this trade was issued on a Friday afternoon, a week ago, on the 23rd. And as I told you earlier, our team does not take Friday afternoons off. We don't worry about holding things over the weekend. Amongst all the tariff craziness, we follow the history of the trading system. We enter that trade on Friday afternoon, as you can see there, walk in on Monday to the gap up situation, and it ran for us all the way to our 100% profit target. Remember, all trades target 100% with a 50% stop. But as I said earlier, it's not absolute. It's not all or 50 or all or 100. We do have that 2-day time stop. More about that in a few minutes. Now this trade, let me take that ink off there. This trade generated $553. Why only $553? Well, if you look at the contract price, it was $553. So under this $1,000 scenario, you could only do one contract, right? And so one contract at 100% is $553. Now you see the percent R down here is in this upper window. Now you notice that on that Friday morning, it had gapped down from Thursday's action and rallied back. One of the tradable patterns that we like to see. We were not fearful with this movement down over 3 days and the gap down on this fourth day. We like that gap down on the fourth day and the rally back. To us, that showed strength, and it was confirmed by the percent R indicator down there in that upper window. Now, as I've told you, not all trades will hit 100%. And as I told you, we also have the time stop. So remember, if a trade doesn't hit the 50% stop, or the 100% profit target within 2 trading days, we will shut it down at 3:40 p.m. 2 days later. So we get into this trade. This was a Friday as well, if I believe, October 25th. Again, we have a gap up situation. It had been rolling over for a few days. We got this gap up. We got another gap up. And we like that action. And again, you see the percent R in this upper window. So we enter the trade, carry it over the weekend, and we had to close it down 2 trading days later. We still made 48.29% or $338 on that trade. Again, this is a time stop trade. So many people, when I do these presentations, think that we deal in absolutes, that the trade's either going to be a 50% loss or 100% win, and that's just not the case. Not all trades will hit either one of those targets. Now listen, we're trading a single ticker. We've talked about that since the beginning. We're only trading the Qs, QQQ. Remember, it tracks the Nasdaq 100. It's one of the most highly traded securities out there. Frequency has not been an issue. As I told you earlier, being on the front lines here at Big Trends, traders love action. So as I mentioned earlier, we start off targeting 100% for each trade, which was achieved with these next 2 trades. Get into this trade here. Now you'll see this is a red candle. Not all red candles are bearish. Not all green candles are bullish. And you'll notice percent R is in this lower window. So with this type of tradable pattern, candlestick pattern, and the percent R being in the lower window, we like that trade. Very next day, it hits our profit target of 100%, 100.75. That trade generated $808. Then the next day after that, look at this. We get this gap up situation. It continues to rally. We enter on that trade, 409. It doubles for us, going to 100.49% as it continued to work higher. And look at this trade, the second trade we entered. The percent R is in the upper window. Again, you hire us for our team to do the research and follow the trading patterns, looking for those 3 tradable patterns. Here's 2 of them right here for you. That trade generated $822, so $1,630 in 2 trades. Now, as we have to say, past performance is no guarantee of future results. Future results are going to vary. And as you've heard me talk about, there's going to be losing trades. Let's talk about a losing trade. We get into this trade, we get the pattern that we like. We have this inside candle here, right? The high and the low of the candle that we enter is inside the high and the low of the previous candle. We've got percent R in the upper part of the range that we like. The trade just didn't work out, and that's going to happen. Minus 53.15%. Now, QQQ Options Playbook is finding an average of 8 new options trades per month, about a trade or 2 per week. So let's review some more case studies. Get into this trade. You notice that we've been moving upwardly, right? And percent R is in the upper range, tradable pattern that we like. Get in, very next day, 100%, 100.63%, trade made $954. Trade here on Monday, December 23rd. Again, we don't take off because it's the holidays. We're not, oh, tomorrow, the 24th, is a shortened week. Nothing's going to happen. Nobody's around. No, 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 no. If the markets are open, our team is working. And it worked for our subscribers to 100% right before the Christmas holiday. That trade made $782. Again, we get this upward lift. We got percent R in this upper window. Situations that we like. Start off the first of the year. You'll notice multiple down days, right? You see multiple down days there. And we're entering to buy calls. We're entering to buy calls on a down day because the percent R is in that lower window. The next day it flips all the way to 100%, $802 on that trade. January 21st, very special day. It happens to be my birthday. It was a Tuesday, coming back from a holiday. Monday the 20th was the Martin Luther King holiday. Our analysts didn't come back into the office all fat and sassy after a 3-day weekend. No, they came in ready to work. They followed the trading system. We get some lift that we like. Enter that trade there. Remember, all of these trades are entered at what? 3:40 p.m. Eastern time, right? 3:40 p.m. Eastern time. Now, I'm surprised nobody's asked. The market closes at 4 Eastern time, so I'm surprised nobody said, hey, you only giving me 20 minutes to get into a trade? It's not accurate. If you're not following the Q options, they trade until 4:15. So you've got over a half an hour, all right? Enter that trade on Tuesday, January 21st. The next day, it jumps up, goes higher, all the way to our 100% profit target. That trade made $826. Remember, all trades today on these charts are based on allocating up to, but no more than $1,000 a trade. Wednesday, February 12th, get in, get out on February 13th on that Thursday for 100%. You notice, look at these lower opens, but rallying back, lower open, rallying back. Percent R upper window pattern that we like, worked out for our subscribers. They made 100% on that trade. If you'd allocated up to 1,000, you'd have made $897, again, before any commission or subscription investment. Surprised nobody's asked. We can trade puts. So here's a put example. Look at these multiple down days. And I've shown you some call trades that have had multiple down days. But on this particular pattern, we get a gap down and a rally back. And we said, all right, with the percent R indicator being in this lower window down here, a good setup for puts. That was a Friday. Carried it over the weekend, walked into a gap down because there was the close up in here, gaps down here, and drops all the way to our 100% profit target. That trade made $509. Why $509? Well, you see the entry price was $509, so you can only trade a single contract. March 18th, calls, 2 up days, get a gap down, drop down, percent R in the lower window. Setup that we like for calls, rewarded accordingly, 100%, 974 in profits on that trade. Now, trading 3 DTE options can be seen as aggressive, but with our unique trade management, it has been extremely successful. And let me remind you how it's performed over time. So remember on this slide, starting with a $25,000 model portfolio in the inception in January of 2023, allocating $5,000 a trade before any commission or subscription investment, all trades, all wins, all losses, no compounding, $88,740, just simple math. Add it all up. What do you get? $88,740 gross profit. As I pointed out earlier, if you just joined, that's 354.96%. Again, past performance doesn't guarantee future results. Future results are going to vary. But let's break it down to the $1,000 level like I've been showing you on the charts. $1,000 a trade, this time a $5,000 model portfolio, still starting with the inception of January 23, up $16,073 in gross profit before any commission or subscription investment. That scenario is up 321.46%. Remember, not in the market every day, only in these trades, 2 trading days at the most due to the time stop. Now, since you're a Traders Quarter attendee, right? You're sharing your Saturday with Anthony, his team, myself, the other presenters. So again, thank you for doing that. There's 1,000 other things you could be doing, but you're serious traders. That's why you're here. You want to learn. I've received approval to offer you a fantastic trading opportunity. Now, I'm going to show you how you can get real-time trade alerts when this strategy finds a trade, but this is only available for the first 34 traders, and Anthony and I can tell you there's more than 34 of you in the room. So the first 34 traders today can subscribe to our QQQ options playbook. Remember, we call them alert services here at Big Trends. 3 months of trade alerts from the QQQ options playbook alert services, resources for you. Please hear me when I say this, if you want to use them. If you just want to sit back and get the trades, you can get the trades. But if you want to learn more or if you have questions, we have resources for you. Let me talk about those. So again, Price Headley is our founder and CEO. Started Big Trends over 25 years ago. We've been around for more than a quarter of a century. We've seen and experienced a lot of things. One of the things that Price does for our clients is he records weekly video updates, breaking down every trade, why we got in, why we got out, much deeper explanation than what I've done today. He also shares market commentary with you. He records those on Mondays. It's not a live session, so you don't have to worry about missing anything. He records those. We send out an email to our subscribers letting them know when that video is available to be viewed in their Big Trends account. As I told you, you would get access to the settings and rule sheet. Again, it's a 2-page PDF that will be found in your Big Trends account. It's a line item of the trading system, right? You're going to get a dedicated email address that goes to Price and his team of analysts. Should you have any questions about trades, any of the content in his weekly video updates, or anything you may study on that settings and rule sheet. Now, it has a package value of $891. That's based off the monthly list price of $297. But as I told you, Traders Corner special package. 3 months of trade alerts from the QQQ options playbook, total package value $891. Again, for the first 34 traders today, just $177. That's not per month. That's for all 3 months, for 1 quarter of action. And no worries, no surprise charges in 3 months. What'll happen is 3 days prior to your expiration, our team will send you an email giving you the opportunity to renew. If you miss it, ignore it, no worries. Your subscription will simply expire in 3 days. So no surprise charges. How do you get that? Well, you go to members.bigtrends.com/corner. Members.bigtrends.com/corner. Let me throw that in the chat boxes for you. All right. Let me do that real quickly here. There we go. I'm going to take you to that page, show you how simple and easy and most importantly secure this is. Billing information, top left, first name, last name, email. Please put in your trading email address there. Most of us have multiple email addresses. So put in your trading email address so you can get your purchase receipt, your welcome email, and of course your trades. And you could get your first trade as early as Monday afternoon at 3:40 p.m. Eastern time. How do you get signed up? Well, payment information over here at the top right. Visa, MasterCard, Amex, Discover. So we take the 4 major credit cards, but if you glance down there to the bottom right, we also accept PayPal. So 5 ways for you to get signed up today. It's just $177. Again, it does not automatically renew. The contact information is listed twice in the checkout cart. You see it up there at the top right. Terms and conditions are listed twice, once there, and the contact information is listed a second time there. You saw that on some of my slides. It's 1-800-BIG-TRENDS. That's 1-800-244-8736, or email clientcare@bigtrends.com. And as it says, we're here to help. Again, we've been around for more than 25 years, assisting traders and investors just like yourself. Members is plural, bigtrends is plural.com/corner. Now, I do have some more slides I'd like to share with you, some frequently asked questions about the QQQ options playbook. What type of strategy is used? Buying calls or puts. Remember, no spreads, No worries. How are you going to get those trades? They're going to be sent to you real time via email. So Cool Dip was asking, do you send out sell alerts for the QQQ? Stay with me, Cool Dip. I've got an example of a trade alert for you. So they're going to be sent to you real time. So whatever email address you use in that checkout cart, that's the email address we're going to use to send you the trade alerts. Now you also see over here WhatsApp. We do not text the trade alerts. We have found over the past 2 years that using WhatsApp is faster, more efficient, and more effective using the free, and WhatsApp is a free application. You can download it to your computer, your laptop, your tablet, your mobile device, or all of the above. All right? Do you have to use WhatsApp? You do not. You'll simply get the trade alerts via email. We give you setup instructions for WhatsApp in 2 locations. 1 in the welcome email that we send to you. 2 in your Big Trends account under the My Account section. If you subscribe today, get a few trades via email, and you're like, you know what? It'd be really great to get WhatsApp. You can sign up for WhatsApp at any time during your subscription period. Remember, the new trades are going to be sent to you at 3:40 p.m. Eastern time. And also remember, these options trade until what? 4:15 p.m. Eastern time. Winter trades close using the time stop 2 days later at 3:40 p.m. Eastern time. How many trades per month? About 8 on average. So about a trade or 2 per week. Remember, no day trades. So wipe that concern off the sheet. Average contract price over the last 12 months has been $4.10 a contract. Remember, resources, if you want them, if you want to utilize them. Price Headley, our founder and CEO, weekly video updates, settings and rules sheet for the trading system. Remember, it's a 2-page PDF that breaks down the trading system for you, and you've got email support with Price and our team of analysts should you need it. That email address is revealed to you in your welcome email. So let's review this winning trade from the past week one more time. So we got into it last Friday, Friday the 23rd, with this setup that we like. You see that it had been rolling over for a few days, even gapped down and rallied back, and we got that percent R in that upper window, setting up a call trade for us. It's one of the 3 tradable patterns that I mentioned that our team uses. On Monday, got the gap up and go all the way to our 100% profit target. Again, that trade made $553. What do these trade alerts look like? Let's talk about it. Trade came out at 3:40 p.m. Eastern time. Buy to open. What does that mean? Just means you're starting in a new position. You think about me handing you your favorite beverage, water, soda, adult beverage, whatever it may be. You got to pop the top on it to open it and enjoy it. Well, you've got to open a trade to have the potential to enjoy it. We're only trading the Qs, right? So trading QQQ, we give you the exact expiration, May 29th. We give you the exact strike price, 511. You know the direction, it's call. We even give you the option symbol down here on the second line, and we tell you what to pay for that trade. No doubt about what you're to do. It's not just sending out a signal going, hey, buy some calls on the Qs. No, we're very specific, very specific. So there's no guessing about what you need to do. Now, on Monday morning, before the market opened at 9:25 a.m., we give the stop of 276, the profit of 1106, good till cancel. Cool tip, we do not send out sell instructions unless it's a time stop. It is up to you and other subscribers to follow these parameters right here. So if it hits the stop, you get out. If you hit the profit target, you get out. So if you want, you can set up what's called an OCO order. That stands for one cancels the other. I love them. As I told you, I'm doing webinars like these all week long. I'm assisting traders just like yourself via the phone. Believe it or not, OCO, it's great. I use them. It just means you have both of those orders working at the same time. But please hear me when I say this. Do you have to use OCOs to be a subscriber? No, you don't. But it is up to you to follow where these options are trading. So if it trades at 276, you get out. Or if it trades at 1106, you get out. So we know this trade was hit at 1106. So then the software would go in and cancel the stop working at 276. Pretty cool technology. So mathematically, what's that trade look like? So as I told you earlier, it's a single contract. Why? Because if you're using the $1,000 parameter, you can only do one contract at 553. So 553 in the trade, we know it hit the 100% profit target. That's 1,106. When you do that math, it's 553 gross profit or 100%, again, before any commission or subscription investment. Remember, Traders Corner Special Package. 3 months of trade alerts, total package value $891 for the first 34 traders today, just $177. $177. That's not per month. That's for all 3 months. When you go to members.bigtrends.com/corner, no www needed. Just simply members, plural, bigtrends, plural.com/corner. I took you to that checkout page earlier. But as I've told you throughout the presentation, I was one of Price Headley's earliest clients back when he launched over 25 years ago. I've also told you I've been with him for 13 years now on the front lines, assisting and helping traders just like yourself. One of the things that I enjoy are unpaid testimonials. And I'm going to read this to you because I think it's impactful and powerful. Maybe you've never heard of us. Let me read this to you from Tom W. Again, unpaid, unsolicited. Dear Chris and all at Big Trends, I cannot thank you enough for always working with me to smooth out issues or questions I have with my subscriptions. I've been with you now for 10 years plus and don't regret for 1 minute for choosing BT as my #1 and only trading organization now. I spent years prior to BT trying many different programs and all without success until Big Trends. Not once have I ever had an issue that BT could not fix or suggest a way to correct. Their customer service is the best and above all others I've dealt with prior, and never without a quick response or phone call to answer any questions or issues I was dealing with in my account, and always with professional and courtesy responses every time. You will not regret joining this team of experts, and I'm sure you will always be pleased with their professionalism and knowledge in trading, especially with options. I'm blessed to be a part of this organization and always will. Tom W. Again, unpaid, unsolicited. So as a reminder, the power of a single trade, a single contract, could cover your special package today. No guarantees that your first trade is going to be a winner, but I've shown you the power of the trading system. So again, Anthony and his team has allowed me to represent Price and Big Trends today with this special package. Traders Corner special package. Remember, it's 3 months of trade alerts, total package value $891 for the first 34 traders, $177. Members.bigtrends.com/corner. Don't delay, act today. Remember, this is only available for the first 34 traders. And as I told you earlier, there's more than 34 of you here today. Well done by Anthony and his team. And once again, thank you all for sharing your time with us today. This is the checkout card, as I shared earlier, members.bigtrends.com/corner. You see the email address here, all right? It's highlighted in red. Why? I click into that on purpose and click out. Cannot tell you how many times in my 13 years of being here, traders either type their email address wrong or they put in some other email address, and then they get mad when they don't get their trade alerts or can't access their account because they forgot that they used a different email address than their trading email address. So please take just a few seconds and put in that trading email address. Contact information, I've put that in your chat boxes for you. Again, the office is closed today, but we'll be back in on Monday at 9 a.m. should you have any questions. Payment information, we do accept the 4 major credit cards, as you can see there, Visa, MasterCard, Amex, and Discover. But don't forget, we also take PayPal, right? PayPal down there at the bottom. So 5 ways to sign up. Remember, it's a non-renewing. It will not automatically renew. $177, not per month, for all 3 months. Members.bigtrends.com/corner.
Chris, are you
Yeah,
able to take some questions?
yeah, I think so. I see a couple in there. I see one from Claude. Hey, Claude, thank you for signing up. Said he just subscribed. Claude, email our team, clientcare@bigtrends.com, and we'll get that for you. Or Claude, here's what I'll tell you, since you subscribed, when you log into your Big Trends account under the member newsletter section, and all of that'll be outlined in your welcome email, Claude, but under the member newsletter section, you'll see the QQQ options playbook. You'll click on that, and then you'll see a section for the positions table, or track record, I think is what our team call it. If you click that link, it'll bring up a sheet and show you every trade that the system has issued since January of 2023. All right. Have any questions, reach out to us. Again, the office is closed this weekend. We'll be back in on Monday at 9 a.m. I see David. David says, am I seeing this right? You're allocating up to 20% of your bank per trade. That's correct, David. And I agree with you. That does seem risky. But as you heard me say earlier, traders need to trade with what fits in their financial situation. So if you feel like 20% is too high for you, David, simply just scale it down, because as I shared multiple times throughout the presentation, the average recommendation has been $4.10 a contract over the past 12 months. So you could do it for as little as $4.10 a trade or $500 a trade, roughly, right? So again, yes, it is a risky idea, David. Always trade with what fits in your financial situation. Anything else out there, Anthony, that I've maybe missed?
Did you answer about the doubles? Someone was asking, targeting doubles in days. Can you explain that?
Target doubles and days. Yeah. So what that means is since we're targeting 100%, that means you would double your money, right? So if you put 1,000 in, this is just simple math. You put 1,000 in, the trade goes up 100%, the 1,000 goes to 2,000, so you make 1,000. That's the double.
And then they also asked, do you send alerts for, do you send sell alerts as well for the queues?
We don't, unless it's a time stop. So the trade alert that I showed, we give the stop and the target for the first 2 days of the trade. So it's up to the client to follow that stop and target. All right. And then if it doesn't get hit, if the stop and the target doesn't get hit, then we will send out an alert to close the trade down based on the time stop.
All right. Thank you, Chris. That's all the questions there were.
All right. Well, Anthony, thank you again to you and your team for having us. I hope everyone out there has a wonderful weekend. And as my boss likes to say, trade well.
Thanks again, Chris. That was powerful. Thanks for breaking down a clean, repeatable approach to triple Q options. And for those wanting to implement Big Trends tools, you'll find their exclusive offer in the chat. Next up, we've got Doc Severson, founder of 12-Minute Trades and a master at simplifying complex concepts. Doc's presentation, Creating More Accurate Directional Trades, the Pane Fractal System. Today, he'll review how fractals and a few simple rules can dramatically improve your entries across the time frame, across any time frame. Now let's welcome Doc.
Good afternoon, everybody. Hey, Anthony, good to hear from you.
Good to hear from you as well. I like that first slide you got there.
Okay, so we got the first slide working and everything like that. I'm actually going to change things up a little bit, and this is kind of an 11th hour thought, just because I like to give presentations that match what the market is providing right now. And this is my favorite strategy right now, which is what I'm going to talk about here. So if you're ready, I'll get started here.
Yeah, it's all yours, Doc.
Okay, thank you very much. We'll try to keep this in. We'll bring you in on time at 1:15. All right. So again, my name is Doc Severson of 12-Minute Trading. You may have heard of me before, maybe not. I'm an individual trader and performance coach since 2005. So I am that guy that used to work in the corporate environment. And it was a combination of inspiration about trading and desperation to get out of the corporate cubicle environment. I had a 6-figure job back then. Everything was going well, but it was just miserable. And I think a lot of you can relate to that. You feel like you're making enough in terms of salary and benefits, but it just feels like you're going to prison every day. So this is something that for the right people, you can give yourself a different life or contribute to your retirement income. The current services that I provide this through are 12minutetrading.com, as well as I've got a service through ReadySetCrypto.com. You may have heard of me at some of the other sites like Options MD or TheoTrade, Docs Trading Tools, or maybe even the original Options Linebacker. So my specialties are fractal price analysis, that multiple time frame fractal price analysis, options and future strategy, understanding the trading mindset. And because of that, what I did was I wrote my first book because I was making decisions that I couldn't understand, and I had to figure this out myself so that I could help other people understand. So this is a book on Amazon, the Trader's Guide to Cracking the Code of Profitability. And then with the fractal price analysis, also the second book here is Fractal Energy Trading, also available on Amazon. So if you want to know a little bit more about what I think and who I am, those are some quick and easy ways to find out. But basically what I do is I'm not going to hype you guys up over the next 45 minutes. I'm going to keep everything really sane and rational. I'm going to show you how to simplify the complex, and that's really what I do best. As a former engineer, and most former engineers, make things more complex, but really what I try to do is to understand something to the root level and to make it approachable and solvable for just about anybody of any background. So my purpose today for you guys in the next few minutes is to help you understand how you can retain some of that momentum, right? So a lot of us feel like Sisyphus. We roll that stone up the hill and we start to make some progress in this, and then we watch that thing just roll back down again, and then we start all over again, and then it rolls back down again. So it's this cycle that we go through all the time. I went through it myself. Everybody I've ever worked with has done it to some degree. And really what I specialize in is showing people the path to get that stone to roll down the other side of the hill. So that, again, that was me 20 years ago, trading like my life depended on it, but having no answer to what the market was throwing at me. So my purpose today is to share something with you that has lowered my stress level immeasurably, especially over the last 2 years. So I want to share something a little bit different with you in the hope that it will help you as well too. Okay, so that's who I am. That's what we want to do here today. Now, let's focus on the objective. So as an engineer, you always got to give me a problem statement to begin with. Like, what's the problem that you want to solve? And for nearly everybody, especially look at all the people that are around here today on a Saturday afternoon, giving up their free time. And most of us are here to understand how to get financial freedom. So the problem is everybody's trying to set themselves up for financial freedom, but using yesterday's methods won't work anymore. Most people don't even know how to use one of these things, right? These days, you bring it to high school and they're going to get odd stares. So some of yesterday's methods are grow the pile. So the old paradigm of investing was to continue to build your pile of assets and then live off of the interest. This is the way things were done for decades. The legacy income solutions from money managers are just straight interest, dividends, and annuities. And guess what, guys? They're still pushing the same solutions as from 40, 50, 60, 70 years ago. Today, it's the same thing. But there's one small problem. Inflation has kind of snuck in. And this is because we've debased the dollar. We've been printing like crazy, especially ever since the great financial crisis, which is coming up on 20 years ago. So the problem here is that we don't have enough money and we're expecting to get a meaningful return off of that. Inflation has quickly put a 20% surtax, especially over the last 3 or 4 years. Like, for example, my auto insurance has doubled in 2 years, and I bet it's done the same thing for a lot of you. And this morning I went out and looked and said, what are the current CD rates that are out there? 4%, 4.5%, 4.5%. That's about it. Not going to get anywhere on this amount of capital with this type of interest rate. Okay, so what we need is income. There's 2 different types of income that we can earn. One is active income. Active income is basically what most of you are doing right now, which is a job, or perhaps it's even active trading. Requires participation and effort to earn that income. Now, passive income is the holy grail of income. It's earned without active participation. This is where you sit on a piece of land for a number of years and it grows in value, and you can perhaps even rent it out if you want. You can get passive income off of this. And another example might be a landlord that owns a building getting passive income from their tenants without too much active participation. Most are like that. So interest and dividends are something else to do that. So the majority of uneducated retirees can only fall back on one solution. Most of us only know one thing to do to get income, and that's continuing to work by trading their limited time for money. This is the game that we all fall into, that we're taught to do from when we're very, very young. You know, someday, son, you will trade your time for money. And what I'm trying to do is to help you understand that there's different ways to do that. So without trading time for money, what else can we do? Well, guess what? We can trade options. We can use options to replace our interest income from the old paradigm. So passive income, we can sell longer term options to act like an insurance company where we're selling the risk premium to buyers. Or active income, we can look for short-term opportunities to either buy or sell options using the leverage of options to more efficiently use capital. I'm sure we've been talking about options all day long. So my assumption here today is, since you're joining us at the Traders Corner Investor Summit, you probably already have some exposure to options and understand their potential to deliver real world returns to solve that income gap. So we'll skip the basics for now, but maybe you don't know the way to use them to get consistency. So my focus for the next 30 minutes here is going to be, how do we generate active income using options? So off we go. That's our objective, is understanding financial freedom. We're going to use options to get there, and I'm going to show you how. But here's the challenge. I'm sure you've all been through this before. Again, there's Sisyphus rolling the stone up the hill. I want you to keep that image in mind, because this is how we all go. So how do we create wins without giving them back? Well, what a newer options investor will do is to initially go high probability. And this is exactly what I did when I started. Is I would sell options out there at 5 delta that would have a 95% chance of success in each direction. Sounds perfect, right? Man, I'm selling something that's got a 95% chance of winning. We multiply them together. Okay, so that's 90% for both sides. Okay, so this is one of the most common things to do, is to sell the iron condor. And this is where most people start, because it makes sense. It totally makes sense. However, if you do the numbers, and this is kind of a transition that I see everybody go through over the years, is they start out with high probability trades because it all makes sense. And then you've got a bunch of folks in the back saying, no, the numbers just don't work. So if we placed 100 identical trades with an 80% or 86% probability of success, okay, so maybe if we have the law of large numbers, maybe if we do 1,000 trades, and we're going to win 860 of them, we're going to lose 140, right? Something like that. So if we have a win generating $70 and a loss subtracting 430, the numbers just don't work over time. The only winner really is the broker. The only winner is really the broker if we play this to the numbers like this. So we can try to fix the high probability trade. So a lot of people talk about, well, we have advanced skills to show you how to take earlier profits, or define bad exits, take earlier smaller losses, or rolling the trade out to more distant time and distance. We could have all kinds of various dynamic defenses using butterflies, debit spreads. We can alter the Greeks of these. Guys, I've tried them all. I used to teach all this stuff, and people snapped it up because I was using it, and I was getting some success with it, but not enough. When I would get rolled and I'd get run over on one of these trades, I would give a lot of it back, no matter what kind of dynamic defense that I used. So to me, there's really only one real answer for improving these high probability trades, and that's the root fix. And that's where the implied move needs to be overstated versus the realized move. So in this line here, the implied is in the blue and the realized is in the orange or tan or whatever this color is down here. And so for a large period of time, we can see where the implied move is overstated versus the realized. But then we get into situations like this where the realized move is actually much more than the implied. And so really what we're seeing is the best edge is during times where we have this, implied fear. And then as markets become more linear, we lose our edge and we get run over on these things because the realized move is much larger than the implied. So there are times for it, but not all the time. So how do we fix this now? After our little mean reversion that we've had since the April-May move, we've mean reverted back down to lower implied volatility again. Now, that doesn't mean that it's always going to stay that way. We could get movement starting tomorrow, depending on what tweets get made. But volatility has mean reverted again. So this is going to make it tough to sell high probability iron condors. You're just not going to get enough distance and space. So the question is, how do we fix this now? Okay, so the challenge is consistent income. How do we create wins by giving them all back? How do we avoid this Sisyphus sort of syndrome where we roll the stone up the hill, we go to all this effort, and then we just watch it go all the way in just one or two trades? So frustrating. Well, what I'm going to suggest is that we fix these high probability trades with time. We're going to use time spreads here. These are distant cousins of the iron condor. So what is a time spread? Okay, this is a time spread where you're selling the front option and you're buying the back option. So if I could, I would just sell put options or sell call options if I could, but the margin to do something like that is usually pretty outrageous, especially with something like the SPX. You need a 7-figure account and portfolio margin to do something like that. So what realistically can we do? So this is why we use an insurance option, in this case, the long option, that creates the margin relief for this. So we're selling a short-term front option, which in our case is going to be about 1 day to expiration. And then we're going to buy a back option at some distant point in time, usually 40, 45 days, something where it's not going to experience a whole lot of decay yet. So what's the edge here? This is what I love, because this edge will not go away no matter what. So if we look at these options, we have a short-term option, which expires at T1. This is our front option. And then we have an option which expires in another 3-4 weeks or so. So there's quite a bit of difference in time between the two. Well, as you guys know, most of the decay in an option comes at the very last moments of its life. Whereas the longer term option, that back option that we buy, this one stays pretty steady, depending on what else is going on with price and volatility, but it stays fairly steady in terms of the decay of that option. This is what we're focusing on, is the decay of that extrinsic value. So that will go to zero. That front option will go to zero by its expiration date. The back option will decay more slowly. So we're trading the differential between the two. So this is a fundamental edge. This is not something that I'm going to teach you about today. Then by next year, all of a sudden the edge is gone because people have figured out a way to fade it. This is a fundamental edge, will never go away. However, you must take care to keep the edge. This is what we're going to talk about today. So how are they different? How is it different than an iron condor? Can we use a time spread in place of an iron condor? So again, the problem with an iron condor right now is you're not getting a whole lot of distance. We've had a lot of volatility reversion in the last couple of weeks in particular. So you're literally picking up nickels in front of the proverbial steamroller at this point. Now, the similarities are that you're creating income by selling a wasting asset, which is that front option. The differences, though, is that, they're entered for a debit versus a credit. That to me is no big deal. But here is the important thing. This is a long Vega trade. It's not some crappy car that GM sold in the 1970s. The Vega is the sensitivity to implied volatility. So this is the opposite of the iron condor. So if we catch something at the very top of the move, this is very dangerous for an iron condor, especially if we get a retracement, because the implied volatility will jump up and you get trapped in the trade. You can't get out early. Those of you that have traded iron condors know exactly what I'm talking about. Whereas when I'm trading a time spread, that's exactly what I want to see, because that allows me to get out much faster. So the time spread is better for these low volatility markets that we're seeing right now. And quite honestly, we see these about 80% of the time. What we've seen in the months of, February, March, April, the corrective move that we had, our little tantrum that we had for tariff tantrum, I guess we'd call it. We see one of those maybe once every year, maybe every couple of years or so. And it tends to get things spiced up. And then we see 80% of the time, we see this sort of stair-stepping price action, which is what I call quiet and trending. So when we get the breakout, consolidation, breakout, consolidation, we get into a very linear flow versus corrective market action, which is just all over the place. So there's different edges depending on what markets are available. So when is the best time to do something like this? Well, it is during this sort of stair-stepping type of price movement that we've seen in 2021, not so much in 22. So we want to avoid it during 22. But as we got into 2024, this was good stuff. We want to avoid this strategy during the tariff tantrum. And then as it comes out of it, this is where we want to be aggressive. So now is one of the better times to do this that I've seen. And this is why I've changed my topic of my presentation today. So if we want to summarize condors versus time spreads, condors are a little bit easier to qualify. They're a little bit simpler to trade and understand. Most people understand them. And it's a fairly hands-off trade, but the payoff is slower. Trading in lower implied volatility conditions, you can be lulled to sleep where all of a sudden you're trading too close and you get run over in the space of a day. Time spreads require a little bit more effort on your part to learn the edges there, but trading time spreads will make you a better trader because it teaches you more about how things actually move. So playing generally at the money, this is different. We're used to playing trades out of the money. It's kind of like being in the artillery. If you're in the Army, you're 3 miles behind the front lines. You're just drinking beer in the rear echelon and just lobbing shells over the front. And it's a pretty low risk life back there until somebody does a flanking maneuver, right? So we're going to be playing close quarters combat here with time spreads. We're going to be playing right at the money. It means much faster profits because you're bringing in much, much more of that extrinsic value. Okay, so time spreads. Conclusion here, time spreads might be a better choice for today's low volatility but high velocity market. Okay, so that's the problem with high probability trades and how we're going to fix them with time. So one of the other things to do with something like this is that I'm going to talk about the concept of a campaign trade for the win. So how do we manage trades and keep score? So how do most of us keep score? Well, we keep score like we're, a member of a baseball team. What's your batting average? And that's what people want to know. I saw these questions from the last presenter, or into the last presenter, was what's your success rate? And that's what people want to know. What's your batting average? Not necessarily what's your profit factor, which is what your question should be, but instead what's your batting average. So most of us trade and keep score as if we're on a baseball team, right? And this may not necessarily be the most important thing to do with that, because the downside here is that humans lose interest if we're not receiving constant encouragement and reinforcement. So I could show you a strategy that wins 95% of the time, but loses money overall. Is that what you want? This is where you say no, all right? You don't want that. You want something that wins no matter what. By contrast, I could also show you a strategy that wins 30% of the time, but makes an enormous amount of money. Most retail traders won't trade that because they don't get the positive reinforcement for that. So we give up. If we're not getting immediate feedback with things, we give up. So this is why I want to change the game with you guys today. This is damaging. You've invested time and money into learning and trading a strategy, and you end up giving up and moving on to something else just because you don't get immediate positive feedback. I see this all the time. I've been doing this for 20 years now, guys. And I did this initially when I started too. I would invest into something and I'd just pour my heart and soul into it and learn it and study it. And then finally I'd work up the guts to take a couple of trades, and wouldn't you know it, they wouldn't work out. As soon as I took the effort to place a couple of trades by some unknown reason that only the market can explain, and actually I understand why it happens now, but you won't win those trades. And so you get discouraged, despondent, and like, oh, this strategy is no good, or the guru is no good, or whatever it is. You blame it on something, but oh, look over here. Look at this bright, shiny penny that's over here. Look at this cool strategy that this guy was talking about on YouTube. Oh, let's check this out. So you go thundering over there. You do the same thing. You invest your time and money and attention, and you pour your heart and soul into it, and finally you work up the gumption to take a couple of trades. Well, guess what happens? Same thing here. Those don't work out. And so once again, you're like, oh, this is a scam. I just feel this is this is no good. Everybody's out for themselves. So here's this other bright, shiny penny that's over there. You go thundering over there, and pretty soon you're just going spinning around. You're just buying programs and not really getting anything. And next thing you know, you look up and instead of getting 10 years of experience into learning how to create income, you're getting 1 year of experience 10 times, and you're never going to attain mastery like that. This is why this is so damaging for us to go running around like a herd and trying to, looking for quick money. So here's an alternate approach. What if we traded a hedge position that wouldn't lose much no matter what happens? We're kind of delta neutral to start with. No matter what happens, we're not going to lose much one way or the other, and we could win. We don't really care about the outcome of any one trade. Doesn't matter if it wins or loses. Some will work, others will not, and we accept that at the very beginning. We don't know in advance which will work or which will not work. We've given it space to do what it's going to do. Nothing that we do will affect the trade working or not working. So we can't screw up. We can't, oh man, if I had just done the right thing yesterday. No, you don't know what the future is. Nobody knows what the future is tomorrow. Don't put the pressure on yourself to predict the future. We don't really care about the wins and losses. Our only job is just to show up every day and execute. Doesn't a strategy like this sound easier to trade and manage day to day, especially if it produces positive results that are based on the edge that we talked about? Yes, this is what's called a campaign. We can run a campaign on a strategy as long as the reward to risk is relatively tight. So here's an example of a campaign. Now this upper row, this is my long option. Oh my goodness, I lost $831 on that long option. Must not be a very good strategy, right? Well, think about this though. The short options, 370, 530, 1338. This is the only thing I care about, which is the bottom line, a 25% return on risk. The huge advantage to running a campaign is that you just stay in the campaign until you're profitable. There's very rare conditions where I will pull out of a campaign and say, oops, okay, changing character, not good. So we're going to suspend the campaign until we get the conditions that we want. So it's a very low key trade where you don't feel the need to win or lose because you're going to get the results that you want. That's what a campaign is. It's a different way of thinking about trading, guys. So what we have is the daily cash flow campaign strategy. It's based on time spreads, and I trade time spreads in the S&P 500 options market every day. This is a quiet, low volatility market that supports time spreads really well. And we could trade them through a couple of different instruments. I tend to favor the European settled instruments so that we don't have to worry about any kind of early assignments or anything, since we're playing right at the money. Not that this would ever happen. Even if we use the spiders, it's not going to happen. But we don't, I want to just reduce the number of variables. I want to reduce the number of variables. So we're going to buy to open a longer term option. You can see in this case, this is a July option. And here was the one that on 527, we're putting on the 528 short option here. So you are hedged against a black swan in either direction. A big move is not going to hurt you that badly. What we look for is a small move. The other thing that's an advantage here is zero DTE. Every single day, I've got another option one day out that I can sell. We roll to a new short option every single day. Every day, we're looking for that time decay. We're pounding on that time decay, because that is going to decay no matter what. So again, it's a campaign. We're going to run our campaign mechanically. Sometimes it's a day. Sometimes it's 3 days. Sometimes, as I'll show you, maybe it's 10 or 15 days. I don't know what it's going to be. Sometimes the targets hit quickly. Sometimes it takes longer to do that. We just have to be patient and run the system. It's simple. So this is our daily cash flow campaign. Our results depend, again, don't get too caught up in the SPX here, because the SPX, it's a big instrument. It takes a larger account, and not every broker will, depending on what type of account that you have. Like, we're having problems with Schwab and retirement accounts. So we've been trading Tasty Trade, we've been trading E-Trade. Of course, IB will let you trade whatever. Some of those other brokers as well too work just fine. So generally, you can find something that works for these. And a smaller account, we use the XSP. It's real simple. So we've had good results for this, and this is something I wish I'd discovered 20 years ago when I started this. It took me, unfortunately, 18 years to discover this. So some examples, recent examples here. Here's a fast campaign on the SPX. Again, this took $12,000 of capital. So this is an SPX trade. If I was doing this on the XSP, it would take 1/10 that capital, so $1,200. Hold time was 2 days, 6% return on capital. You do that day after day after day, and it adds up. It really does add up. So again, these are low stress trades. We can hold them overnight without real fear of anything going on. So in this case, we entered this trade on this day. The price was about here, goes up, and because the price went up, we made some nice profits on that short option. And on day two, we also made some nice profits on that short option. And then we decided, hey, as long as we're getting somewhere above 3% in the course of this trade, we're going to just take it off, because there's so much event risk that's happening these days. A slower campaign. This one was from this fall, and this one took 13 calendar days. So this one took about a couple of weeks, and then I finally just shut it down at about 2%, because I think we were right before a Fed, one of those Fed days or some other event risk day. It's like, let's just shut it down. We've accomplished a profit with this campaign. Let's let the event risk pass by, and then we'll just open up another campaign. It's real simple. Here's one for the XSP. This was a couple of days ago, and this was 2 trading days. Again, the profit doesn't sound like a whole lot, but that is almost 4% return on capital. This is a very small instrument compared to the SPX, and it was only 2 contracts. So you can do this with a small account as well too. $2,000 was the margin that was held on the account. So those are a couple of recent examples. These are simple trades to put on once you get into the flow, once you understand what's going on. So how can you apply this? Let's bring it together here. How can you use this short presentation to start generating income now? So first of all, what we talked about is the usual legacy solutions don't work in today's high inflation world. You're going to burn through your principal in no time. You're going to be withdrawing principal, and you're not going to be replacing it with the income that you generate. So simple interest, dividends, annuities, they just don't work anymore. I can't believe that they're still selling that junk and trying to represent themselves as superior. Careful with the high probability trades. Just because something has a 95% chance of success doesn't mean there's something that you want to use right now. There are times to use those. Right now is not one of those times. It's not an ideal market for the high probability condor. They're very dangerous until the risk premium rises again to allow better distance. So we talked about time spreads. Delta neutral time spreads work great with today's low volatility but high velocity market. We're in and out before the market gets a chance to really move. And then we talked about the condition of setting up a campaign. So instead of looking at every trade as if it's a win or loss and judging yourself based on that very last trade, set up a campaign. After having to be right the last 20 years on every trade, it's so much more relaxing to trade this strategy where I don't care what happens at night. And I do care, but not that much, right? So just turn the handle, work the campaign, let the market do its thing. I certainly would prefer to see a profit come in the trade, but if it's not, there's always tomorrow. And these things are incredibly effective at generating profits. And then accelerate. Stop getting ready to get ready to get ready. This is what we all do. You know what you have to do. This is your time. So what I'm challenging you guys to do is today, learn what you can today and focus on getting good at one thing. I want you to find your one thing, as Curly said in that movie, City Slickers. Find your one thing. Stop trying to be a jack of all trades. You'll be a master of none. Find one thing that you're going to commit to and be the best in the world at it. And you'd be surprised how quickly that you can do that. This is where it all changed for me. I was so frustrated because I'd been through so much education. I'd spent so much money learning how to trade. I had 50 trades going on in my brokerage accounts at the same time, and I was still losing money. And so I got to the point where I said, that's it. I'm going to trade one strategy, one stock, one chart. I'm going to become a master at this one strategy if it kills me. And wouldn't you know it, that it was only, I think it was only about three months later that I put my notice in because I had done so well. Now, looking back, that might have been a little bit reckless with, 3 young kids and all that stuff, but I was driven. I was going to burn the boats, right? It was going to burn the bridges and just never looking back. And that was 20 years ago. So find something that works today, execute, make it your one thing. That's how you apply this. So let's summarize, and we'll get it back to Anthony here in a minute. So where do you go from here? I've just showed you everything what to do. So it's my belief that everybody needs an active income focus based on time spreads, traded as a campaign, ditch the old financial income paradigm that no longer works. So you might say, well, Doc, that sounds great, but how do I start? How do I get there? Okay. Well, it doesn't hurt to ask for a little bit of help. Consider joining me. I have 2 ways that I can help depending on your time commitment and educational budget. And fortunately, both of these are really, really inexpensive. The first thing that you can do is if you just want to kick the tires and say, well, I don't know who you are. I don't know what this is all about, but I'm willing to join a class or something. So I have a campaign masterclass. So we have all the materials that are out there today. You can get started on this today if you want to. You'll be trading this by Monday. Go to 12minutetrading.com/courses. 12minutetrading.com/courses. You'll see the menu structure that's up there on the site. It's a very easy to navigate site. And look for the class called the Campaign Cash Flow Masterclass. And you'll see it for, I believe, $97 or $99 or something like that, which is still relatively cheap considering the power of the material that you get. But if you use the coupon code campaign79, you'll get it for $79. This is a 10-module course. It's easy to work through and understand. Most people are done with it over a couple of days once you understand everything. And if you have questions, you can email me your questions. Just go ahead and reach out and I will get right back to you with that. So this is I'd say this is the easy way to get started with this, is the Daily Cash Flow Campaign Masterclass. But if you are more impatient, if you want more help, if you want to get started faster, then join me in the live trading room. So I run a live trading room every day from 9:20 to 10:05 Eastern time. So we talk about the market. We go through our trades every day. You get included on alerts. We do 0 DTE setups, intraday internals, and of course we do campaign time spread entries when the market conditions favor that. Otherwise, we're doing, things like wheel trades on different stocks. There's all kinds of different things that we'll do in there, and there's a great group of traders that are in there as well. You'll learn a lot from them, as we will from you. So if you want to join me in the live trading room, go to 12minutetrading.com/services and look for the live daily trading room with Doc Severson. Normally this is $197, and you can use the coupon code SAVE50 and get this for $147. So what some people do is they say, well, I'm just going to kick the tires. I'm just going to join you for a month. I'm going to learn everything I can from you, and then I'm going to hit the ripcord. And that's fine. And what I find is a lot of those people are still with me 6 months later because they enjoy the camaraderie, they enjoy the learning experience, and it just makes dealing with the market so much easier. Again, so that's the faster way of learning this. Again, you can join either through the masterclass or through the live trading room. But however you do this, I encourage you to learn the campaign, learn in this case the campaign diagonal, learn time spreads, and make sure that you're trading what the market supports. Okay, I'm going to take, I've got about 2 minutes here for questions. If there's any questions, I'd be love to take those. I don't see any right now, but let me know if you guys have anything that what's the code for the masterclass? The code for the masterclass is campaign 79, campaign 79. That is the code for the masterclass. Thank you for that question.
Could you also give us the code again for the room?
The live trading room is SAVE50.
Thank you.
And some people do both. They sign up for the masterclass as well as signing up for the live trading room. In the live scheme of things, or the grand scheme of things, this is still relatively inexpensive considering how powerful this is for your future. Okay, I'm going to see if there's any other questions here. I think we've caught everything, so we have finished on time. So Anthony, I'm going to give you the steering wheel back, and I want to thank everybody for your time and attention and being part of this great Saturday webinar here at Traders Corner.
Thank you, Doc. That was incredibly insightful. Thanks for bringing clarity to directional trading. Traders, you'll find Doc's bonus offer and training link in the chat, so please have a look at that. Thanks, Doc. That was really great.
Okay. Thanks, everybody. Have a great weekend.
All right. Coming up next is Jeff Tompkins, hedge fund manager and founder of Altos Trading. His session is called How to Find Stocks That Are Ready to Skyrocket. Jeff will walk you through a systematic approach to uncovering high probability trades, even in volatile markets. So let's bring in Jeff Tompkins.
Hello, Anthony. How are you?
Hi, I'm good. How are you?
Doing well, thank you. Thanks for having me.
Thanks for being here.
Great. Well, I'll go ahead and dive in. I want to welcome everybody. Thanks to all of you for being here. And as Anthony mentioned, I'm going to be revealing my strategy for finding stocks that are ready to skyrocket. This is a new twist on what some of you might be familiar with related to relative strength. So we're going to be talking about a little bit about relative strength and how we can use this methodology to identify stocks that are ready to go up. So I want to start out by kind of talking about an interesting principle that relates to this. This is out of a book by Sam Parker. Some of you may have picked this up at some point in the past. If not, I would encourage you to read it. It's a good read. It's called 212 Degrees, the Extra Degree. And what this book essentially does is it, oh, sorry, got a little technical glitch there. Is it emphasizes, so it talks about the boiling point of water, and it uses it as a metaphor to highlight the importance of going above and beyond. So what Sam Parker does is he shows you how extraordinary results can begin with just one little small change. Okay, and I love this quote from Thomas Edison, who of course is a famous American inventor, who said, "Many of life's failures are men who did not realize how close they were to success when they gave up." So let's kind of elaborate on that a little bit and look at the 212 degree difference. Okay, so what does that mean? Well, at 211 degrees, water is hot, right? It's not doing a whole lot. It's just kind of sitting there, but it's hot, right? At 212 degrees, it begins to boil. And with boiling water comes steam. And incredibly, steam can power a locomotive train. Okay, when water's at 211 degrees, it's not able to do that. So that one extra degree can make all the difference. And when we think about this concept as we apply it to other aspects of life and specifically trading, the one extra degree can separate the good from the great. So if we look at this in the context of sporting events like golf, right? The average margin of victory for the last 25 years in all major tournaments combined was less than 3 strokes. The margin of victory between an Olympic gold medal and no medal at all is extremely small. In the men's 800-meter race, it's just 0.71 seconds. Indy 500, average margin for victory for the past 10 years has been 1.54 seconds. On average, the winner took home over $1.2 million. Second place prize was $621,000. That's a difference of over $650,000 for just a matter of a split second. So it's your life, you're responsible for your results. We're going to turn up the heat today. To get what we've never had, we have to do what we've never done. Okay, so this is going to be an approach that you've likely never encountered. And as I'll demonstrate, can allow you to identify stocks that are outperforming the broader markets and that are set to go up significantly. Okay, so before we do that, I'll just give you a brief background on myself. Again, I'm Jeff Tompkins. Pleasure to have all of you here today. I have over 2 decades of experience trading the stock, options, and futures markets. I received my professional training at Morgan Stanley back in the early 2000s as an intern at the trade desk. And about 10 years ago, founded Altos Trading, where I'm the chief investment strategist. We've rapidly grown to over 60,000 members in over 100 countries across the globe. As Anthony mentioned, I'm also a hedge fund manager, so I do manage money for my clients at Altos Capital. And when I do educational events such as this, the strategies, methodologies, systems that I share are those that I do incorporate in my hedge fund, which has been successful since we launched it over 5 years ago. We've traded through some very difficult market conditions, the COVID crash of 2020, the bear market of 2022, and have never had a negative year. And again, I credit a lot of that to these methodologies. I'm also the founder and manager of some of the top performing options and stock alert services out on the market today. And I'm going to be sharing some results we've been able to achieve using methodologies like this unique twist on relative strength. So before we dive any deeper, I'll just read a quick disclaimer. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options. It must meet suitability requirements. As I mentioned, we're going to be going over some various results on our session today. Just know that anything that I do share, due to the time critical nature of trading, activity of other traders, etc., we don't guarantee that anyone will mirror the performance of what I share. Okay, so by the end of our session, you're going to discover how to gain the extra 1 degree trading edge that can put you ahead of some of the best traders and investors in the world. In fact, you may have seen the statistic that less than 1% of professional money managers, that includes hedge fund managers, financial advisors, institutional traders, are able to consistently beat the S&P 500 index. So that's typically used as the benchmark for performance. Okay, but I'll show you how that is actually possible. So whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets. So let's get back to this 212 degree difference. All right, and how does this apply to trading? Well, as we looked at it, 211 degrees, water's hot. Okay, it's standing still, it's not doing a whole lot, kind of like a stock before it explodes to the upside. So for any of you who have been involved in the markets for a period of time or have traded stocks, right, you realize that they don't just go straight up, right? They commonly spend extended periods of time in consolidation, moving sideways, and then over brief periods of time, they will make a more magnified directional move. Okay, and there's a reason for that. We'll get into it. Okay, but getting back to the 212 degree difference, as the temperature rises 1 degree, right, water starts to boil. It begins to create steam, and that, as we talked about, can power a locomotive train. So that extra 1 degree makes all the difference. And it's kind of like when a stock starts to outperform a major benchmark index or sector and then skyrockets. So let's start to dive into relative strength. You may be familiar with the traditional indicator called the RSI, or Relative Strength Index Indicator. Okay, if you're not, I'll give you a brief background of what it is. It's essentially a momentum indicator that is used in technical analysis, and it measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. So it's displayed as an oscillator, which is basically a line graph that moves between two extremes, so it's bounded, and it can have a reading from 0 to 100. Okay, so this indicator's been around a long time. It was introduced by J. Wells Wilder back in the late 70s in his book, New Concepts in Technical Trading Systems. And in terms of interpreting it, the traditional interpretation and usage of the indicator, the RSI, is that values of 70 or above indicate a security is becoming overbought or overvalued. It might be primed for a trend reversal or corrective pullback. Conversely, an RSI reading of 30 or below indicates an oversold or undervalued condition. Now, there's a couple key problems with this indicator, okay? And I'm going to point those out. Problem number one, stocks can remain overbought or oversold for extended periods of time, okay? So it's that old John Maynard Keynes saying that the markets can remain irrational longer than you can remain solvent. So you might get an elevated RSI reading above 70, indicating the stock is overbought, but then it just keeps going up, right? Or you get a reading below 30, indicating the stock is oversold, and it just keeps going down. Okay, so that's a major problem. Let's take a look at that. So this is a past chart of Tesla, and I plotted the RSI indicator below the chart. So I'll point out that in this prior year of October and November, the RSI was providing an overbought reading, okay? It continued to do so in December, January of the next year. But notice what's happening to the stock. It went from around $40 a share up to around $190 a share, while the RSI was telling you the stock was overbought. So it provided misleading information. Here's another example, Best Buy from, again, a prior year. So RSI indicators plotted. We see that it is bumping up against the overbought level, that 70 level. It exceeds it in July and August of that year. But what's happening to the stock? It's skyrocketing from around $67 a share back in April that year to around $120 a share. Okay, so once again, very misleading. One more example, Amazon, again, for the prior year. What's the RSI telling us? Stock's way overbought. But does that correlate to what the actual share price is doing, right? Where it went up from around $2,400 a share to over $3,500 a share, okay? So we're gonna look at a different approach that is much more effective in telling us when a stock is likely to actually go up, trade flat, or go down. So this is a new twist on the traditional RSI, or relative strength indicator. Okay. And I'm going to walk you through all the steps, give you the formula. You'll have everything you need to do this on your own. Okay. So what are we seeing here? Well, on the left half of the chart, and this is from a prior year, okay, May, June, July, August, September, all the way into early November. Okay, this unique approach to relative strength is actually telling us that Amazon is outperforming on a relative strength basis. And here that actually coincides with what the share price is doing. Okay, back in May of that year was trading around $2,200 a share and then went up to over $3,500 a share. But then around mid-November, that changes. So now the stock is not performing strongly on a relative strength basis. Okay, and notice what the share price does. It just goes into a sideways channel. Now let's look at problem number 2 with the old RSI indicator, or antiquated. I like to call it an antiquated indicator. The relative strength indicator only measures the current strength of a stock relative to its past price. And this is in fact what most indicators do. They just compare current price action to past price action of the same underlying asset. Okay, so think about the problem with that, especially as it relates to relative strength. And we looked at that on the charts where we had the old RSI indicator plotted. So if a stock is going up, naturally the RSI indicator is going to increase as well, because it's just comparing itself to itself. So then you ask yourself, why do you even need the indicator? If the stock price is higher, you know that it's relatively, that's right, stronger or higher in price than it was in the past. Okay, but there's a solution to all this. Wouldn't it make more sense to identify a top performing index or sector and select a stock that is outperforming it? This is the true definition of relativity, of relative strength. Okay, because we're not going to look at the current price of a stock relative to its past price. And that extra 1 degree difference can take a losing system and give it the steam that can spot the next stock that is ready to explode. So often when a stock begins to outperform a major index, industry, or sector, it goes on to make a big move up. So the key is to identify stocks that shift from underperforming to outperforming relative to a benchmark index or sector. And once you identify these opportunities can be the golden ticket to beating the market. Okay, this is the way the pros approach relative strength. Okay, and I'll just quote Jim Cramer here, right? There's always a bull market somewhere. So even when we're in a market correction, a bear market, there's relative strength can help us identify opportunities that outperform the broader market. So there's always stocks that are going up, even in the worst market conditions. Okay, and this approach to relative strength can actually help us spot these. Okay, so let's now start to dive a little bit deeper, and I'll walk you through some of the steps. We'll look at some charts and some comparisons between the old RSI indicator. So I think it's important to look at the difference in real world circumstances. So I still have the old RSI indicator plotted here, but we're also now going to incorporate this new twist on relative strength. So we're looking at this past chart of Tesla, okay? And at this point in time, the S&P 500 was performing very well. Okay, we were in the midst of a decade-long secular bull market. All right, now around the third week of September of this year, prior year, okay. Well, let me back up. So let's go back to August and early September. Okay, the approach that we're going to be using in the formula, and again, I'll give you the formula here momentarily, was telling us that Tesla was underperforming the S&P 500. Okay, and you can see in the actual share price, right? It is essentially just sideways for a couple of months, right? It wasn't doing a whole lot until around that third week of September. Okay, the stock began to outperform the S&P 500, which again at the time was already performing very strongly. And notice what happens to the shares shortly after that, right? And we literally knew to the day when this shift occurred. And it was just a matter of maybe a couple weeks before the stock took off. It went up over 1,800%. But look what the old RSI indicator was telling us. It was telling us the stock was overbought, okay? And should likely be primed for a pullback or reversal. Okay, but that's not what happened. Let's look at another example, Teradata, ticker TDC. Okay, we're gonna get rid of the old RSI indicator now. We're not gonna be using that anymore. We're solely gonna focus on this new approach. And if we look at TDC relative to the S&P 500 index, which again, at the time was performing very strongly, right? So we wanna, our goal is to, number one, find a stock that's gonna go up, but also that's gonna outperform. Okay, now that wasn't occurring in October, November, December of this prior year. Okay, and you can see that based on what the actual share price is doing. It's just moving sideways until around the third week of January. Okay, there's a shift. Okay, the relative strength has changed from negative to positive. And literally the next day, the stock breaks out of the range and shoots up from around $25 a share to nearly $60 a share. That's a 125% move. Futu Holdings, ticker FUTU. Okay. This is actually, for full disclosure, one I traded in my hedge fund back at the time. And again, I just applied the formula and I noticed that previously Futu Holdings, which was trading down below $40 a share at the time, was underperforming the S&P 500. Well, the S&P 500 was performing very strongly until that changed early that year. So I went in, I bought shares of Futu. Okay, within about a month or so, it went from trading around $40 a share to over $200 a share. Okay, the relative strength it was actually increasing. It never changed to negative. Okay, that's a 380% increase in share price. So let's walk through the 4 steps of how to do this, okay? And I'll lay out what they are and then we'll walk through these. So step 1 is to identify a top performing industry or sector. Step 2 is to screen for stocks within that industry or sector. Step 3 is to compare the relative strength of each stock to an index or ETF that tracks that industry or sector. And finally, step 4 is to select a stock that changes from underperforming to overperforming. Okay, so we're gonna walk through these. Let's start with the secret to finding the top performing sectors. So this is step 1. Okay, and there's a number of ways to do this. I'll just share with you a simple free tool that I like to use. We have no affiliation with this company. It's Finviz. Finviz.com is the website. And I believe they do have some paid subscriptions or memberships. Those aren't necessary. You can, just use their freebie version. So if you go to the website, okay, you're going to go to the Groups tab. Okay, so you'll click on the Groups tab, and that's going to take you to a relative performance page. So this isn't current. This is from the past, just so you know. I don't want anyone jumping in and thinking that these are the current relative performance statistics, okay? But I want to point a few things out for purposes of understanding. So you'll notice that there are different time intervals that reference the relative performance, okay? So this is relative to the S&P 500 index. And what we see is there's a 1 week, 1 month, 3 month, and half year relative performance. I think they provide others, but these are the ones that we want to focus on. Okay, and so what are we going to do with this information? Well, let's first start looking at the 1 week relative performance. What do we see? We see industrials as the top performer. It's outperforming by just under 4%. If we go to the 1 month relative performance, we see it at the number 2 spot, where it's outperforming by just under 4.5%. We go back 3 months, and we see that 3 month relative performance shows industrials at the number 3 spot, outperforming just under 12%. Finally, if we go out to the 6 month relative performance, we see it once again at the number 3 spot, outperforming just under 30%. All right, so what we're looking for here is an industry or sector that ranks in the top 3 across the 1 week, 1 month, 3 month, and 6 month relative performance. This is our starting point. This gives us an immediate edge, okay? We can now hone in on an industry or sector that is already outperforming the market. Okay, so let's look at a couple examples. This is Builders First Source, BLDR. Okay, in June, early July of this prior year, it was underperforming. Okay, we've identified industrials as a top performing sector, right? This is an industrial stock, but it's underperforming its benchmark. And you can use an index ETF or is typically what I like to use, right? So if I'm looking, like, for instance, at the energy sector, I might compare it to the XLE, the energy ETF. Okay, so if we do that and plug it into the formula, and again, I'm going to give you the formula in the next step, we see that it was underperforming in June and July until around the 3rd week of July. There's a shift in relative performance, and we shift from negative to positive. And the stock proceeds to go up 113% over the coming months. Another one, Deere. Okay, so we are just selecting stocks in the industrial sector, comparing them to the industrial sector, right? The stock wasn't doing a whole lot in late June, early July. It had a negative relative performance until later in July that shifted. It begins to outperform its benchmark, and the stock goes up 122%. All right, so now let's cover the formula here real quick. This may look a little complicated. I'll walk you through it. It's actually pretty simple. We're just using 2 data points. We're using the stock price, so that's the stock we might be interested in trading, right? It's data point 1. And then we need a reference price. That's our data point 2. And the logic is, if the stock price is greater than 0, which obviously it should be, right? You're not going to trade a stock that's not worth anything, and the reference price is greater than 0, then we take the log value, and that's equal to the log times the stock price divided by the reference price. Okay. Now, to get the relative strength number, we're going to use 2 inputs. We're going to use an RS length of 90 days and an EMA, or exponential moving average, length of 3 periods. So the relative strength is equal to the average times the log value minus the log value length. So remember, we got the log value in the previous calculation, the stock price, the log times the stock price divided by the reference price. The log value minus the log value length, okay, that's our 3 period, the EMA length. Okay, sorry, 90-day period, and then EMA length 3 period, and then we multiply it by 100, and that's going to spit out a number. Okay, and that number's going to either be negative or positive. Okay, and quickly, I think I should have been more clear on the reference price. That's data point 2. That's the comparator. So that would be like, again, if we were looking at trade stocks in the energy sector, we could compare it to the XLE. So that would be an example of our data point 2. Okay, so that spits out a number. If it's negative, it's underperforming. If the number's positive, it's outperforming. Okay, so we want to look for obviously positive numbers, but there's a timing component. We want to identify opportunities where previously the formula spit out a negative number, and then the next day it turned positive. So we're looking for that shift. So this approach will actually tell us the exact day that that stock went from underperforming to outperforming on a relative strength basis. So once we've identified these, okay, obviously the trade management aspect is important, right? So I have an approach that I use to manage these opportunities once I've placed my trade. And this isn't arbitrary. It's based on a lot of research and experience, but I'll set an initial profit target of 5 to 10% on the first half of the position. So I have a kind of a scaling out approach here. A high percentage of the time, when we've identified these opportunities, they'll go on to make a minimum of a 5% move. Okay. And often in a very short period of time, as we looked at in some of those examples. But as we also noticed in some of those examples, many of these can go on to make very significant upside moves in the double, even triple or quadruple percentage range, okay? And we want to try to capture that, as much of that as we can. So what I do is, once I've captured profits at a 5% share appreciation, I will set a trailing stop. So I'll exit half the position and then set a trailing stop at 10% on the second half of the position, okay, to help capture the big gains. Now we can also apply this system to options. So I do a lot of my trading is in the options market. This is a very powerful approach and system for options. Number one, the timing component. So as I just discussed, this system will tell us the exact day there's a shift from negative relative performance to positive relative performance. So for directional option strategies like buying a call, selling a put, vertical call spreads, bull put credit spreads, calendar spreads, you know, the list goes on and on. Right, you've got to be precise on your timing. In the case of like just buying a single leg call, you've got to be very precise, not just on the timing, but on the forecast of the directional move, right? And this approach can help us do that. So it's one of the key methodologies I use for placing directional options trades. And the exciting thing is that a 5% move up in a stock can equal 100% options gain. So 100% ROI on the premium. Let's look at an example. This is one on Apollo, ticker APO. Use the exact system we just walked through where I identified a top performing benchmark. In this case, it was the S&P 500. So the S&P 500 was performing very strongly at the time. And I was looking for opportunities that were going to outperform. I found this one on Apollo, which previously in this prior year, early in April, was underperforming. The formula was spitting out a negative number until around the middle of April. Okay, it shifts to positive, and the stock goes from a relatively tight sideways range into a momentum breakout and goes on to make a significant upside move. Okay, so how could we trade this with options? So on April 16th, that was the day that the formula told us Apollo Group is being outperformed the S&P 500, which was already in a strong uptrend. The stock closed that day at $29.66 a share. So if we go to an at the money strike, so we're just selecting a strike closest to the current underlying share price. Okay, that would be the 30 strike calls. Those were trading for $1.70 a contract. Okay, so September 20th expiration. We'll use 10 contracts in this example. Okay, that would be an investment of $1,700 on a 10 lot. Okay, not including brokerage commissions and fees. So let's take a look at what happened here. So only 6 days later, okay, 6 days after the formula told us that it was outperforming, okay, the stock was already trading up 5%. That resulted in nearly 100% move in the option premium. Okay, so you can see trade date April 16th. We go out to April 22nd. We're at nearly 100% ROI there. So then we can use this scaling out approach that we just talked about with options as well. So we could close, we have the option obviously to just book the profit, close out the entire position, all 10 contracts. But I like to use the same approach with options as well. So we can close half of the 10 contracts and keep the other half, the other 5 contracts open until expiration on September 20th. So as we looked at on the chart, right, the formula continued to tell us each day that the stock Apollo was still outperforming. So that made sense, right, to continue to hold on. Now, if at any point it went negative, we'd want to close out the position. Okay, so we have the remaining 5 contracts open here. Those would have picked up an additional $4,225. So that's a 297% ROI potential on a $1,700 investment, or over $5,050 in profit potential. Okay, so here's an example of how I, use this approach to also trade options. And I'll get into that a little bit more, but when we look for these opportunities, we typically will look for optionable stocks. But now when a stock gains that extra 1 degree, it begins to outperform a top performing index or sector, it starts to boil and often results in explosive moves to the upside. So I revealed my 4-step process for identifying these opportunities. It does take a lot of time and work to sift through thousands of stocks every week to find the very best. So what I want to offer to you now is to let us do the heavy lifting for you. So we, for many years, have been sending out these opportunities to our members at Altos. We do it on a weekly basis. Okay, depending on market conditions, we send somewhere typically between 5 to 10 opportunities like this to your inbox or your smartphone every week. You can also take any other indicator or system you're currently using and apply it to our top performing relative strength stocks. So these are, again, we do all the legwork. These are picks, we send them out. And if you already have a system that you're using that maybe you want to take up to that next level, maybe you don't want to do all the legwork research to find opportunities, you can certainly apply this to anything else you're currently doing that's working for you. So I'll walk you through what we provide and then let you know how you can get it. So you get access to our best trade recommendations right to your inbox. So we, again, send these out every week. You don't have to sit in your computer and watch your screen all day. There's no day trading necessary. We send everything out after market hours, the very day that the stock begins to outperform. So you'll know that very day. And you'll have an opportunity, if you choose to do so, to take action, place a trade on any of these recommendations when the market opens the next day. We also offer these via priority text if you prefer to get them by text message in addition to email. So they come with easy to read instructions. Okay, it includes the profit target levels. And again, depending on market conditions, right, you're going to get a lot of opportunities, probably more than you would likely trade. Okay, but you get the ticker symbol for each stock that we've identified. Okay, you get the company name, you get the stock, the current stock price, profit target 1, profit target 2, and our analysis of why the stock is expected to outperform. Okay, and as I mentioned, I would say probably over 95% of these are optionable. Okay, so we also let you know whether it's an optionable security. We don't provide a specific option alert. That's totally up to you. but most of these are optionable, so you can trade options on these underlines. These are actual real world examples, some recent ones that we've sent out to our members. One on XPEV that went up 8% in one day after we identified this opportunity using the formula and the system that I've laid out for you. Vail went up 11% in 4 days. We alerted our members to DocuSign that went up 12% in a single day. We also alerted them to US Steel that went up 16% in 1 day. TECL went up 25% in 12 days. SGH went up 31% in 5 days. MCHP went up 15% in 14 days. ESI went up 9% in 14 days. SGFY went up 13% in 7 days. These are all real world examples we sent out to our members. We periodically, recalculate all of the performance statistics of this system. Again, we've been doing this for many, many years. Most recently, I think, so we look at the number of our picks that hit the initial 5% profit target level. And that is somewhere close, I believe, like between 85, 90%. Okay, so many of these hit that initial 5% profit target level, and many go on to make much more significant upside moves. But not to mislead you, that they're, not 100% of a pick, just like any other system, is going to skyrocket hundreds of percent, right? So for, fair disclosure, that's not what you should expect, but the system is very, very accurate in identifying these opportunities, and they often go on, and with a high degree of historical probability, go on to make at a minimum a 5% move, and in many cases much, much more. So I'm going to walk you through the package here because there's a whole lot more that comes with it, and that includes, again, an average of 15 to 20 trade alerts per month. Okay, and we send those out on a weekly basis. These are short to medium term swing trades. Okay, so as we looked at in some of those real world examples, they could be as short as a day. In some cases, they might be, a week or a couple of weeks. In some cases, they might be a month or more. Okay, but they're typically short to medium term swing trade opportunities that have the potential for large percentage gains. We only select the very best of, it's the best of the best. Okay, so there may be many more opportunities that we find in our research. So we're just picking the cream of the crop, so to speak. And then we alert you the very day a stock begins to outperform a top performing sector or index. So not only do you get our relative strength picks for an entire year, so we're going to send these to you for the next year, as long as you want. Okay, I'll walk you through that as well. You also get the priority text alerts to your smartphone. Okay. You're going to also get weekly live strategy sessions with me. We meet every Tuesday evening at 7 p.m. Eastern. So you'll have weekly access to me. We run current market analysis for the week. We cover a different strategy topic each week. So kind of like we did today on our session, looking at relative strength. We focus an hour each week on a new strategy. And then we also do a ticker roundtable where you can throw out, tickers or stocks that you're interested in looking at, and we run a technical analysis on those. So we do those every week. We also are throwing in our online training curriculum for adjusting losing options trades. So we have a whole curriculum about if you're an options trader, about how to effectively manage options trades, and specifically options trades that aren't working out. We show you how to mitigate risk, mitigate losses, and in many cases take what would otherwise be a losing options trade and transform it into a net profitable outcome. So you're going to get that training as well. As I mentioned, we deliver all of these alerts after the market closes, so there's no day trading necessary. You get 15 to 20 picks per month. Okay, and again, this is based on market conditions. It could be more. You're ultimately going to get to learn to trade stocks and options with consistency. That's what we're here to help you do. That's why we established Altos Trading to begin with. And we're including a couple bonuses. So bonus number 1 is our professional trading series online course. Okay, this is over 10 hours. We've added to it, so I think it started out around 9 hours or so. It's over 10 hours of content that goes through our top strategies for a variety of asset classes, technical analysis, chart reading, trade management. It's all covered in our professional trading series. You can watch it at your leisure, never expires. And we normally retail that for $9.97. That's bonus number 1. You're also going to get bonus number 2, which is my most recent ebook, How to Create Risk-Free Trades. This is a money management ebook that walks through different tactics to mitigate risk, and even in some cases eliminate it from your trades. We retail that for $97, but it's also yours as part of the package that is retail valued at over $4,700. Okay, we are offering a very steep discount here. So over the course of a year, this will save you 88% off the retail value. You can literally get everything you see here, including our weekly relative strength picks, for just $49 a month. The link to do that is altostrading.com/RS2025. We are limiting this at the discount to 20 seats. So you can still get any of these things once those 20 seats are scooped up. It will just go back to the retail price. And just for the relative strength service, we retail that for $1,499 a year. Okay, so if you want to lock in that discount, altostrading.com/RS2025, you get everything you see here in the package. It's just $49 a month. And we designed this for everyone from beginners to seasoned traders. Okay, people who work full-time, part-time, or maybe retired and would rather be out doing something they enjoy versus spending hours and hours doing all the legwork and research to find these opportunities. We have traders all over the world. In fact, as I mentioned, we have students in over 100 countries across the globe. You get to decide, which picks you want to trade, what your position sizing is, what your risk tolerance is, all of those things. Okay, so you're in full control. Your account size really doesn't matter. You just can adjust your position sizing, again, relative to your account size, your risk tolerance. You get to decide how many shares you want to trade. This is designed for traders who want to learn to trade on their own and for those who want to be spoon-fed. So I obviously provided you with the full 4-step system, the formula. You can certainly do all this on your own, but we're also here to help support you. And if you just prefer to not do the work and let us do it for you, we're here to do that too. Okay, so I want to welcome everyone who's joining now. I'll give you just a quick rundown of what will happen next. So you're going to automatically be added to our members list and then directed to our Trade Alert membership registration page. You'll register and then you'll receive a confirmation email in a few hours confirming your access. You're going to get exclusive access to the members only portal. That's where you're going to find your bonuses, your professional trading series online course, everything that I just walked through in the package. And then you're going to receive your very first alert this coming week. Okay. And then also the 2 bonuses. Okay, again, these will be found in the members area. So our professional trading series. And in the interest of time, I won't go through all the details of this, but it's now over 10 hours of content. My latest ebook, okay, that's bonus number 2. Again, that'll be in the members area. And then I have a guarantee. If you're not convinced this is the best strategy for you, we do offer a full 30-day money-back guarantee. Okay, so just let us know, no problem. I realize life gets in the way sometimes, or you may find another interest, or maybe decide that this isn't a good fit for you, and that's fine. Just shoot us an email. We're happy to give you a refund. All right, so I have a few questions or a few minutes left. I'm happy to take questions. I will also give you our contact information here. Our email is support@altostrading.com. Our offices are closed, being that it's the weekend, but our toll-free number is 800-895-9348. You can call us anytime, Monday through Friday during business hours. And I will go ahead and take a couple minutes to answer any questions. So if you have any, please do put those in the Q&A box. Let's see, and I'm gonna have to just back up a little bit here, make sure I'm not missing anything. Let's see. EJ asked how to use the 3 EMA with the relative strength. Okay, good question, EJ. So that is one of the inputs that you put into the formula. So there was a line in the formula that included the EMA length, and you just plug that number in to that formula. So you just put in a number 3 basically. Let's see. Al asked, are you trading these trades with your money and at what allocation percentage? So yes, I do trade my own personal trading account, and I do use this methodology and system to place trades. I also do this in my hedge fund. I think I mentioned that. So there may be a difference there, but in my personal trading account, I don't necessarily have because the question is, what are my allocations? I don't have a fixed allocation percentage. It's going to be based on market conditions, volatility levels, and a number of other variables. But I guess I would typically allocate maybe 5 to 10% of my overall portfolio to any single opportunity. Let's see, I just have about a minute left. Cloud asked, what is your percent winning rate? Yeah, again, about 85 to 90% of these historically over the past, that's roughly maybe 5 years, have gone in and hit their initial 5% profit target. Let's see. It looks like I just hit my time. I'll quickly throw up our contact info one more time if I didn't get to all the questions. But want to thank all of you. I hope you got a lot out of the session today, and want to thank Anthony and their team for having me on. As always, it's a pleasure to be here. So Anthony, back to you.
Thank you so much, Jeff. That was a masterclass in finding breakout stocks. Jeff's system and special offer are available right now in the chat box, so have a look at that. Seems like a great deal. Our next speaker is Chris Vermeulen of the Technical Traders. His topic, how to trade today's cycles and trends for stocks, commodities, bonds, real estate, and the economy. Chris will show us how to decode larger market cycles and make smarter, longer-term trading decisions. So welcome to the show, Chris.
Hey, thanks, Anthony. Can you hear me loud and clear?
I can hear you. Thank you so much.
Perfect. All right. Well, welcome everybody on a Saturday afternoon. It is a cold, dreary day where I am in Canada, but perfect day to be indoors and learning. So today I want to jump into how to profit from bull and bear markets in stocks, gold, real estate, all kinds of things that are unfolding in the economy. And I want to show you a way that I use a strategy called an adaptive compounding strategy that allows us to pretty much hold only assets going up in value and be able to profit from both rising and falling markets. There's always something going up or a way to hold something that'll pay us a return no matter what the markets are doing. And so that's what I'm going to walk you through and show you some of the realities. This is a lot different than what Jeff just shared. Jeff's always got great presentation. He's focusing on options and I think 5 to 20 trades a month. What I'm focusing on is kind of the other side of the spectrum. Somebody who likes ETFs, we have 5 to 15 trades a year. And this strategy is around managing large portfolios, your retirement accounts, and how to protect it without giving up any of the gains. In fact, how to make more gains with a lot more protection and ways to profit from all market conditions. So it's the other side of the spectrum, and you're going to show you some pretty interesting things that are unfolding and why now is such an important time in the markets to protect your capital. And more so, if you protect your capital, you're also protecting your lifestyle, your retirement, and that is what I'm focusing on here. So real quick here, let's get this disclaimer out of the way. Access to this webinar is for educational and informational purposes only. We provide educational services that are meant to teach you the risks and reward of trading and are not implying or guaranteeing any profits. Past results are not necessarily indicative of future performance. Trading securities and options involves risk, so do not trade with money you cannot afford to lose, and consult a licensed broker or financial advisor before placing any trade to ensure it's suitable for your personal circumstances. So again, I run a financial newsletter. I manage my portfolio, and I share with people of my newsletter the exact ETF trades I'm doing, my portfolio positions, allocations. I send you every trade alert that I'm going to do, and I take the same trades at the same time as everyone else. And so that's how we go about doing this. So more or less, I can help you if you're worried the markets are topping. If you are close to retirement, you don't want to give up 3, 5, 10 years of a roller coaster ride, potentially no gains, all that stuff. Obviously, that can lead to running out of money if you're in retirement and you have no returns, or lose half of your portfolio in the upcoming financial crisis, which it's just a matter of time before we have another one. I can help you there. And if you or your advisor don't know how to protect and grow your money through all types of market conditions, because there are 4 stages through the markets, obviously bear markets are the most deadly, or a financial reset, then I can give you a hand there. So a little bit about myself before I get started. I'm located just north of Toronto, up in Canada, married, 2 kids. I'm an entrepreneur. I have multiple different businesses, big into real estate as well. I'm an inventor. I've patented and licensed products. I have been a technical analyst since about 2000, and I would say 2001, 2002, after I learned fundamental data does not work in a bear market. You can own the best companies in the world, growing by leaps and bounds, but your investment just gets cut in half and then gets cut in half again. And really, it comes down to price action and identifying trades, turning points, all of that stuff. And the market, just as Jeff was talking about, it's all about following price action, momentum, and taking advantage of different size waves. I'm looking for larger waves that roll through the markets, and that's what I'm going to show and kind of teach you today. So I've been involved in the market since 1997, and I've been lucky enough that I more or less semi-retired at the age of 27. I built a dream home on the water. We've got pool, boats, dock, cabana, all of that stuff. We travel. My wife and I, Kristen, my son, Ben, Mirabelle, my daughter, we do all kinds of activities, horseback ride, dirt bike, travel, fish, you name it. And all of this was accessible because I was able to protect and grow my capital through the bull markets and generate big returns in bear markets as well. And then, of course, that really allows you to compound your growth very quickly when you profit from markets going up and down. So that's what allows us to do what we want to do in life and be able to have that freedom. Now, if you haven't seen me, I'm on a lot of different places, a lot of different TV stations and channels and things like that. I've been a contributor since about 2001 to many financial stations and sites, so you may have seen me around. And more or less, if you have seen me, then you know I am always talking about we need to be prepared for a bear market. One of these things are coming. This is the 2000 tech bubble in the S&P 500. This was the 2008 financial crisis, which went even lower than the low of the tech bubble. And you know, it's losing money isn't the end of the world. And as I'm going to show you, we don't have to lose money. In fact, we can profit from falling prices very substantially and make money on the way up. But the most important thing here is this line right across here. 13 years of no returns and one heck of a roller coaster ride. This is like the perfect storm for somebody in retirement or near retirement, because you lose half of your wealth twice in this particular scenario, and you just went, 13 years with no return. And that is what I want us to avoid. So I'm going to show you how we can take advantage of all of these market movements, profit on each direction, and not have any wasted time. And that allows us to compound our growth much, much faster going forward. Now, I want to kind of touch on a few things that are slowly building up to tell us we are getting very close to a major market top for stocks, for the economy. I think we're coming into a global reset. And gold here, this is the monthly chart of gold. We've had a couple scenarios, super cycles kind of play out here. And what happened back over here in early 2000s when gold broke out of a base, started a super cycle to the upside, it eventually went sideways and went dormant for a couple of years. And while gold went dormant, everything else was going ballistic. This was 2006, 2007, early 2008. Stock prices were through the roof. Everyone was piling into real estate. It was bubble feeding frenzy in those investment worlds. Eventually, we saw gold just come out of that big bull flag pattern, start to scream higher, and it became the #1 top performing asset class. And that's because people around the world, savvy investors, felt and could sense something was about to happen. They didn't feel safe around in the financial systems. They felt bubbles were there. They wanted to get their money out of the financial system and protect it. And so they move into physical gold. And so when gold starts to rally, that is a global barometer saying this is not just like, I think what's coming isn't just some little reset. There is something big financially that is going to break, and there's going to be like a massive shift in how the world functions and things like that. And so this was the 2008 financial crisis. Gold will fall with the markets. Don't get me wrong. It leads into it, but it still collapses and will fall with the markets. Now, in 2019, we started another super cycle. We broke out of this multi-year base, started to go higher, and then what happened for several years? The stock market took off, housing prices took off, bubbles everywhere. It was a feeding frenzy, and as we know, everyone piled into the stock market thinking it was easy money. And really, in the last 6-8 months, we've really seen gold break out and explode higher. People are getting nervous. Something big is about to break, and I think we're going to have another global financial crisis. I like to look at planet Earth almost as a hive mentality, and gold is that barometer of fear. And so when gold starts to shoot higher, it's telling us the whole world feels like there's going to be a financial shakeup. And so this is an early warning sign that something big is brewing. Now, I came across this interesting chart. So I was playing around, and I went on Google search trends, and it was interesting. The top chart here is the monthly chart of the S&P 500 during 2007-2008 market top. And the bottom chart is kind of where we are right now. We've got 2003, 2004, and here we are beginning of 2005. I need to update this chart with the bounce back up here. But overall, if you take a look at the search terms for the term bear market, it spiked up when the S&P 500 had that first sharp break to the downside. And we had this first sharp break to the downside early this year, and we saw the same thing, a big spike in fear of people searching up a bear market. And it's funny because a lot of people are saying, hey, well, everybody already thinks we're in a bear market and the sentiment is super bearish, then we're not going to have one because everybody's already sold. But keep in mind, this cycle that's at play is way bigger than just a stock and people thinking it's oversold and it's gonna go down. This is a global cycle. And it's just like, for example, if you think of the ocean tide and say, you know, tonight at 7 p.m. is high tide and then the tide's gonna go down. Well, just because we all know it's gonna go down doesn't mean it's not, right? These are cycles and tides around the world, global economic tides that don't just change when a bunch of people search a term, and the majority of people are nervous. In fact, it's the start of something much bigger where they go through waves of searching the same thing each time a new bout hits. And so that's kind of, you know, another shot across the bow, a warning sign that, okay, the tides is slowing. We're expecting some type of bounce up and sideways for a few months before the market starts to sell off and go down in a big way. And so that's something we need to be aware of. And we've already had part of this bounce. We're already bouncing up near all-time highs, kind of like a bear market rally to some regard here. And then I think we're going to go lower. And then to zoom it in a little bit closer, if we just look at seasonality-wise of the S&P 500, typically from January right to the end of May, beginning of June, which is, hey, right where we are right now, typically the markets start to run out of steam and we start to see it go into the summer doldrums, and we start to see a pivot low in October. And so that's kind of where we are right now. The stock indices are trading near all-time highs, which is resistance. We just had NVIDIA have good numbers. Both NVIDIA and Apple shares rallied huge this week. What happened on that gap up? Massive selling. The general public piled in. You could see people buying, feeling the market is going higher. People have been loading up on ARK ETFs and uranium stocks and all kinds of high growth, small cap stocks. And that is a sign that people are bullish. And so the general public piled in this week on Apple and NVIDIA on that good news. But if you look at the volume intraday on those, which I don't have on me at the moment, it was huge institutional selling. The institutions are selling and handing off shares to all the retail traders who are bullish. And we're going to get into the mindset of the retail traders and where we are in the cycle right now. And so that is a very bearish sign. Not only is institutional selling, but seasonality wise, we have like a week left or so and this market could run out of steam and be done. And put in a major market top and sell off for potentially 6, 8, 12 months or longer. And so I break all the analysis down and I have this risk on, risk off chart. Risk on means the stock market is favorable. Risk off means the technicals have changed, the sentiment has changed, the money flows have gone negative, money is moving to various different assets. Now, while this is a 30-minute chart, I have the same thing for the monthly and weekly chart of the S&P 500 for the same spectrum of, are we in a bull market? Are we in a bear market? And I really try to make it as simple as it's red or green. It's pretty basic, easy to understand. And we use these signals for our portfolio positions where we trade 1 or 2 ETFs at a time and manage our entire portfolio in a very controlled way. So let's jump into market structure. Now, there are 4 stages to the markets, and there are actually 4 stages in price action in general. It doesn't matter if it's a yearly chart, a daily chart, a 1-minute chart. It doesn't matter if it's stocks, commodities, currencies. Everything has this cycle that goes through it. A stage 1 is a base. It's bottom. It's trying to find a bottom. It's shaded red because it's dangerous, meaning it's random, it's sideways, and it's wasting your time. You're better to find something in a stage 2. Stage 2 is a bull market phase. Something trending up, it's green because we make money in trends. Stage 3 is red because it is kind of like a stage 1. The market doesn't know what to do. It's sector driven. 1 week, one sector's on fire. The next week, it's the worst performing sector, very choppy. And then a stage 4 is a decline, a financial reset, a bear market. And I have this shaded green as well because it's a strong trend. We can make the same amount of money going up and we can make the same amount of money going down. Believe it or not, in a falling market, as we know, the market usually takes a staircase up and the elevator down. Falling markets, you can make a lot of money very quickly. And it's a very different feeling, very different way you need to trade a falling market. And I will show you how we go about doing all that. But overall, that's where what we need to be aware of. I believe the stock market and the housing market and the economy more or less are in various stages here of this stage 3 topping phase, and everything is about to go for a bit of a swan dive. So if we were to take a look at the market participants' emotions. So obviously when we start into a new bull market, everybody's optimistic, and then eventually things take off and everybody's in full on belief and they start piling into stocks. They're making tons of money. They throw their money at everything that's fast moving. They think they're a genius. And eventually the market has a reset and puts in a top. And most people just become complacent. They're like, all right, we just got to let it base and it'll continue to go higher. Problem is, most people don't know what they're doing. They don't understand when major tides are changing in the markets, and eventually starts to break down, and these people start to have anxiety. Now, what I'm going to show you and what we do with the strategy that I have is we are able to replace all of these with all of these. So as people have anxiety saying, I can't believe I'm down this much. I can't believe I have margin call. I can't, eventually things fall enough that they're in denial. They're like, I'm down so much, I can't sell now. I just have to ride this out, unfortunately. And that's the point. This is a turning point where people make the wrong mistake of holding on, thinking they're down too much, versus taking the loss and being able to use that loss to write off against future gains. They hold until they hit the breaking point where they say, if this market falls anymore, I'm going to have no retirement. And eventually they panic out, they get out, and they've lost their money and they're in anger and depression. Now, if you're a technical trader like I am, and we have rules in place and we track price action, instead of anxiety, we're optimistic. We're like, wow, this might be the start of a bear market. This is going to be good. We can not only profit from falling markets, but then reinvest in new things when a new stage 2 starts, and we'll have even more money to invest. As people have denial, we're in full-on belief. We're like, no, this is full-on bear market. This is epic. And then as people are panicking and going into depression after losing their shirts, we know that it's coming to an end, but we are like, it's like taking candy from a baby. The markets are falling. We profit from falling markets through some inverse ETFs, and we can take advantage of that. So right now we are in this red zone up here, peak financial risk. Any money you invest right now, you're probably going to have to go through a downward cycle, suffer a lot of pain before we get a whole lot further. So as I kind of keep mentioning kind of these waves and the tide in the market, this is a big misconception. I think a lot of people say, oh, I'm good, I'm diversified. I have, tech, I have the S&P 500, I've got these sectors and these individual stocks, I'm spread out, I'm good. Well, what people don't understand is a stock is a stock. I don't care if you hold 7,000 stocks and hold every sector or whatever, they're all the same trade. When the stock market is in a rising tide, a bullish environment, just like a rising tide in the ocean, which If the tide's going up, what's happening to every boat? They're all going up. Well, the stock market's the same. If we're in a bullish phase, you want to own stocks. Great, knock yourself out. If we're in a falling tide environment, diversifying between a bunch of other stocks is actually very dangerous because on average, they're all going down. And what people don't realize is if you move into a sector ETF instead of, say, the index, sectors fall a lot more than the stock market does. And then a lot of people also go and buy a bunch of their favorite stocks. And an individual stock is even smaller than a sector. And when the bear market hits, those individual stocks all fall a whole lot more than the actual sectors and the indices. So people who are diversified lose way more money than somebody who just owns the stock indices and like has the stock buy and hold bond portfolio. People who get active and hold a bunch of different stuff actually lose a lot more money because of their diversification, thinking they're diversified, but they're actually putting a bunch of ticking time bombs, grenades into their portfolio. So it's really big to understand. This is a weekly chart of the S&P 500. This is right after the COVID crash. We can identify when to hold and buy, when to be out of it, when to be in. And we can zoom in on shorter term charts, which is what this ACS, this adaptive compounding strategy is. This is this year in February. Our strategy said, hey, the stock market is telling us to get out. The trend has stalled. The technicals are now, momentum have turned down. Money is flowing out of the stock market. And our strategy says you have to get out because it is no longer going up. And what happened is the market collapsed, set 20% plus. We were able to not only avoid it, but we were in a position that went up in value and continued to grow our portfolio while everyone rode this crazy roller coaster ride. Eventually, the market stabilized, showed some strength, and our strategy says, hey, get in. We've hit our first target. Now it is sitting here trying to figure out if we're going to have another push higher or if it is eventually going to stall out, turn red, and kick us out of that trade. And so these are the type of waves that I like to play in the market. And to get an analogy of the type of waves we play, think of like a surfer off the beach in the ocean, just floating out there past where the waves break. What is that surfer waiting for? He's waiting for a set of those waves to roll through, and you can see them coming from a distance. Well, the stock market and different asset classes have about 5 to 12 waves that roll through the market every year. And these surfers, just like what we do, we're more or less surfing the market. When these strong waves roll in, we pick the one that meets our risk criteria, that we know inside and out, that we understand. We hop on that wave, we ride that wave. And the nice thing about catching a strong wave is we also know when it's actually starting to weaken. We know when to trim profits. We know when to move our stop up. We also know when the trend is actually, it's starting to curl and break, and we can just get out because the trend has ended. It doesn't have to hit a target or a stop. It just, if the trend loses its momentum, just like up here, it will end before our protective stop will kick us out of there, our trailing stop. Now, if we were to take a look at the QQQ, this is 2022. This is the bear market phase on that weekly chart I showed you. You can see uptrends are very short-lived. Some of them don't even work. The majority of the time in a falling market, a tide going down is red. And we want to make sure we're holding something that as the market is going down and it's red the majority of the time, we're in something that's going up. So you can play during this window here, the stock market fell like 25%. The US dollar index, which is a currency play, an ETF that we do play, it actually rallied almost 18% to the upside. You could trade inverse ETFs, like you can do a lot of different stuff here. And so we can identify this. This is pure technical analysis that blends in technicals, cycles, and sentiment. We track about 11 different asset classes, money flows, and things like that to know what people are doing. Our strategy is more or less allowing us to look. It's like playing poker, but you get to look over the shoulder of your opponent and see what their hand is, and then we see what they're doing with their bets, their money, and we're able to just totally take advantage of it, being kind of like looking over their shoulder and playing against them. So that's what I focus on. The key to success, though, is managing your risk and positions. Most people don't do this, and there's no doubt you will always underperform and lose money in the long run if you don't know how to do this. And the strategy that I share, we manage all this. We do all the legwork for you. We help you with position sizing, like how much of your portfolio to put in for each trade. We take partial profits. That's what creates consistent returns. You do have to pull money off when you're winning. That reduces our risk and exposure because you never know when the market's going to roll over. And of course, we need to exit positions. We need to put in losses. We actually need to take the loss. The biggest problems with most traders and investors who are self-directed is you get into a winning trade and they don't want to get out because it's working. That usually will eventually backfire because markets will usually turn around and correct in some way. And then what happens is when people are in a losing trade, they say, well, I'll just wait for it to come back. It's such a terrible view of the market, and they end up holding on to it. So they won't get rid of a winner, they won't get rid of a loser, and it ends up being a dead position they have in their portfolio for years, and they could have just, actively played the markets. And so this is what I really focus on. The key to making money is managing positions and managing your risk. When things are volatile, strategies need to change and compensate for volatility. Either become smaller positions or larger positions of your overall portfolio. So I'm going to show you how we go about holding only assets rising in value. I use this thing called an asset hierarchy. And this is an example here of the COVID crash. It's a perfect example of how we can walk through the markets without panicking and freaking out. And because we have a plan, there isn't really any real stress or anxiety because we know exactly what to do way ahead of time. We know how every trade has to be managed no matter if it works out or not. And so the hierarchy here, this example is the SPY on the top, this is the daily chart, TLT, which is the long-term bonds, bill, which is just a cash type of position. You earn daily interest and it pays out a cash dividend every month. And so the stock market, just like we saw this year actually, the stock market gave a sell signal saying to get out, and then the stock market crashed about 34%. So we got out of stocks, and our strategy at that point, as we go down this hierarchy, which I'll show you, our list here, it said to get into TLT, which was in a very strong uptrend at that time. We moved into TLT, it rallied over 19% in 9 days. It actually gapped up above our 15% target, gave us a 19% fill. It closed out the trade because it hit all of our risk criteria and our target. And then it moved us into a cash position. And so we just collected daily interest while everybody was going through the COVID crash. And this, people were losing their shirts, panicking with their financial situation and having to deal with COVID. Well, we just got richer than we'd ever been. And during the most volatile time, we were in cash and could focus on our lives, our safety, our health, and just, keep a much more calm perspective on things because we don't have the money side freaking us out. And then what happened is the stock market got another buy signal. Our strategy says, hey, things have stabilized, money's flowing back, get back into the market, and we rode that up. So this is what a trading strategy that bases around a hierarchy and rules allows us to just navigate through it. And so the hierarchy looks like this. We have the most volatile stocks at the top, which is we generally want to be long the most volatile asset, which is the S&P 500 and QQQ. The more volatile it is, the more potential there is to make money. As we go down the list, we've got bonds, we've got the dollar index, we got the inverse dollar. So it doesn't matter if the dollar is rising or falling, there is potentially a trade there. And then we have a cash position. As you can see, volatility goes down as we work through this list. And what sets my strategy and my mentality of how I attack the markets from everyone else is most people, when the markets start to crash and things are moving fast, they all tend to want to take advantage of it, and they buy options and they buy leveraged ETFs and they blow their accounts up and take huge hits. They might hit the odd good trade, but they usually end up losing most of it. And we do the opposite. As the markets get crazier, we get away from stocks, we might get away from bonds and currency, and eventually we'll go to cash. When things are nuts and wild, you're best to protect your capital. And when the market is good, then we move back into various assets to pull money out. And so if we do this versus what active traders do and chase things, or doing the buy and hold strategy, you can have a very dramatic difference in performance. And this chart here shows a good example of that. So this is the buy and hope or the buy and hold strategy. And this is the asset reinvesting strategy I'm going to be showing you here. This is both the same account. So if you had $1 million, and say you're withdrawing $50,000 a year to help subsidize some of your retirement. Now the buy and hold strategy from 2013 to 2022, this is the type of return you would have. You'd have withdrawn $500,000 and you still have your $1 million. Problem is, as we know, everything has gone up 30 to 100% in real costs. So you really don't have the same buying power anymore. If you take a look at a strategy that is rotating into holding assets going up and profiting from things going down and just earning cash when nothing makes sense and just collecting daily or monthly interest, we end up with a much higher return, 3 times the amount of money, and a very little amount of risk and stress on our system. This strategy here has us in cash 30 to 40% of the time each year, meaning half of the news and hiccups that hit the market doesn't even affect us because we're waiting for another wave to roll through the market. Whereas the buy and hold strategy, you are riding every news dip and blip and tweet from the president and tariffs and all that stuff, and you're definitely underperforming because of diversification, and chasing pricing is a very dangerous strategy in a nutshell. So like that's kind of how the strategy starts to unfold. And if you focus on this is the type of curve that we get, which is a consistent growth strategy versus the S&P 500 and the buy and hold strategy. And the biggest value here, it's not about, I focus on people generally who have a lot of wealth, usually are 45 plus or in retirement. You've got a lot of a large account size, and you value consistency, and you value your lifestyle and your time and your stress. So, while we have good returns compared to the other strategies, this is the most important thing. The max loss, the max drawdown our strategies has from the 2008 market top, when the stock market fell 57% or 54%. We had multiple 34%, 25%, all of these corrections. We had less than 6% loss, meaning you can sleep at night. Whatever Trump does, whatever any president does, or news event that hits, it's not going to affect us because we manage our risk very tightly, and we have a game plan in place. So this is the most important thing. This is like, you can sleep at night, you can go spend money and not worry about running out of money in retirement. That's what makes this so powerful. And that's why this is what I use with my own capital, and preserve your lifestyle no matter what's going on. So in a nutshell, I have a couple of books that you could always look up if you're interested in, but I do want to touch on a couple of things here on the live charts just before we jump over to potentially a housing bubble. So if we were to take a look at 2008, so the left chart here is the 2000s, well, we go all the way from 2004 to 2008. This is the 2008 market top. This candlestick chart is the S&P 500, which you can see right here, SPY. The yellow line is gold. Now, what's really interesting here is the stock market in 2008 put in top, and then it put in another double top with a nominal new high, really making everybody get very, very bullish. And then the stock market corrected about 20% to the downside. And what happened here is the stock market started to get weak. Our strategy actually got us out very early in that strategy, and what we saw was gold shot higher. Even before the stock market put in the final top, gold had already started outperforming, rocketing higher, and then kept on going. As the world was starting to say, hey, something bad is brewing here in the financial system, in the markets, and in the economy, something's going to break. Well, if we take a look at where we are right now, we have the S&P 500 put in a high. We also put in a nominal new high right over here. This is just February this year. And then we've gone into this, this 20% correction, very similar to 2008. And of course, gold shot up even before the markets broke, just like over here, and continued to go. And so gold is giving us another one of these warnings saying, hey, people are worrying about what's going to happen. Savvy investors are saying, get me out of the financial system. Give me a bunch of pet gold rocks, because I don't trust the banking system. I don't trust stocks. I think the housing market's going to blow up, all of this stuff. And so that is what's happening again. And if we were to take a look at what happened in 2008, and let's just throw the dollar in here. Take a look at the dollar index. Now, this green line's the dollar index. No one wanted the dollar. Everybody said it was going to go to zero. They've been talking about the dollar collapse, the fiat currency blowing up for 25 years since I started trading. Nobody trusts it, and it keeps going. Nobody wanted the dollar. Everybody wanted gold. Well, if we take a look at where we're at right now, the dollar is down in the lower right-hand corner. Nobody wants the dollar. They think it's going to zero again, and everybody wants gold. And people are bullish on the stock market. They're in that complacency phase, thinking that we're actually going to continue to go higher. But really, I think the market is getting close to rolling over. And then the people are going to get into anxiety. They're going to lose so much. They're going to be in denial how much they're down. And then they're stuck in the bear market trap and the retirement kind of trap of giving back half of what you owe or have earned, I'm sorry, and really struggling with the retirement. And so that's kind of the scenario where we're at. If we take a look what happens in 2008, and we just scroll forward, the market eventually rolls over, sells off, and it just keeps on going. It ends up falling about, I think the S&P fell about 57% from the high to the low. That is pretty devastating. And there's ways that we can profit from these legs to the downside. Now, this is the weekly chart, so it's squished in there pretty tight, but I believe we're about to do something very similar. Whether it happens or not, it doesn't matter because we follow price and we just follow along as it goes. But you better be prepared, because if it does happen and you have a large account and you're in retirement or close to retirement, this is going to blow up your advisor account or your own self-managed account, and you are going to regret avoiding it. If you don't avoid it, best case scenario is you just move to cash and you collect 4% interest for the next year. Worst case scenario is you don't do anything and you lose half of your portfolio and it takes 5 or 10 years to recover. The best scenario is actually to take advantage of falling pricing and be able to reinvest when the stock market hits a major bottom, and then be able to catch bull market that lasts many, many years after that, and reinvest into dividend stocks and all of that stuff. In fact, I bought a dividend ETF. It was early in 2009. It was paying 16% dividend, and this was on the TSX because I'm up in Canada, but it paid 16% dividend because the stocks were all beat up and had fallen so much. Not only did it make 16% return, but the ETF doubled in value over the next year. So to not only grow your account and be richer than you've ever been when everyone else has lost their shirts and businesses have gone under and people are unemployed, and then you can invest into something where you're getting paid 8, 10, 15% dividend, and you have potential for hundreds of percent upside return over the next few years. On top of that, it's pretty amazing. Those who ride all this down and take years to come back will it's just not the same experience, I'll tell you that. What else is there? I think there was something else I wanted to take a look at. I think I'll leave it at that, and I'll just jump over to the housing stuff, because we're all investors. We probably all have a house or two, or commercial property or industrial. I'm big into self-storage. I have multifamily. So it's important to understand what's going on in the housing bubble, and I think we're going into number 2 here. This chart's a little bit outdated, but it continues to push higher. But the monthly cost to buy a house right now is ludicrous. It's way above the average kind of trend line trajectory. 2006, 2007, it was way up outside of its norm. Obviously, we are even further out of that now. So this is definitely a red warning sign. The housing market is going to start to have a big correction. Homes in southern United States, that's kind of like Florida, Texas area, there are more single family homes for sale right now than there were from the last housing bubble. So there is a ton of homes for sale, tons of supply, and the pending home sales, this is how many sales have been closed and are pending waiting to close, is at a record low. Tons of homes for sale, nobody wants them. There's, I think, several reasons for that. One of them is our mortgage rates have jumped. We've seen rates skyrocket. I think interest rates are going to stay for quite a while. I think they could actually push even higher. Not good for home prices. The people who I've been talking to, I talk to a lot of real estate individuals who own real estate and real estate agents. People who are trying to sell some of their rental properties right now, or their vacation homes, just to trim and clean things up, can't sell them. They have lowered the price. Some of them have lowered multiple times, and they're not even getting offers. And this is the big problem. And almost everybody I've spoken to in this scenario, they just said, yeah, we listed it for like 4 months. We're just going to rent it out and just keep it. And that's because these people are successful. They're just trying to reduce their portfolio exposure and volatility, but they don't care. If they're cash flow negative on a house for a few months or something, it's no big deal. The problem is when the general public start to actually run out, the people not quite so financially fortunate have to start to sell. They lose their job or fewer hours, or one spouse loses their job, they can't afford the house. Mortgage delinquencies and credit card delinquencies are jumping. Once people have to start selling their homes, that's when things are going to get pretty ugly. If we actually look at the commercial mortgage-backed security delinquency rates, we're already at and above that of the worst it was back in 2012. And the banks are keeping this hush hush. Nobody wants, everybody's keeping it quiet. This system is breaking down and nobody's flagging a red flag anywhere saying, guys, look out for this, which is why I'm trying to share this. Things are about to get very, very ugly in the housing market. And if we take a look at single family homes, price peaked out in 2022. They've been drifting lower. And the scenario here is everybody still thinks their homes are worth a lot more than they really are. Nothing is selling because the homes aren't worth that. The homes are worth way down over here. And until the price comes down here, they're not going to start selling. Numbers for real estate don't make sense still. Yes, they've come down quite a bit, but not nearly enough for them to be a good, viable financial investment long term. The numbers just don't work. And so all these people here, the reason things aren't selling is because the fortunate people they're not just going to give their house away. They're going to just keep it because they bought it years ago, most likely, and they're going to keep renting it. But eventually we're going to see this unwind. I think we're going to see the housing market fall 15 to 20% in a very quick, swift downwards dive here once things turn. So that's kind of it in a nutshell in terms of where that real estate play is. And there is a way to attack the real estate market from, if you are a smaller investor. IYR, this is an ETF for the real estate space. I'll just jump to the weekly chart. And I know, a lot of people want to get into real estate. Some people just can't afford it. But if you were to look at an ETF, for example, now real estate ETFs are very, very dangerous. They fall sharply. They do not fall like real estate. A pullback in real estate of like 10, 20% is generally pretty big. Real estate ETF can fall 77% or more. It's had many big 20, 30, 40% corrections. But where this is interesting is after the housing market flushes out and sells off, and the stock market cleanses out, you can buy these ETFs and you can build your own real estate portfolio with ETFs. There's ones for self-storage, there's ones for single family, or not single family, but multi-family. There's all kinds, international, and they all pay dividends because they have they're rentals, right? They have cash flow, they're positive. So people can get into the real estate market and build their portfolio. They could buy, $1,000 worth of this ETF, or 10,000 or 100,000. You don't have to commit to buy a house, and you can have the share price appreciate. Just like it can fall 75%, real estate ETFs can rally hundreds of percent to the upside. So you can take advantage. And what's really interesting is, imagine if you actually profited from the collapse in real estate when it does fall off a cliff. Let's just zoom out to where we are right now. You can buy inverse ETF or short an ETF on real estate. When it unwinds and sells off, you can profit from the collapse that we have, I think, pending in the real estate space. So that's just another kind of aspect of the market, the side that's going to affect us, because once people start losing money in their stock portfolios and it starts dropping, and then they realize their homes are worth hundreds of thousands less, it starts to spook people, and usually people will sell their stocks first, which is why the stock market usually falls first and before the real estate market. Really, real estate's usually a little more delayed. Stock market crashes, and then home prices continue to go weaker and weaker a little bit after that. So anyways, that's kind of the strategy that I share here. It's called the ACS strategy, and why it's time we should invest right now. So the ACS strategy, the adaptive compounding strategy, this is an end of day trading strategy. So I do a weekly update, I do weekly and daily updates now of what's going on in the markets with videos. I walk you through the markets before they open if you want to be that active. Again, there's only 5 to 12 trades a year. We get a signal at the end of the day, so you get an alert in the evening if we have a trade, when we have a trade. And then you have all night and all morning to just set a market order to enter to buy like SPY tomorrow at the opening bell with an allocated amount of your portfolio. So it's very, very simple to follow. It doesn't get a whole lot easier, to be honest. It's like usually one ETF position as we move through the market. So actually generally be two, because we'll usually do the SPY and the QQQ. You can have it auto traded. We have a brokerage firm that'll automatically execute. This is free of charge with the special offer here for Traders Corner. So if you just want to move some money to that brokerage and just have them execute the exact strategy I do with my account, then you can do that. If you want to learn technical analysis and really dive in, there's 7 hours of technical analysis video courses. And of course, we do 2 live mentoring sessions every month where we get on and you can ask whatever questions you want. We can go through the charts. We can look at whatever it is you want to look or learn about. We can cover all that. So generally, it's about $6,200 value. You have this subscription right now for the year. It's $2,500. You can access this at thetechnicaltraders.com/exclusive, and that'll get you this package. Now, asset revesting, if you are interested, I do have a book on asset revesting. If you want to learn this strategy and see if it's kind of right for you, learn more about it and the benefits of it and what we do. I really scratch the surface at a very high level today just to show you the threats and things we need to be aware of in this market. This strategy will get you there. My other book, Technical Trading Mastery, which I kind of skipped right through here, which is battling constantly for bestseller for online trading and for financial management. This book here, if you really want to learn the markets and learn these short-term trading signals, that book on chapter 10, 11, and 12 will teach you how to identify oversold market conditions for bounces, how to identify panic selling levels when we know there's going to be panic selling and these exhaustion gaps the following day, when to play these gaps. It's going to tell you how to identify trends from downtrends to uptrends in the markets. And of course, we have FOMO indicators. So in a falling market, when we have FOMO indicators, will tell us when to actually sell, where the short-term highs are. In a green trend here, it's these panic lows. These panic selling indicators tell us when the markets are hitting lows. And depending on the level reading, it tells us if it's the low for the day or if we need to wait the next day for the exhaustion, for the panic to carry overnight, and then watch it gap lower and go higher after that. So all of that is in Technical Trading Mastery book if you want to learn how to trade the 30-minute chart for the S&P 500 and the Nasdaq. But anyway, that's our whole package here. If you want to take advantage of your future and not have to worry about what's going on with tariffs and all that stuff and just ride the markets higher or lower, it doesn't matter. Go to thetechnicaltraders.com/exclusive and you can get all of this in a bundle. So, all right, I'm a minute over here. I'll give it back to you, Anthony, if you want to take the screen. And if you guys have any questions, send us an email, go to our website, and we're here to answer any of those questions you have.
Great. Thank you so much, Chris.
Yeah, no problem.
Excellent. Yeah, that was really great. Really enjoyed the later half of all that, and I'm going to check out your book as well. Thanks for helping us zoom out and see the big picture. Everyone, make sure to grab Chris's offer in the chat box. I put it in there for you. Chris, thank you so much. We really appreciate it.
Thanks, everyone. Thanks, Anthony. Take care, everybody.
Thank you. Closing out today's summit is the sharp and consistent David Wyse of Right Line Trading. His session, Advanced Heiken-Ashi Tactics for Profitable Trading. You'll learn how to smooth out market noise, reduce false signals, and combine Heiken-Ashi candles with other indicators to improve timing and accuracy. He's really great at this. Let's finish strong with David Wyse. It's all yours.
Thank you very much. Let me get my screen shared. Let's see if you can see it. I think you should be able to now. Yeah.
Sorry, David. I think we rushed you a little bit.
Okay, no problem. Can you see my screen now?
Yeah, we could see it.
Okay. All right, great. And I got audio on. Okay, great. Thanks very much. I appreciate it. Yeah, I was just I didn't want to step on anybody's toes here, so we're ready to go. All right, thank you very much for the introduction. I appreciate that. Thanks for everybody who is spending a Saturday afternoon here at the Traders Corner. Again, my name is Dave Wyse, and I have I run a trading room, an options trading room, a text alert service. we lean on a piece of software called the SPY Super System software that helps us identify when institutions are in the trades. So we're going to talk about those things today. We're also going to cover Heiken-Ashi candles. Don't know if you've ever used them or not, but they're very, very effective in entering trades and riding trends and knowing when trends are starting to stop. So I'll go into quite a lot of detail on Heiken-Ashi candles and how I use them to improve my trading. And we'll talk about the results we've had in the room and on the alert service over the last 3.5 years. The room has been going since January of 2022, and I'm in the room market open to market close 5 days a week. So not very many rooms that you have somebody who's in there that's actually going over trades and answering questions all day long from market open to market close, but we do. All right, so we'll go ahead and get started here. And the first thing I got to do, of course, is the usual disclaimer. All signals and trading opportunities we provide are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. Okay, so we'll get started. Again, if you have any questions, just put your name and phone number or your Skype username in the chat box or the question box, and Rory from Right Line will give you a call, and that's his number right there, and I'll show you this again at the end. And so as we get started here, this is a kind of a graphic representation of what the SPY Super System looks like. I run it on Thinkorswim. It runs on Thinkorswim. It also runs on Ninja, but we're going to be focusing on the Thinkorswim version. In this SPY Super System software, I'm going to focus on quite a bit. This tracks institutional money flow, lets us know whether institutions are in the trade or when they're not, and it's very important to understand that. If you're going to have an edge over other retail traders, you want to be in the trade when the institutions are in the trade, and you don't want to be in there when the institutions are not in there. Okay, and again, this is what the alert service looks like. We do SMS alerts to text. I'm also in the alert service, so I can make sure that they're going out to timely fact. They take about 10 seconds or so to get to your phone once I alert on them. All right, so now just a kind of a aside here. I just listened to Chris too, was excellent speaker, excellent information. And the difference between what I'm doing here and what a lot of other folks do is this isn't an investing strategy. This is a trading strategy. This is for retail traders who want to trade day in and day out and be consistently profitable in their trading. All right, so I cover every single webinar I do. If you've been into my webinars, you've probably seen this before. But we want to talk about what drives the market, what moves the market. The first thing that we need to understand is we're the little marbles here. We're retail traders. We are unable to move the market at all. If we're in the market trading, and the institutions, these are the institutions, this big marble, we're not doing anything except chopping price around. A lot of chaos as retail traders are in the market. This is the institutions, this is where the money is, this is what moves the market. These are, and you probably know, these are things like Goldman Sachs, Morgan Stanley, Bank of America. These are the investment banks, have billions and billions and billions of dollars. They trade all the time. They have two different ways to trade. They trade with humans at trade desks, which is a tiny, tiny percentage of their trades. Most of the trades from institutions are coming from algos or programs that are written. They're called algo trading, and this is where most of the trades come from institutions. And this is the folks that drive the market. Now, it's also important to understand that the institutions are also include pension funds. Pension funds have billions and billions of dollars. Police pension funds, firemen pension funds, state workers pension funds. All of those, that money is also in investment and trading. So that's part of it. As also is hedge funds. And there's hundreds of hedge funds, again, with more billions and billions of dollars. And lastly, there is things like Vanguard, T. Rowe Price, the mutual funds that also become part of the institution. So this is where the money is that drives the market. And when these folks are trading a stock or an index and they're pushing it in one direction or the other, this is what drives the market. And they need to be doing it in concert. There has to be enough of the institutions moving a stock or an index in one direction or the other in order for us to take advantage of it. So we as retail traders can't move the market. What we want to do as retail traders is we just want to be able to identify when the institutions are moving trades and when they're not. And we take advantage of that. That's what we do. That's what the SPY Super System software does. All right, and we'll talk about that. And then we'll talk about how we use Heiken-Ashi to even improve on that. All right, this is kind of a, it seems like a slide that's a little bit out of place, but this is a game of blackjack here. That's an ace and jack of spades. These are $100 chips. And the reason I bring this up is in my younger years, much younger years, it's important for me to understand, for me to let you know that when I was much younger, I made my living playing blackjack. Okay, as a card counter. If you may have heard or not how card is, may not. You're actually not tracking each individual card. You're keeping track of little cards and big cards as I leave the deck, because as the number of the cards that are left in the deck, the composition of what those cards are determines whether the person who's playing has an advantage or the house has an advantage. So anyway, this idea of tracking cards, this gave me a mathematical edge over the casinos when knowing when the cards were in my favor and then they weren't. When they weren't in my favor, I'd bet the minimum. When they were in my favor, I'd bet more money on multiple hands. All right, now, the reason I bring this up is, again, the question is trading stocks and options gambling? And if you've ever talked to, if you're trying to be a stock trader, an option trader, and you've talked to friends and relatives about it, this is what you commonly hear. It's gambling. They tell you it's gambling. And is trading stocks and options gambling? Well, it's very similar to that without knowing what the institutions are doing. The trader has no edge. So in essence, you're gambling. If you don't have an edge over the other retail traders, that's all it is. Now, the SPY Super System, which is the software that I'm going to show you, and we rely on, I call it my card counting system. This gives us an edge over the other retail traders, allowing us the ability to become consistently profitable traders. And that's why I point this out, is because for me, it's relatable, because I did this before. I've been a fairly numbers person my whole life, and I don't like to gamble. I like to trade with advantages. And again, the SPY Super System, in conjunction with identifying the best high probability trades, can lead to consistent profits. And we'll show you exactly how we've done that. I mean, the record has been excellent. Okay, now in the room and on the alert service, I have a couple of simple trades, simple rules that we trade by. Number one, we trade the best and we skip the rest. So this is sounds real easy. This is not real easy. We have to find the very best. But this is the most important part of this, because skipping the rest is critical. One of the big reasons that a lot of retail traders lose money is they overtrade. They feel like they have to be in trades all the time. And that's not true. We only want to be in the very best trades. We don't take a lot of trades. We only take the very best ones, right? So that's important. Let me just pop up here this question box. Okay. All right, let me just, I want to have the questions up so I can answer them as we go forward here. All right. Okay, Doug, what charting software do I use? I use the SPY Super System for my platform. I'll show you that in a minute. For my charting, I use TC2000, right? TC2000 is how I chart. Okay, all right, so basic, skip the best, trade the best, skip the rest. Very simple. We're just looking for the very best trades. We have to wait. We wait for the setups to come to us. Second thing is, our objective is not to make trades. Our objective is to make money. A lot of retail traders lose sight of this. They feel like they have to be in trades all the time. If they haven't taken a trade for an hour, they start to justify reasons to take trades, and it's a killer to your finances, to your account balance. So our objective is to not make trades. Our objective is to make money. And I suspect that most people want to trade. That's what they feel like their objective is. But this is what that's a lot of times, if you watch them trade, this is what they're doing. Now, maintaining discipline, this is really a critical thing here now. And I'm going to kind of differentiate it between a couple of things. Maintaining discipline, learn and follow the process. The process is identifying high probability trade setups, identifying when the institutions are trading them. That's the process that we've got. And maintaining discipline means only take those high probability trades with the strategies that we have known we know have been proven. So that's called the process. We have to learn the process, and then remain patient. And again, trying to get folks to stay out of trades when there's no advantage. We only want to trade when we have an edge. That's all. Okay. Now, as far as profitable traders, we do need an edge. And remember, we're trading against other retail traders. We're not trading against institutions. We're going to try to basically trade with the institutions. We're going to follow the breadcrumbs. So profitable traders need an edge. Our edges, and this is a big one. We have the SPY Super System software. This tells me when I look at a trade whether the institutions are in it or not. All right. If they're not in it, I'm not going to take the trade. It doesn't make any difference what the other criteria look like. I'm not going to take it unless the institutions are in the trade. And we also trade relative strength and relative weakness. This is a really highly overlooked criteria that most retail traders don't understand. And I'm not talking about RSI. I'm not talking about relative strength index. What I'm talking about is if you look at a trade and you want to go long, is that stock outperforming what the S&P is doing that day, what the SPY is doing? The SPY is moving sideways or going down, and you've got a stock that's stacking green candles on a 5-minute chart. It's got relative strength, and vice versa for relative weakness. This increases your edge by a lot. First of all, it's going to allow you to get out of the trade with less of a loss or even a small gain if a market reverses on you because the stock is outperforming the SPY or the Qs. Now we trade with the market trend if there is one. If you looked at a day like Friday, it was chopped. We gapped down and then we just chopped all over the place most of the day. It's very difficult to do that. So when you don't have a market trend, we just follow the institutions. If we have a market trend, we trade in the direction of the market trend with the institutions. And the last one here is buy near support and sell near resistance. And this is, again, meant to try to get traders to avoid FOMO, fear of missing out. A lot of traders, when they see a stock, Netflix is coming out of the gate flying in the morning, at 9:30 it comes up, it puts in 4 or 5 big green candles in a row, and everybody's, the retail traders are sitting there, and they get this awful feeling that they're losing money. So emotions start to set in, and it's called FOMO, fear of missing out, and they jump in, and it's very commonly occurs right at the high of the day, or high of that particular time. So they get in, and then it pulls way, way back, and they're basically taking losses and don't know what to do. So if you wait for a stock to come down to support for a long, or go up to resistance for a short, and then take that trade once it confirms that it's gone back into the original trend, this is where you're going to do much, much better, because your losses are going to be much smaller. You're going to get out of the trade. If it goes against you, you don't really have to wait too long. If you're buying at the very top, when you're $4 away from your next support level, it's going to cost a lot of money, and you're never going to be able to stay in the trade. You're not going to be able to take the pain. All right, so those are the edges that we have over other retail traders. And remember, we're trading against other retail traders. We're not trading against the institutions. Okay, now the compass system is what the SPY Super System used to be called, and we've made enhancements to it. It's now called the SPY Super System. But what this software does is identifies the highest probability setups while sidestepping setups that look good but fail more often they succeed. It's very, very important. And this does this by identifying when the institutions are driving the move and when they're not. That's what we need to know. And the system analyzes complex trading data and displays the results in easily identifiable visual format. This is important because even though it's crunching a lot of really complex information, the way that it's visualized on the screen, as you'll see, is really pretty easy to see. Even newbie traders, new traders will be able to identify whether an institution's in a trade or whether they're not. Okay, so that's going to help. It's going to help a lot. All right, now how do we get edge over retail trades? We just talked about that. We only take trades that are being driven by the institutions. We trade stocks that have relative strength or weakness versus the SPY or the Qs, and we trade in the direction of the overall market. If you follow these 3 rules right here, you're going to be miles above 95, 96% of all the other retail traders out there, and there's millions of them. So how does it give us an edge? Well, our trades are going to be supported by institutional buying or selling. It's going to be outperforming the SPY or the Qs, and it's going to be moving in the direction of the overall market. That gives us the edge. And it's important to understand that you don't want to be taking trades unless you have an edge. Okay, now the SPY Super System software, which I'm going to show you, and then we're going to get into how to see Heiken-Ashi's on it and how to use them. This is really important. The SPY Super System software is the critical element in finding and trading the highest probability trades. Right, the SPY Super System software is the engine that drives our exceptional results, and you're going to see the results. And last year we had 12 months. I had 1 losing month last year, September, small losing month, and 11 winning months. In the previous year, I had 12 winning months. And so the software is what helps us drive these results. So that's important to remember. It's the ability to identify when the institutional players are driving a bullish or bearish move, and when they are absent is a key factor in pinpointing high probability trade setups. It's a key. That's the function of the SPY Super System software, and it's the critical component. So as we go through all these results, you want to remember that this is the #1 thing that helps us drive these results. All right, and this, I'm just going to show you this quickly. This is the SPY Super System software on the Thinkorswim platform right here. I just want to do a graphic of it so you can see what it consists of and what we use. But the most important things here, and these are the indicators down below. These are the indicators. This is the current time frame momentum right here. This is multi-time frame momentum, and this is long-term trend. Now, these momentum indicators are really, really critical, all right? And this is on a 5-minute chart, this would be the 5-minute time frame. On a 5-minute chart, this would be the 5, 15, and 45. It's looking at all 3 of those, and it's looking at the momentum across all 3 of those. And this is the long-term trend. Now, what you see in colors here, blue and green will show up as bullish, and red and yellow is bearish. So this is going to tell us how we trade these. So if we're trading on a very quick trade, so let's say we're trading a intraday trade off of 5-minute candlesticks, we're just going to use this for intraday trades. If it's not going to be a swing trade, we're just going to look at this. All right, we look at the 5-minute time frame to determine what the institutions are doing. All right, so you can see that. Now, up here is a couple of indicators as well. This is called the pivot point. This is something I use for support or resistance, but I don't trade off of it. The things we trade off of on the 5-minute chart is this VWAP right here, the volume weighted average price. Now, if you're not familiar with that, it's something you want to have on your charts. This is something that all the institutions use. It's a critical level, volume weighted average price. If you're going long, you should never be going long on a 5-minute chart if the stock is not above that VWAP, the volume weighted average price. The second one we use is this 15 EMA. This is a 15 EMA of an EMA. This is actually a smooth EMA, exponential moving average of 15. When the price gets away from the VWAP, then this becomes a support or resistance level right here. So those are what we trade off of. So this is the whole layout of the SPY Super System software. This is what it's going to look like as I show you it on the Thinkorswim platform. All right, and this is just a couple of trades that we've done, and I want to just kind of show you how we took these trades. This was SMR right here. We entered this on 5/13. We exited on a 5/15. This is a daily chart. All right, this is the SPY Super System. If you notice when we took the trade, here's earnings, here's when we took the trade. You notice that we have green, which is bullish, on the current time frame, which is daily, multiple time frame, which is 1 day, 9 days, 1 day, 3 day, 9 days, and this is a long-term trend. Everything went green right there on that candlestick right there. And this is where we took the trade. We get out in the 13th, out in the 15th, 56% profit, 2,000 invested, created $1,170 profit. This is one of the trades we've taken recently. Really, really a nice trade. This was alerted. Everybody who is a member got this trade. And again, this was one on Tesla. And just so you can see how this looks on the platform, all right, on the SPY Super System platform. This is Tesla. Here's what the platform looks like. Where are we looking? Well, we're looking to see where we can take a trade on a 5-minute chart. Here's the VWAP. See how the price went right through the VWAP right there to the upside. You see what the institutions are doing here. You see how they went from selling to buying right there on that candlestick at the open. They took it. You could take it right here as it goes through the VWAP, and you follow it up as long as it stays above the VWAP. And when it starts to lose momentum, this is where you get out. So that was a Tesla trade right there, and you could have just taken that off of 5-minute candlesticks and done really, really well. I actually took this one. That's why I put it up here as an example, but it produced about $250 per contract on the options. And here's the SPY. Again, this if you're trading the SPY, we do these a lot. Here's the SPY. Here's the current time frame momentum off the 5-minute chart. Notice we're not looking at the multi-time frame. We're just trading off the 5 minute. But here you've got selling, buying, selling, back to buying. All right, so it goes back to buying around 11:15. You see the price going above the volume weighted average price, the VWAP right there. It pops above that. And so this is an entry for a long right here off the SPY super system. Okay, and you've also got some confirmation here. This pink arrow is a pop out of the box symbol that the SPY super system puts in there. All right, and that's what tells you that this is a place to get long. And it was another good trade. All right, and this was Wendy's. This was a short we took off our daily charts, just so you can see how these indicators work. All right, so here's Wendy's earnings. Here's the next day right here. You see how everything went to red. It was blue here, it went to red here. The institutions are selling. We took it right here, and we get out right here. We just took it one night, overnight, and out. All right. So this is a kind of graphics I want to show. It's a humorous, obviously, but if you've ever traded and jumped into a trade that went against you really hard, and you don't know whether you should stay in or not stay in, you don't have any strict criteria to follow. This is emotion. This is what you look like when you panic, and I'm sure everybody has experienced this. I have, when I first started trading, I experienced a lot. What we're looking for is to have a methodology where we can feel comfortable or confident in the trades we're taking, knowing that over time they're going to be profitable. And the trades we take in the room and on the alert service are profitable between about 84, 85% up to about 90% of the time, most of the time. And I'll show you some of those results. All right, but this is what we don't want to be. This guy, we want to be this guy. All right, now just before we get into the Heiken-Ashi, I do want to point something out here. And this is for a specific reason. With process precedes results, process before profits. You've got to learn the high probability criteria and strategies. You've got to learn that before you're going to become successful. And the reason I point this out is that learning those must come before focusing on results, because a lot of people focus on their P&L. I have a lot of traders who take true trade, and they judge their success based on whether the trade is profitable or not profitable. And this is not going to work, all right? Because you can take good trades that go bad, and you can take bad trades that you make money on, but you're not focusing on the right thing. I recommend people don't even look at their P&Ls when they're trading. They should just be looking at the technical setups and following those. Okay. And this is this is for informational purposes. I'm not going to go into detail, but this is kind of a thought process that a lot of retail traders that are successful go through. It's called the OODA loop. It's basically just 4 things: observe, orient, decide, and act. So when I'm observing, I'm using my scans, watch lists, and news to identify prospects. I orient, I identify whether the prospects meets the high probability criteria on the daily and 5-minute chart. I identify support and resistance levels, know the next earnings date, and check the option chain for pertinent information. Well, I'm going through this each time that I'm going to recommend a trade. I look at these things. And then decide. You make a decision on whether this trade qualifies as a good high probability trade setup or not, and then act. Take the trade. Try to avoid analysis paralysis. You can stare at these things and have so many indicators in your chart and so many questions that you can go through this process and never get to the point where you take a trade. So that's what that's meant to do. Okay, and this is the high probability trading setup, what I call the setup funnel. This is the process we go through. I look at the daily chart first on any trade that could become a swing trade. It may be just one I'm going to take for 4 or 5 hours, but I'm not going to take it long for a potential swing trade if the daily chart's not bullish. You've got to look at the daily chart first. Don't trade against the daily chart. So I make sure the daily chart, and then I'll look at the 5-minute chart to try to find the best entry. But this is, and the reason I put this first is a lot of retail traders don't even look at this. When they go to take a trade, they don't even look at the daily chart to see what it looks like. They think the 5-minute chart looks great. I'm going to jump into this trade, not knowing that the daily chart is against them, and they can't stay in the trade if it turns against them because they can't hold it overnight. All right, we want to trade with the trend, both the stock and the market. This is what's called the context. What's the context of the current market conditions? The market drives everything. If you've got a choppy market, it's much more difficult to make money or stay in trades longer. If you get a trending market, it's much easier to make money and you can stay in trades a lot longer. And Then the SPY super system has got to align. The institutions have to be in the trade. So the SPY super system must be green or blue for long, red or yellow for short. If it isn't, the trade is immediately scratched as far as I'm concerned. I don't take the trade. And then we look for relative strength and relative weakness. And then again, we want to try to enter near support and sell near resistance. That's the last thing. Stocks that fall out of this little virtual funnel, those are the ones that you're gonna want to try to consider trading. Okay. Now the funnel method, this is just written out what we just looked at, but you can see the key. The SPY super system indicators must align in the direction of the trade. The stock to be traded should have daily and 5-minute chart aligned. This isn't that complicated, and the SPY super system gives us everything we need to know here. Okay, and the stock should have relative strength and relative weakness, etc. As I mentioned before, if you're going long, the stock price should be above the VWAP. If you're going short, it should be below the VWAP on the 5-minute chart. Have patience is very critical. All right, now just to discuss the room, and we're going to get into the Heiken-Ashi. The room itself, the strategy we use in the options room and the alert service, we use straight calls to straight puts, of course. We do straddles and strangles, non-directional trades. These are non-directional. I've been doing quite a few of these. Debit spreads using weekly options expiration. This is a way to take advantage of a directional trade, but limit your risk on it by doing a debit spread using weekly options expiration. I do time spreads over earnings. Don't have a lot of those going on right now, but the next time earnings report comes out, we do a lot of this. These are also non-directional trades that are meant to capture the volatility crush when the earnings come out. If you're not familiar with what volatility crush is, before the earnings are released, the market makers, they jack up the prices on the option prices on the puts and calls because they don't know what the earnings is going to be. They don't know which way the stock's going to move, and they don't know how far it's going to move. So they cover themselves or protect themselves by increasing the volatility. It's called volatility crush. When the earnings come out, as soon as they're released in the morning or after the market, the volatility is going to come out of those premiums because now the market makers know the direction and they know the magnitude of the trade. So there's a methodology we use that actually captures that volatility crush, and we call it a time spread. Weekly ATM, this is a strategy that I use when the market is neutral to bullish. I can't really use it right now, too choppy, but it's very good during trending markets. Capture weekly premium by selling puts every week against a bullish stock, and we have a much longer term dated put out in time to protect ourselves. We do some credit spreads as well to collect premium. I also do what's called the SPY super system. This is a methodology using the SPY super system software. These are for very high probability trades for the SPY, the Qs, or the futures. And we do these, I take them in the room. I can't really call them out. I can identify when they're setting up, but they're too fast, so I can't alert on them. So these are one for traders who like to trade more than just 1 or 2 or 3 or 4 trades a week. They want to be able to trade more. This allows you to do that while still maintaining very strict criteria and a very strict high probability trading setup. And I'll show you the results we've had with these. These have been exceptional. But remember, on these that I show you, the results will be my results because I can't post these. These would be ones that you would learn and trade yourself off of the SPY super system software. Okay, and just to cover the alert service quickly, it's designed for day trades and short-term swing trades. It's not an investment methodology. It's designed for traders who can't watch the market all day or don't want to. It's going to have real-time alerts on the highest probability trade setups. And what's the highest probability trade setups? We do that by identifying when institutional involvement is there. This is the key right here. Then I also look at market internals, which is cumulative volume of stocks moving up minus the cumulative volumes of stock moving down. If the market internals are in my favor, that gives me an even bigger edge. And then we do some technical analysis on each one of these. Okay. And I will, by the way, take a trade if the institutions are in there and the market internals are neutral. As long as they're not against me, I'll take it as long as the institutions are in there. Okay. This is my equity curve for, I guess, Q4 and Q1 of 2025. Pretty nice equity curve. This is the kind of results. Now, this is based on $2,000 per trade, putting $2,000 into each trade. So if you were trading options, you just have to take the number of options that corresponds to $2,000 for that trade. But this also includes some of my SPY super system stuff. Those particular profits would be based on my trades, but a lot of other folks do just as well, or even better, and some do worse. But the point is they're included here, and I just want to be transparent about that. But this right here, all of this was before they started doing the SPY super system trades and put them in here. Okay, now we're going to talk about trading Heiken-Ashi candles. Something that I find really, really helpful in trading. Again, trading Heiken-Ashi candles with the SPY super system. We're going to go ahead and look at some of these. All right. I want to show you, first of all, what a Heiken-Ashi candle is, what it looks like. We're going to look at some real Heiken-Ashi candle charts from Friday. But this doesn't matter what this is British pound, Japanese yen. It doesn't matter. These are candlesticks. That's all we're interested in is candlesticks. Now, these look like regular candlesticks, but these are Heiken-Ashi candlesticks. And the big significance about Heiken-Ashi candlesticks is bullish candlesticks, bearish candlesticks always have flat tops. The candlestick is always going to have a flat top if it's bearish. You notice the flat top, flat top, flat top, flat top. These are Heiken-Ashi bearish candlesticks. And you also notice something. Each candle begins in the halfway up, halfway down the previous candles. It's at a halfway point. In other words, it's going to start in the halfway of the previous candle. And that's because they're made up of two candles. I'll go over that in a while, but that's always what you're going to see. Always coming down. You see it's in the middle, going up, it's always in the middle. Now, these are bearish Heiken-Ashi candles. This is a bearish trend. You can see how easy to see this trend is. All right. Now, if we were looking to get into this trade long, let's say it's coming back down to like the VWAP down here, and it's coming down, what you're going to do is you're going to look for what's called a Heiken-Ashi reversal. These reversals are major helps in trading. So what you're looking for is you're looking for a bearish trend that's going to turn into a bullish trend. So now you're starting to see the wicks and tails, and then you get a flat bottom. Now this is a Heiken-Ashi reversal to the bullish side right there. All right, but here's something that's important to remember. When your trade is reversing, when the direction is reversing, you really want the reversal to have some candlesticks that are about as big as the ones that were in the trade. Okay, so this was reversed, but the candlesticks were much bigger coming down than going up. So for me, I wouldn't take this. I would wait for the real reversal to take place, which is right here. You see, you're getting the wicks and tails. Here's the flat bottom right here, and then you get another flat bottom, another flat bottom. This is a strong Heiken-Ashi reversal to the bullish side right there. All right, that's a bullish Heiken-Ashi reversal, and you can see the trend drives right up. All right, so that's what a Heiken-Ashi candle looks like. Dennis, what's this? You disagree about the flat top bearish candles. I've seen way too many wicks on bearish candles. But they're not Heiken-Ashi candles. They're not bearish Heiken-Ashi candles. Heiken-Ashi candles are made up of two candles. If it has a wick on the top, it's not a bearish Heiken-Ashi candle. It does not qualify as a Heiken-Ashi bearish candle. It has to have a flat top. If it doesn't have a flat top, it's not bearish. When the bearish, you notice when the bearishness starts to stop, you start to get wicks on these things. Just like when this starts to fade, you start to get wicks and tails. That's a Heiken-Ashi bullish candle here. That is not a Heiken-Ashi bullish candle. All right. All right. So the distinctions of Heiken-Ashi candles. The bullish Heiken-Ashi candles have flat bottoms. The bearish Heiken-Ashi candles have flat top. This is the most important thing to remember. All right. You've got to have the two candles creating a flat top and a flat bottom. All right. And bullish Heiken-Ashi reversals are identified by flat-topped Heiken-Ashi candles, which are bearish, followed by flat-bottomed Heiken-Ashi candles. Those are bullish. That's a Heiken-Ashi reversal. And bearish Heiken-Ashi reversals are identified by flat-bottomed Heiken-Ashi candles, followed by flat-topped Heiken-Ashi candles. All right. And the Heiken-Ashi candles are important because when you go from a trend like this that's coming down, and then you reverse to a trend like this first Heiken-Ashi candle has a flat bottom. This is by definition a confirmation of the reversal because it's made up of 2 candles. Much easier to identify than reversals on individual candles, just regular 5-minute candles. This has the built-in confirmation in it. Okay, so that's why they're so helpful. All right, so I'm not going to read through all of this. This is an article I did and read it quite a while ago, but just to kind of explain about Heiken-Ashi candles, it means average bar in Japanese. It smooths out the price action, so identifying trends and reversals is clearer since they eliminate a lot of noise and make it easier to see the trends and stay in the trade throughout the trend, allowing improved profits. And I'm sure if you've traded off of regular 5-minute candles, you know about all the 5-minute noise you can get. Big candle here, then a small candle, big candle, a lot of chop, a lot of chaos, very difficult to get shaken out. The Heiken-Ashi candles will help you avoid some of that. Okay, and we talked about the flat tops for bearish and the flat bottoms for bullish. Okay, we've already covered all of these things, but I do want to leave it in here so when you get the replay of this, if you want to read through it, you can. And again, I do emphasize when you get a valid Heiken-Ashi reversal, the first thing that needs to be true is the Heiken-Ashi candle height has to be at least as large, preferably larger than the prior candles that occurred prior to that reversal. You want the trend to reverse with a strong candlestick. Okay, this is kind of an introduction here. We'll just talk about this, but again, Heiken-Ashi candlesticks evolved from regular Japanese candlesticks. They combine open, closed data from the previous period with the open, high, low, closed data from the current period. And that's why they always start in that halfway up the previous candle. Okay, this fusion minimizes market noise, providing clearer depiction of the trend. This is what makes it easier to follow trends. And again, it comes out to average pace. That's what Heiken-Ashi means. Okay, and again, just understanding trends. We'll talk about this one more time because this is really one of the things that's going to help you trade these things. Flat bottom candles in an uptrend are a strong visual of a current trend and strength. You see these flat bottom candles, you see how many they are, and you see how easy it is to see that trend. Now, if you look this on regular candles, it wouldn't look smooth like this. You're going to have a lot more chop in there. All right, so here you are bearish coming down. We chop around a little bit, and then we get a nice Heiken-Ashi reversal. Now, if this was the VWAP, for example, and here's a Heiken-Ashi reversal candle right here, this is where you would take the trade and you would stay in it until it starts to lose. Now, you might get out of it right here, but you definitely would get out of it up here as it gets wicks and tails and starts to head back. Okay? Okay, and again, tips for using Heiken-Ashi. This is really a lot of the same tips that you would use for any trades that you were doing. Examine the nearby support or resistance level, inciting potential gains. If you're going to go into a trade long, and you look at the daily chart, and you're 10 cents away from the 200-day moving average above, in other words, you only have to go up 10 cents to get the 200-day moving average. You don't want to take that trade. You don't have enough room to the upside. So always examine nearby support and resistance levels. This is what's going to determine if it's going to impact your potential gains. All right. Align the trade with the current market trend if you can, and choose stocks with relative strength and relative weakness. This is the same kind of criteria that we talked about earlier on. All right. And I do switch to standard candles when I want to get out of the trade because I want to exit. If I've got profits, I want to exit quickly if it starts to reverse, and I can do that more quickly on single candles than on Heiken-Ashi candles. I want to get in on the Heiken-Ashi, follow the trend on the Heiken-Ashi, but when I get out, I want to get out on regular candles. All right, so again, we covered this already, but I'm trying to reinforce this. Bullish Heiken-Ashi candles have flat bottoms. Bearish Heiken-Ashi candles have flat tops. Bullish Heiken-Ashi reversals are identified by a flat top candle, followed by a flat bottom candle. And bearish Heiken-Ashi reversals are identified a flat bottom candle, followed by a flat top candle. This is what you will find for reversals of going into new trends. And it's really important because you're getting in at the very beginning of a trend. Okay, so this is the recap, the advantage of the Heiken-Ashi candle. It smooths out price action, reducing noise. And we'll look at some Heiken-Ashi traps here in a second. It makes identifying trends much easier. It improves identifying the identifying confirmation of trends or trend reversals. Very big help in confirming a trend. You've probably heard when a stock breaks through a resistance level, is it going to continue? That's the question. Is it going to be a breakout or a failed breakout? And this is going to cut down on the number of failed breakouts you take if you're following the Heiken-Ashi candles. And it helps identify potential exits when the candle bodies shrink, reversal occurs. Okay. And now this is just a graphic of Uber. I just want to show Uber chart comparing regular candles to the Heiken-Ashi, so you can kind of see the differences here. Right, this is Uber. This is regular candles. Doesn't matter. This is back a couple of years ago, but it doesn't matter. But I want you to notice here. This has got bullish here, and you see the gaps. Okay, this is gaps. These are regular candles. Here's the Heiken-Ashi. Now, if we go back to this is May 1st right here. All right, see that gap up? This is May 1st right here. That was a Heiken-Ashi reversal candle. See the pink tops, the candles coming down with the flat tops? And then you hit, this actually was a 200-day moving average. But right here, and this is my TC2000 chart that I chart on. But here's a Heiken-Ashi reversal. You can see the flat bottom. And you see how we did flat bottom, flat bottom, flat bottom, flat bottom. That's a beautiful trend. This is where you would have picked it up, right there on the 1st of May for that Heiken-Ashi reversal. And you'd probably stay in it till it get right about here, and you start getting smaller and smaller candles, and you lose momentum. But here's May 1st. This is where the trade would have taken place, right there. This is where you would, and this is what you would have caught by following that. So that's what they look like. All right. So that, and we're going to look at a bunch of those. Okay. So I'm going to look at some alive ones. And I'm going to look at them on the SPY Super System, and I'm going to look at them on TC2000. Right, so I'm going to bring up the SPY Super System right now, the live one. Hold on just 1 second. Okay, so let me bring up the SPY Super System. All right, here is the SPY Super System. This is what the platform looks like on Thinkorswim. This is when I'm in the room every day. If you're in the room, this is what you're going to see. This will be this chart that I have up. These are some scans right here. This is a relative strength scan, relative weakness scan, new yearly highs, but I get about 6 or 7 scans. But what we're really interested in here is the chart here, and I'm going to look at some charts of a daily chart. So I'm going to look at a couple of trades here, a few trades. This is from Friday. This is from yesterday. This is the regular daily chart from yesterday on CCEP. Okay, this comes up on a scan that I have called the Heiken-Ashi reversal scan on TC2000. Right, but these are regular candles. Let's switch over. This is all you have to do to switch over to Heiken-Ashi candles. You go to your candle type, you switch to Heiken-Ashi. What you're going to see right here is, I can probably zoom in a little bit better. See the wick and the tail right here on this candlestick? See the flat bottom candlestick right there? That's a Heiken-Ashi reversal candle on CCEP. This was a Heiken-Ashi. Notice that the institutions are all green across them, all the time frames on momentum here, multi-time frame momentum and trend. So CCEP would be a beautiful trade to take a potential long on Monday. All right, AstraZeneca is another one. Here's AstraZeneca. Same thing. See that? Wick and a tail, flat bottom. This went from selling to buying right on here on Friday. This becomes a potential long for Monday. Okay, I have a few that I picked up. So CHKP right here, checkpoint, another Heiken-Ashi reversal candle right here. This is really kind of a continuation because you had some bullishness in here, and then it kind of faded a little bit. But the institutions kept on buying. You can see that it's blue and green. But this was a Heiken-Ashi reversal, so that becomes a potential entrance for Monday. Verna, this is a biotech. Beautiful one here as well. See the choppiness? See the Heiken-Ashi reversal candle right there, flat bottom. All right, that's important, very important. And one more long here, we got ZS, Zscaler. At earnings here, and you can see the institutions will buying the heck out of the Zscaler, but we do have a Heiken-Ashi reversal on it on Friday. Okay, now let's look at a couple of shorts. AMX here, American Mobile. See the Heiken-Ashi reversal right here to the downside. Notice what happened here in the current time frame momentum and multi-time frame momentum in the trend. They all went from bullish to bearish right there on this one day. Off of that Heiken-Ashi, you get a Heiken-Ashi reversal candle. If that opens red on Monday, it's a beautiful trade for sure. Okay, ALB. ALB right here, same thing. Bearish, bearish, bearish. So we had a little bit of bullishness here, but the current time frame momentum is red. Multi-time frame is yellow. That means it's bearish. The institutions are selling it. You take it right here. Monday, this becomes another potential short. Right, and one other one, and we'll do an ENTG, which is what I had up on the beginning. ENTG, right? There's this is basically a bearish, I wouldn't call it a reversal, I call it a bearish continuation, because you see how bearish this was coming down, and then it moved up, and now it's taking to the Heiken-Ashi to the downside. Everything is bearish, right? So that's the SPY super system. This is how we read them. And we can read them on 5 minutes. We can read them if I switch over to the SPY, for example, and I wanted to take a trade off of a 5-minute chart. I switch this to 5 minutes, and here's the SPY from Friday, right? And it didn't really do an awful lot, but there was some potential trades in here. Not a lot, but there was some potential trades. You can see I see how we were green here the whole way. So there was bullishness here. Until I go back here, see how it went from buying to selling to buying. But notice we're below the VWAP. As soon as we get above the VWAP, this becomes a long. We're green here. We don't care about this because we're only using a 5-minute chart. We use this, and this is where you would take it as it breaks above the VWAP in 3 or 4 candles, and you're out. But the day was very choppy. You can see, so there wasn't an awful lot of great trades on the SPY. And you can use this for other stocks. You can use it for Tesla as well on a 5-minute chart if you want to use Tesla, to go long or short. Tesla could have been traded both directions. Here it is on in the afternoon. You see this red here? Everybody's selling. The institutions are selling Tesla. You notice it's compressing along the VWAP. It breaks down with a pop out of the box symbol right here. This is a beautiful short on Tesla right there. A beautiful short, and you just take it in flat tops, stay on here, and then you just get out right here as it comes down. Notice it backed over to buying again when you get out of the trade. All right, so those are how you use it on the SPY super system. All right, and I'm going to do one other thing here. I'm going to show my TC2000 chart right here, and just so you can see. Again, so this is the same thing we just looked at on the Thinkorswim platform, the SPY super system. This is my TC2000. You can see the same thing right here. See, there's a Heiken-Ashi reversal right there. You can see the different trends here off of Heiken-Ashi candles. If you go back and look, you can see those. All right, and AstraZeneca, another good one here. Reversal right there. Nice big candle, Heiken-Ashi reversal to the upside. Very strong. This is my TC2000 chart. I've got some other indicators on here, but that's the 200-day moving average. This is the 8 exponential moving average. But this is what I'm looking at for Heiken-Ashi reversal candles, and I do have a scan for these kind of things. All right, and ALB. This was a short. Here's ALB right there. See that flat top? Okay, so this kind of should give you a feel for how you use these Heiken-Ashi candles to trade. All right, that's how these things work. All right. Now we've covered that. I'm gonna look at some more SPY super system trades that we've taken in the 5-minute chart and off the daily chart in just a minute. But I'm gonna cover the results quickly just so you can see what we've had. Now remember, as I said at the beginning, we use a methodology, we use a strategy, we use the institutions, and that's our methodology, that's our system. And these are the results we've been having with that for the last few years. I'm not going all the way back, but this was 2023. If you put 2,000 into each trade we took in the Compass options room or the SPY super system options room now, about 60,000 in profits for that year. 2024, about 55,000 in 2024, right? So pretty consistent. Again, a lot of the profitability is dependent on what the market's doing, how long can we stay in a trade, when do we have to get out of a trade. it's kind of critical. And that helps, the trending markets help a lot. Choppy markets make it more difficult. This is just something I wanted to point out. This was really something we're pretty proud of in the room. If you were familiar with when the tariffs went on, the tariffs were paused. If you were familiar with the volatility that get into the market a few weeks ago, the SPY fell down. It fell down 10% in 2 days off of that the tariffs going on, and then it jumped up about 20% or 15% a few days later. But while that week, we only had 4 trades on. These are all in the room, and they were also these are all the alerted trades, and these are the trades that we had and we closed while the market was dropping like that. We had Broadcom, AVGO. We get in for $75 a contract, 75 cents if you're just using the parlance of an option, but they set $75, and it closed for $1.04, 39% profit. So 2,000 invested in that produced $754. Nike, we had Nike. We get in for $2.85, $2.85, $285 a contract. We closed it for $9. That was a 216% profit, which was our best profit of the year. A big move. We don't usually get big moves like that, as you'll see in a second. But again, the tariff when they went on really hit Nike hard. They produce most of their shoes in Vietnam. So 2,000 produced in that. 2,000 invested in Nike produced a $4,300 profit. We had Sarepta get in for $450, out for $8, 78% profit. That produced $1,400. And NNE, another one, smaller win, $180 per contract, out for $225, 25% profit, produced $495. Those are the only 4 trades we had open and the only 4 trades we closed that week. And while the market was down 10% in 2 days, that kind of is a very indicative of what we can do a lot of times. The market doesn't, we're just trading the market. We don't care whether the market goes up, the market go down. Again, this is an investment policy. This is a trading methodology. We're trading to make money off the market. Whether the market goes up, the market goes down. We don't care. All right, so just to kind of review the trades, these are in 2024. I'm just going to run through these very quickly, but the thing I'm trying to point out here is the percentage gains. Normally, this is normally what you're going to see, somewhere in the neighborhood of 10, 20, 30, 40%. Sometimes a little more. We had 96% in Boeing, but typically this is the kind of gains you're going to see in the trades that we take. The smaller one, considering 200%, but typically they're going to be around 10, 20, 30%. I'd say most of the average is probably about 30%, 30 to 35%. And this was January of 2024, 20 wins, 2 losses, 90% win rate, 75.05 was the profit, 2,000 in each trade. February, a good month last year, 24 and 2, produced 11,745. And the room produced 69.30. I'm not going to go into each one of these, but I do want you this is the most important thing. This is the consistency you're going to see in the trades that you take. All right. It's going to be in the 20, 15, 20, 25, 30, 35%. And you're going to have losers. Try to be transparent here. We have losers. Everybody's going to have losing trades. We do have some losing trades. We had 2 losses that month. This was May. I just jumped into May. I did this to show these are time spreads. We did a lot of earnings time spreads that month. And we had a good month, $4,900 profit on 2,000 invested each trade, 88% win rate in May. Is June, again, consistent. You see the consistencies. We didn't have a lot of trades in June. Alerts, we had 14 and 1, 25 and 4 in the room. But you get 17, 15, 23, 15, 21. And very consistent. We had some losers as well, of course, but still, this is the bottom line on these things. The alerts actually outperformed the room that month. July trades, again, very consistent. 6,000 up, 3,300 in the room in the alert service. Same kind of percentage of gains. Very consistent. Do the same thing. August, same thing. September, this was the losing month I said we had. We had 1 losing month last year. In September, 8 wins and 5 losses. Terrible month for me. 72% win rate, lost $1,700. The room, 8 and 4, lost $295. This is my biggest losing month in 2 years. But again, compared to what we're winning here, 4,500 then we lose 17, and then we win 7,400. It's a very small, because we're so cautious with the methodology we use. It's producing high probability trades. We're only taking the trades that are likely to be profitable. So this makes a big difference. So the number of trades you can't predict. It just depends on when we find them. So again, here's October, same nice month. 57, 32, 31, 17, 16, same percentages, had some losses as always. November, same thing. Again, these percentages don't change much. You get some outliers every now and then where you get a 80 or 90% win, but you'll get a couple of losses. This was 100%. News comes out, you're in a trade, news comes out, you can't do much about it when that happens. This is January through March of this year. I'm not going to go into each trade, but 15-3 in January, 84% win rate, 3,100, 89% win rate in February, 3,800, 83% win rate in March, 7,800, and 85% win rate in April, 5,400. Okay, this is the year so far. I haven't done May yet. We had a small winning month in May. I think we only made about 2,500 or something in May. Didn't take a lot of trades. Very, very choppy to trade. If you've been trading, you know that. All right, now just to show you what the alerts look like when you're going to get an alert. If you want to be on the alert service, you're going to get the stock symbol, the option strike price, the option expiration date, and the price to pay for the option. Everything you need to take the trade. All right, this was a Nike trade that I had told you we had such a big win in. When it first came out, all you got was the date, 328, NKE, Nike, buy the April 11th, 67 puts for $2.85. That's what the first alert would have said. That's it. Then when we wanted to sell it, I sent another alert that said Nike all the way through here, and then it would say sell order for $9. Okay, that's where you would put your sell order in for $9, and then we alert you when it goes through it was sold for $9 on April 3rd. That's what the alert's going to look like. And you may get more alerts than that on one trade if we have to modify the exit price. All right, but that's how the alerts work. All right, let me just take a quick gulp of water here. Anybody got any questions at all? Okay, again, how do we achieve these kind of stunning results? Remember, it's the SPY Super System software that drives this. We're able to identify when the institutions are driving a trade and when the market internals are heavily bullish or bearish. We only take these trades when both of these are in our favor, or at least the market internals could be neutral. And that we align our trades with the institutions in the market. How we do it, the SPY Super System software, it does triple screen assessments on momentum, trend, also money flow, but this is the most critical one that I see. This is the one that makes the biggest difference in our trading, is to be able to identify momentum correctly. There's a lot of things to try to measure momentum, but the way we've got it measured in there is we're using the Laguerre, and we're stripping out the divergence. It's just straight momentum. And when you've got momentum on multiple time frames going in exactly the same direction, then the likelihood that institutions are pushing that is extremely high. All right, so here's what we just saw a little earlier. Here's the SPY Super System template. This is what the template looks like. We showed you that. This is another template you get if you buy the software. You get this is just for doing SPY Super System trades off the 5-minute chart. If you just want to make quick trades, this is what you would use. If you're just interested in trading stocks, ETFs, or a SPY Super System like the SPY, the Qs, the IWM, the futures, this is all you need. You get current time frame momentum, you've got the VWAP, you've got the 15 EMA, and you get your pop out of the box symbols. That's all you need to do the SPY Super System trades. All right. What's this question? Is right line trading system using AI in order to follow the smart institutional money? Well, what this system is doing here is it's basically looking across multiple things, across multiple time frames to see it. Now, I don't use any AI in this. You know, AI would be a program driven thing. You would have something that you program to look for that kind of stuff. They use some AI for some products they have that is trading off a Ninja, looking at to trade futures. But I typically don't trade futures. You can trade futures off of this, but I don't. But the thing is, what you're trying to detect here is you're trying to detect what the institutions are doing by looking across multiple time frames, and the institutions leave footprints when they do this kind of stuff, right? Just to tell you a little bit about momentum. Momentum is just not a stock moving up. Just because you get green, 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 this doesn't tell you a stock is that you've got momentum. What momentum is each candle that you look at, as you go from candle to candle, a real momentum tells you that the close for that candle is getting higher to the high for that candle. So if the close of each candle is getting closer and closer to the high of the candle, then that is momentum. You could have a candle that's above the other one, goes from one and it goes to the next one, and it's higher than that previous candle, but it's not closing closer to the high of that candle. That is not momentum. All right, so that's what we look at from momentum. It's much different than what a lot of folks think of momentum as. All right, so this was a SPY super system trade. We took SPY super system trade being a trade that we're trading just off the 5-minute chart, just for a quick trade. And this was a SPY super system trade on the triple Qs. Notice here, current time frame momentum, buying, see it's green, and then it goes to yellow, selling, right here at 11:45. See where the 15 EMA is right there? You see the price breaking below it? Right there? This is where I took the trade, right there. And as long as it stays below the 15, which is this little thin red line, I stay in the trade, and 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 I stay in the trade. That's what you'd be looking for on the SPY super system trade. And this is telling you that you're still bearish. Notice how the institutions continue to sell, continue to sell, continue to sell. The momentum indicator right here is right down as low as it can get. All right. Now, to talk about the SPY super system trade, this is one we just talked about right here. That's what that trade is. This is what we take, and these are ones that I take. These are the results I've had. But we also have a strategy and a methodology for this that I have a video on, and we talk about it in the room every day. I can tell you when they're setting up. I can't tell you to take them or not take them, or when to get in, when to get out, because they're much too quick. But a lot of traders like to use these. So these are the results we've had with the SPY super system trading off of the 5-minute chart that I've had. And I started in July. These are the 25, 96, 16, and 0. August, a lot of trades. Now we can take a lot of these trades because you get multiple setups during the day if the market is performing the way you want it to. If it's trending or chopping around, but chopping and then trending, then you can get a bunch. So 56, 6, and 2 produced $8,201. September, 43 and 2, 40 wins, 3 losses, 2 scratches, 71.32. So you can see the results have been really good. I have never had a losing month with the SPY super system. The thing to keep in mind about this is if you like to make quick trades, scalping, this is not scalping, but fairly quick trades. With the SPY super system, you're only going to have one trade on at a time, but you've got to watch it, and they're going to be very fast durations. You can't put these on and walk away. You have to put these on and follow them. Get in and get out, because it's likely only going to last 2 candles, 3 candles, maybe 4 candles. All right, and this was November, 54 and 5, 9,300 in December at 10,000, 69 and 15. And I think February fell down to about 4,500 or something like that. So you're going to have mixed results. It just depends on how many trades you take, depending on the market. But I have not had any losing trades with the SPY super system. And this, just to recap the last quarter of last year, this was the SPY super system trades, as I mentioned, 48.31. These are the SPY Qs and IWM. This is the room and the alerts right here, 17 and 3, 74.48. This does not include this. This doesn't include this. These are 2 separate methodologies. These you'll get alerted on. If you're in the room or in the alert service, you'll get these trades, and you'll basically reproduce the exact results, fairly much the exact results that I got here, because these are when we get in, when we get out. These are my results. So this is what you could do if you were trading the SPY super system and you learned how to do it. I've got a lot of people that make more money than I do on this because that's all they do all day long. I'm looking at a lot of other things. I'm answering questions. I'm looking for other trades. This is all they do. All right, so this was October, November, very nice. Again, 7,300, 9,300 here. December, 10,000 here, 4,500 here. Again, these are not inclusive of each other. Each individual is a separate strategy, a separate methodology. All right. So that was the last quarter of last year. Very nice, again, very nice results. You know, obviously it doesn't predict what's going to happen in the future, but this is the results we had in the last quarter of last year. All right. Let's see, Damon, does the right line trading system use any of the Nasdaq book viewer level 4 along with the heat map system to see the large buying orders and any of this? See, what I'm looking at here is I'm looking at a cumulative volume on bullish stocks and bearish stocks. I'm looking at the cumulative volume of stocks moving up minus the cumulative volume of stocks moving down. All right. And to me, that gives me a much better overview of exactly what's going on in the market. All right. And as opposed to diving down into some really detail. I mean, a lot of people use, they'll use gamma levels, et cetera, and things like that. But I found if you're looking at the cumulative market index, or the cumulative volume index of stocks moving up, moving down, that's going to give you all you really need to know about that. All right. But I understand what you're talking about. Yeah. Yeah. Again, you don't want to buy a host of trading software. The thing is, you can really complicate things a lot if you're not careful about some of these things. You can just put too much things in there. You can look for too many things. You're gonna get handcuffed trying to make a trade. All right, back here. This is a SPY super system trade. These are some actual results we had. This was when you can see it looks a little different here. I didn't have the actual gear down here at that point in time. I do now. I got rid of this thing right here, which was a confirmation line. I didn't like it. It didn't really help me. So I got rid of that, and this is what I use. But this was a trade we took. Right here was the entry. You can see how it went from selling to buying, moved up right here off the VWAP. Okay, with a pop out of the box symbol, you take the trade there. Again, current time frame momentum is right here. This is all we're interested in on the SPY super system. There is the trade right there. It stays above the 15. You're watching it, you get out right there. See, this stayed green the whole way, even though the multi-time frame was chopping around. We're only taking a SPY super system trade. We're only interested in this. So that was a nice one, $220 profit per contract. This was a $90 profit per contract on the SPY. This was a quick trade, get in here. As it went, it was bearish, took it as it broke down below the 15, get out right here. As the stock reversed back up again, he took a really quick trade, 2 candles, $90 profit per contract. Another one on the SPY right here. And again, this is using the modified template that you get if you have the software for just SPY super system trades, using the 5-minute candlesticks. Here it is right here. Here's where we took it right there. As it went from buying to selling, we take it here, moves back down, we get out right here. That little line down there was actually a pivot point, which is getting pretty close to it. But that's on the modified layer. Here's the VWAP, here's the 15, here's the current time frame momentum. That's what you use. And again, this is a new one with the SPY super system. This is a new template, the one we just looked at. You see where it goes. This is where I actually get into this. You see how this was breaking above the 15, but it was yellow? I can't take it when it's yellow. I got to wait till it goes to green or blue. It went right there. I took it right there and took that up and worked beautifully. There's another one right here. So I'm just showing what these look like, just so you can see. The results are nice. This was $130 profit. I would say most of the trades are going to average somewhere between $80 or $90 a contract, up to about $120, $130, $150, especially when the market's chopping around, because you can't stay in them a long time. This was a pretty good trade on the SPY. We get in right here. Everything was green. You can see that the institutions were buying the heck out of it, but you're just trying to find your entry as it bounces off the 15 and take it right here. All right, this is another one here, SPY super system trade, $90 profit. This was on the IWM, the Russell 2000, doesn't move an awful lot. Bounced off the 15, you notice it went yellow, selling, buying, blue. Then went right to green, which is even more buying. So we took it right here, and we didn't get much movement initially. Depending on where you bought in on this candle, You might have been down a little bit of money as it moves, but you basically, you wait because you're not going to get out unless it closes below the 15. And it doesn't close below the 15. And then we get out of the trade right up here. Right? Stay green the whole way. Current time for momentum, stay green the whole time. IWM, nice short right here. Again, compression, selling. The institutions are selling the IWM. You take it, trade right here short, right below the VWAP. As it breaks below the VWAP, you stay in. Once the price gets away from the VWAP, now the 15 becomes your stop, and you just stay in right here down here. That was another nice trade, $120 a contract. All right, 823, just another one. So you can see these. Again, I don't want to beat you to death with these things, but I do want you to see the strategy. You see how easy these are to see. There's a VWAP right there. It's buying. It's breaking above the VWAP with a pop out of the box symbol. You take it there, and this was $150 a trade here on this one. That was a fairly long trade back in August. This is another SPY trade right here. Okay, you can see where would you take this? I put this on here because I wanted folks who are interested in this to see. Here we go from selling to buying. All right. So here's a big green candle, but do we take it here? We do not. See the VWAP right there? VWAP is a very severe resistance level. You wait for the price to break above it. Here's where you would take the trade. As it broke above the VWAP, you take it here and you ride it up and you're out, right up here. Okay. And this was I just show this one because this is one I traded both ways. I took it here as it comes down, comes off the VWAP and heads down. Everything's red. It's selling, selling, selling. I take it here. I get out right here. And now it goes back to blue. See this? It goes from selling to buying, and the buying breaks above the VWAP. I take it long right here as it goes above the VWAP and the 15 with the pop symbol. I take it long right here and I ride it up till it gets to the pivot point and I'm out of the trade. So I took this one both ways. Right, so you can do that as well. And another SPY super system trade right here. I didn't put entries and exits. I want you to kind of see if you can see it. But here you got buying, going to selling. See the selling break below the 15 right here with a pop out of the box. There's your entry right there. Current time frame momentum, yellow, that's selling. Take it here. It stays below the 15. You stay in the trade till it get right here, till it starts to pop out and get out right there. Okay, so that's the SPY super system. I cover that because a lot of people like to trade these things. I know a lot of people like to make trades that are fairly quick, and that's one you can do. You have to take one trade at a time. You've got to manage it yourself. You've got to, you can't put it on and walk away, but it's very, very nice. Now, these are some of the trades of the high probability trade setups. These are what we've taken on the swing type trades. All right, and again, this was SMR. I just showed this a little earlier, but this is off the daily chart. You see the SMR earnings here. You see we knew this was a Heiken-Ashi because we looked at this on the Heiken-Ashi chart. There's the bounce in it right there. We took this SMR trade right here. We get in, get off right out here. That was a beautiful trade of 50-something% on that trade. But notice it's everything went green. Now when we're on the daily chart and we're looking for swings, we need both of these. The current time frame momentum, the multi-time frame momentum. Both of these need to be green or blue for long, red or yellow for short. Right? Not that complicated. This was Nike. This was the big Nike one we took. We took it here on the 28th. If you saw that alert, this is when we took it. And it was actually profitable that day to the tune of about 60 or 70 cents a contract. But we stayed in it as it stayed red. All right. And it hasn't gone up to the 15. And this is where we got that big gap down. This is where we took the 216% profit on Nike. See that the selling is vicious here. Sarepta was another one we were in at that same time. Again, we took that on the 28th as well. You can see we took it right here. Again, this VWAP, by the way, this is on the daily chart. You do not use this on your daily chart. Toss puts it there, but I don't use it. All right, so here's what we see here. It's coming down here on Sarepta. We take it over here. We stay in it, and we get out right here on 4. I think right. I don't know if we went to 4.4. Can't remember. Might have taken it off at 4.2 because we had a pretty big profit right there. HIMS, this is one here. This was one I kind of missed actually. I took it here, but you notice how this thing went to all green right here. That's probably where I should have taken it, right off the 15 on the daily chart, but I didn't catch it till here. And I took it here and I stayed in it, and it produced a 25% profit. This was in the room and on the alert service. I kept a runner on. I kept a few contracts to hold on HIMS, and those went up 269%, but that's not included in the results of the room. I didn't put that in there because I don't think it's right to do that. Okay, Palantir, another beautiful run here. See, buying, selling, buying again, right? Blue buying, yellow selling, back to green, buying. It breaks out, we take it right here. 31% profit in 2 days on Palantir. Lulu, another nice short here. This is where we took it. This was earnings, it capped down. We took it as everything was, you see how it was blue here on the daily, but went to yellow? That's what we took it, right there. In for 192, out for $3 overnight. That was just an overnight trade. Amazon, this is a 5-minute chart. This was a 5-minute chart on Amazon. So we're interested in the daily, the 5-minute current time frame momentum right here. This is where we took it. Could have actually taken it right here, but see, it was yellow. Took it green here and wrote it up. That was a 32% of gain in 45 minutes. All right, ENPH, another nice short. Just so you can see these, this is a compression. There's the pop out of the box symbol right here. Everything's red. We know we're going to short it if we can find an entry. We were in this thing for an hour, 20%. And Verizon, same thing. Institutions selling the heck out of this thing. Anybody can see that they were selling this. Just a matter of finding the right entry. Compression breaks below the VWAP right there. You take it right there short. We were in this for 1 hour and took 50% profit on Verizon. Verizon, if it moves, you can make a lot of money on Verizon because the options are fairly cheap and they're fairly tightly spread. Because usually you don't get a very big move in Verizon, but this was a pretty nice move. Tesla, this is when we took overnight. We liked it at the end of the day. Everything was red or yellow, so we knew it was short. We had a pop out of the box symbol at the end of the day, so we took some puts overnight. We got a nice break here that it fell from 120 to 112 overnight. The puts exploded. That was a big profit. Okay, so that's the charts. That's the SPY super system. That's the software. Again, this just recaps what we do in the room. Right, we're doing calls and puts and non-directional straddles and strangles, debit spreads using weekly options expiration, time spreads over earnings, weekly ATMs when the market allows us to, which it hasn't lately, and then the SPY super system. This will be only in the room. I'll only let you know when I see a setup, but there's a lot of setups that I don't see because I'm doing other things, but a lot of other traders catch them. All the time I get folks posting that they just made $120 a contract, just made $200 a contract, just made $80 a contract on SPY super system trades, and I'll go back and look and say, yeah, it was a perfect entry. They'll ask me, was this a good entry? And most of the time it was. All right, so what the offers are here, and these are really pretty exceptional offers, but you can take a 2-week trial on the trading room and the alert service if you want to. All right, it's not the best deal. I don't think 2 weeks is long enough to test it out, but that's what they offer. And you get the trading room, you get the text alerts, you get all my trading modules. There's about 30 of them of all the different strategy you use. It's free for 2 weeks, and then it rolls over to quarterly if you want to take it. That'll be activated after the trial, and you can cancel anytime. If you don't like it, you can take it. You can get out, but I don't think 2 weeks really gives you, especially in this market, gives you much room to make a judgment. But that's always up to you guys. But again, this is a 2-week trial that gives you the room, the alert service, and my modules. All right. Now, as far as the room and the alert service concerned, this is really a really good deal. You get the trading room and the alert service. And now it comes with the room, the alerts. Also, we have a Discord chat room community where we have 2 other professional traders in there. They have audio all day. You can talk to them. In my room, you can post questions. I answer all the questions. I chat with all the traders all day long. And you get, of course, you get the master classes or the videos on training videos. $11.96 for a year for all of this stuff. Now you've seen the results. That's really inexpensive, but that's pretty nice. Now, if you don't want to deal with it on an annual basis and you just want to buy it once and just have it be with it forever, this is the one-time payment. $19.96 for one-time payment. So that gives you into the room and the alert service forever. All right. And we will be talking about SPY super system trades if you're in here on the room. because we discussed them in there. All right. This is the SPY super system itself. This is the software, right? This is what drives everything. Now this is really quite an extraordinary deal here. Normally for a year it's $14.98. It's usually about $3 grand, but it's $14.98, right? And that gives you the Compass trading system, which is a SPY super system. It comes with the scanners. It comes with all of this, the training, right? Rightline will take over your machine and put the software right on your Thinkorswim trading platform. Thinkorswim doesn't cost anything. You can download Thinkorswim and leave it there, and they'll go ahead and put the software on Thinkorswim for you, all as part of the trade. And you won't have to worry about the technology. They'll take care of it. You also get 1 month in the options live trading room, 1 month of the text alert service if you buy the software, right? That's the annual subscription to the software. Okay, and you'll get any updates to it if we change it, or because I do change it from time to time. I also make different add scanners as well. You'll also get that. For the one-time payment, you know, look at this now. This is $14.98 for a year. Right now they're offering $14.98 for one-time payment forever. So if you want to buy the software, it doesn't make sense to buy it for a year when you can get it forever for the same price right now, right? And then you don't have to worry about messing with it from year to year. So this is probably this is the best deal I've ever seen on this. Again, it comes with everything that comes with the annual subscription. You get the trading room, you get the scanner, you get the alert service for a month, the room for a month. Oh no, I'm sorry, you get it for 3 months if you buy the one time. You get 3 months in the trading room and 3 months on the alert service for the same price. I mean, to me this is a no-brainer to me. I mean, when I first found this system and tested it out, I loved it. It increased my win rate from about 80% to about 88%. That's a big difference. All right, so those are the offers. 2-week trial that rolls over to a quarterly subscription. The trading room and the alert service annually $11.96, one-time payment $19.96, and the actual software right here. Which if you have the software, you can trade these 5 super systems yourself. If you watch my video and follow those criteria, you can do it yourself. So this is the annual subscription, $14.98, one time $14.98, same price. A no-brainer deal, really is. They've offered it just over this end of the Memorial Day period, so I would take advantage of that. All right, see if we have any other questions here. All right, let's see here. Oh, okay, a couple of questions here. Questions came by here. All right. See some of them. Okay, how do I pull up Heiken-Ashi candles on Thinkorswim D? All right, let me show you that just real quick. All right, because I showed it when I had the platform up here. All right, so here's a Thinkorswim. Here's a 5-minute chart right here. See where it says style? And right here it says chart type. I've got these as Heiken-Ashi right now. If I switch back to candle, that's what they're going to look like. All right, let me go all the way over the end here, and I switch back to chart type to Heiken-Ashi. There's your Heiken-Ashi candles right there. That's all you have to do. All right. Every platform has Heiken-Ashi candles that you can use. Do form time to time. Trade small caps on the Russell 300, Russell 2000, for trading Nasdaqs and mid. I trade everything, Damon. I mean, well, I shouldn't say everything. I'm not trading stocks that are 25 cents or 30 cents or something, but I do trade some small caps on the Russell 2000 and 2000 and 3000. Yeah, you know, I'll call out some things in the room like momentum stocks and things like that, and I'll do that. But I do trade most everything. It just depends on what's moving that day and what the institutions are in. Okay, you're asking those because you're a day trader with a penchant for trading the Russell 2000 and stock options and commodities futures as well, which is, I mean, you can, on the software, you can just put in anything you want. If you want to trade commodities, you can put the commodity symbol on there, and the SPY Super System software is going to indicate whether the institutions are in those trades or not. The only thing it doesn't work on is FX. It doesn't work on FX trades, which is, trading the US dollar against the Japanese yen, etc. Software does not work with TradingView. It only works with Thinkorswim or Ninja. Aside from working with Thinkorswim, does API or work with Interactive Active Brokers or E-Trade? No, it only works with Thinkorswim or Ninja. Now, keep something in mind here, very important. I don't trade on Thinkorswim. I have the SPY Super System on Thinkorswim. I don't make my trades through Thinkorswim. I make my trades through Tradier. But you can make your trades through any platform you want. All right. You just use the Thinkorswim platform to put the SPY Super System on there to allow you to actually see the indicators that let you know whether the institutions are in there. Then you just put the trade in with whoever you want to. This software provides scans for target stocks. It has quite a few scans. It depends on what the market's doing. Like the scans I showed you, I briefly showed you some of the scans that we have here. All right, these are the ones that are up I have right now. This is a 5-minute scan for relative strength. This is a 5-minute scan for relative weakness. This is a scan for new yearly highs. But there's about 6 different scans that you can get. We look for pop out of the box symbols, both long and short. There's a few different scans you can use. All right, and I have a bunch of scans on TC2000 that I use as well. So a lot of trades could be 3 to 5 bars in a 5-minute chart. Yeah, and the alerts are not for that. I can't alert on trades that are going to last 3 or 4 minutes. All right, so I may call them out in the room if I think they're going to be a half an hour to 45 minutes, and I'll put them in the room because people can get to them. But anything that goes out in an alert, I have to be fair to the people that have the alerts that they may not be able to see it right away. So only trades I'm putting out there are likely to be swing trades. Likely to be swing trades. We may close one at the end of the day, but they're likely to be swing trades, which means if you're in a situation where you're a pattern day trader and you can only make 3 intraday trades in a 5-day period, that will work better for you because most of these will be day trades. Now, swing trades. Remember, every trade I take, not the SPY Super System trade, but every trade I take that could be a swing trade is based on the daily chart, which means if it's bullish, you can hold those trades overnight if you can't close it out that day, all right? Because it's bullish and you're not trading against the market. Why have I chosen the Tradier platform over all those that take to trade trades? Because of the commissions. I trade thousands and thousands of option contracts. So even if I had to pay a dime or 12 cents for an option contract, it's a lot. I just pay a flat fee for Tradier. I pay a flat fee per month, like about $50. I have no commissions on options or stocks. I'm not pushing it one way or another, but that's why I use it. Right now, I have one other thing here that I'm going to mention, and for anybody who's still in here, if anybody has TC2000, now TC2000 is the platform I showed you right here. This TC2000. I use lots. This is a daily chart in ALD, but this is what I use for charting. Now within TC2000, I also have scans, and 2 of the scans I have are Heiken-Ashi reversals bullish, Heiken-Ashi reversal bearish. Bullish and bearish for a 5-minute chart, bullish and bearish for a daily chart. I have those scans in TC2000. And I asked Rory that if anybody today signs up for the room in the alert service for a year or for a lifetime, either the room for a year or for a lifetime, or you buy the software, all right? If you buy either of those, the room in the alert service for a year, a lifetime, or you buy the software, all right, which you probably buy lifetime, but year or lifetime. For those folks who do that today, I'll go ahead and I will give you my TC2000 scans for Heiken-Ashi reversals, bullish and bearish, 5-minute and daily. I'll give you those 4 scans. If you have TC2000, you know how it works. All I do is I get your email, I send it to you. It comes in your email. You just go ahead and click on it, and it goes right into your TC2000 platform. You will then now have those Heiken-Ashi reversal scans to use for those Heiken-Ashi reversal candles, which are so important to find Heiken-Ashi reversals for swing trades and for 5-minute trades. How do I feel about the Tasty Trade platform commission rate? Well, you know, listen, I've traded on Thinkorswim, I've viewed it on Tasty, I've traded on Interactive Brokers, I've traded on a lot. Tasty's fine. I mean, it's not much different than TOS. You know, Tasty Trade was done by Tom Sosnoff. Tom Sosnoff was the person who developed the original Thinkorswim platform before it was bought out by TD Ameritrade. So it's very similar to Thinkorswim. I think it's a little bit easier to use. And I'm not sure what the commission rates are these days. But they used to just, I think it used to be like half a buck or something for options. So I did use them for a while. Okay. But again, I don't know how many folks here have TC2000, but if you do, and you buy the software, the SPY Super System software, which by the way, as I just showed you here, there's a Heiken-Ashi reversal right there in ALB. And that scan that I'm talking about, this is where I found it from. All right, I found that from there. I found AstraZeneca to the long side from there, right there. So that's what that scan will produce. And if you have TC2000 and you buy the software, or you take a subscription to my room for a year or a lifetime, Rory will take that information down when you sign up, and he'll give me the email addresses, and I will send you those scans. I don't do this very often. I'll tell you, I've spent 10 or 12 years developing scans on TC2000. It's a great scanning platform. It does a lot of stuff that Thinkorswim can't do, but Thinkorswim does a lot as well. These scans we've got in Thinkorswim are excellent. But I have to tell you that the Heiken-Ashi reversal and TC2000 work great for me. All right, so that's. Do I have scans for TradingView as well? I do not use TradingView, no, I do not. I've been in TradingView. I had a subscription to it for a while. Honestly, I found that the TC2000 structure of creating scans, you know, looking for conditions, et cetera, to scan for were easier. It just might be that I was used to doing it for so long. But I like TC2000 better. So I don't have anything on TradingView. But I have TC2000. Anybody has TC2000. If you sign up, buy the software or sign up for the room and the alert service for a year or a lifetime, I'll send them to you. And you can use them. They'll give you some really nice information. It'll save you a lot of time trying to structure these things. All right. So anyway, I'll wrap this up now. I know I've been going for quite a while, but there is your offers, and I look forward to seeing some folks in the room next week. Jack, I appreciate that. It is an excellent product, believe me. Listen, I've been trading for a long time, right? About 16 years. I didn't have this SPY Super System until 4 years ago, when I came across I was looking for something to help me find out when institutions were in the trade, because what I found was a lot of the setups that used to work well for retail traders, you know, MACD crossovers, RSI figures, all this kind of stuff. The institutions were writing algos, they were writing programs to identify those situations, make them, create them, and then blast them, then break them down. In other words, they get a MACD crossover, they force it, and then they would reverse it. And they trapped a bunch of traders in like that. So I was looking for something to let me know when the institutions are in the trade. So that's where I came across this. It took me a long time to find it. I tested it out for 3 months, hundreds and hundreds of trades, compared my results. And the big thing I found was I was not taking some trades that would have been losers that I didn't know the institutions weren't in. The technical setups were good. The institutions weren't in them. All right, so there's where we are. Now, if you go to the chat box, by the way, there's links to all of the stuff. There's links to there's links to all of the offers that we have here. Or you can call Rory at 786-732-4656. And the website is brightlinetrading.com, and you can find it there as well. All right, so look forward to seeing some folks here in the room or on the alert service or with the software on Monday. If you have the software, you'll come in the room as well, because you'll get free access to it and ask me all the questions you want. That's what I do all day long, is answer questions for folks.
Thank you so much. That was great.
Oh, you remember? Yeah, you remember Tom Soznoff? Yeah, yeah. You know, when he sold off Thinkorswim to TD Ameritrade, he couldn't do anything. I think he had a restriction on being able to develop anything else for 5 years, and then after the time was up, that's when Tasty Trade came out, Tasty Works. All right, everybody, have a great weekend. Enjoy yourself. And I really appreciate you staying with me. I was here quite a long time, probably a lot longer than I should be, but I did want to cover some of things as much as I possibly could. All right, everybody, have a great afternoon. Have a great weekend. We'll see everybody next week. Bye-bye.
Thank you, David. Sorry if I interrupted you there. Thank you for that advanced but easy to follow strategy. Our members love your work, and traders, your access link to David's system is in the chat box right now. So thank you so much. Wow, what a great summit this was. On behalf of the entire Traders Corner team, thank you to all of our expert speakers for sharing your system, insights, and generous offers. And to all of you in the audience, thank you for showing up, staying engaged, and continue to grow your trading edge. If you missed anything, the replay will be posted on our YouTube channel. Keep an eye out in your inbox for access. Until next time, traders, trade smart, stay disciplined, and take advantage of the tools shared here today. This is Anthony Chapman signing off. Thanks again for being here. Trade smart, and we can't wait to see you all at the next summit. Thanks again.